Good morning. I don't know how many of you saw me coming across the front there, but I wanted you to see what an 80-year-old man can do. Okay? And I am not going to run this time, but next. It's great to be here. I am so excited. This is what I dreamed of in 1983. And I had the good fortune in building the company that we built to help people both educationally and as well as managing money for people. And during that period of time, something wonderful happened. Tom Cock became a friend, and an amazing difference that he made in my life and the firm's life. I met Tom in 1988, and that's a lot of years to learn if I could trust him and if he was telling the right story. And I do not find anything about what Don and Tom are doing today that isn't what I would like to have been teaching in 1983, except we didn't have an internet and a lot of other things to make it a little bit easier to teach. And today, I think we have something like 400 people that might be joining us on the internet, which I just think is amazing. But Tom and Don have built one of the finest educational programs that I know. Yes, sometimes it leads to them having a new account at Apella, but it is not just about that. It is about helping people learn how to do better, whether it's on their own or whether it is with professional help. And so it gives me great pleasure to introduce two dear friends. By the way, on our website, we have a page devoted to truth tellers because I know that I don't know it all. And I know, by the way, that nobody knows it all. But I do have a list of people that I trust that include Tom and Don. So I have put my money where my mouth is and tried to support them in any way that I can. And you're going to learn a lot today. And now Tom and Don, the voice, by the way, you want to hear the voice at work? You hear it. You hear it all the time on the podcast. The voice actually read We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement that we wrote. Thank you, Don. Thank you, Tom. The podium is yours.
Thank you, sir. Appreciate it. All Merriman, everybody.
And
I got to walk out fast.
all right, you got to go. Go.
Really fast.
Go, dude. Go.
Oh.
Go. Are there slides I need to click there, Eric? Well, good to know.
Thank you all for joining us. Wow. It's great to be here.
We've never had one of these before.
I know. It's very fancy.
10 years and we get a fancy.
Welcome. So that's
It says,
in case you didn't know that.
I
So.
hate the font. Oh,
This has been the creative director for us. How do you think I feel for the last
I hate the font.
however many years? So yeah.
What is that Comic Sans?
Okay, can we fix that right now? Can we get
Felt marker? All right.
something they did overnight
Do I need that?
along with the eggs? Yeah, for those of you who don't know, we do a little radio show that airs locally here in Seattle that's going to air right from here today around the corner, room 403 at noon. Don will be doing the show. Hopefully I can drop by, right?
All by myself?
You're probably most of the time. And then we turn that into a podcast, which we're thankful how much that's grown over the last few years.
No kidding.
It says top 1% podcast. And we had 2.1 million of you listen
How'd you
to
get
us
that
last year.
past compliance?
I never don't tell them. They're in the back of
Okay.
the room. Please stop by and say hi to my bosses, Jim and Pat, too, by the way, and tell them what a great job I'm doing, would you? Because I need this job. As I tell the folks in the office, retirement? No way. I am not letting them off this easy. Absolutely not. So
I don't believe in retirement.
me either.
But we're at Retiremeet.
I know.
I'll have to retire someday, but not anytime soon. What do you got? You
Well,
look like
I've
a
got
bag full of
yeah,
stuff.
I know. Well,
Did you have toys?
everybody else should have these things like this, right? This is the program today. You're supposed to go through all this stuff.
I am?
I don't know. That's the idea. And then, I know one thing Don was very specific about was
What did I
do
do?
not tell any of your bad jokes today. Absolutely not. For those of you who know, I have a reputation for telling bad jokes. So I went out and bought other jokes because you didn't say anything about using somebody else's bad jokes. For example, I hope you like this one. How many retirees does it take to screw in a light bulb? How many retirees does it take to screw in a light bulb?
This is really gonna stink.
What's that? Did I hear it?
It's-
None, she says. That's close. I like that. No, it's one, but you may have to wait all day and there could be a nap involved.
Oh, come on.
Oh, all right.
Was that just polite tittering?
I'm trying to see what else is in here. They've packed this
To you
these
now.
things people gave me, soccer ball, so somebody said I need to learn to let things go in retirement. So they said maybe I should grow my hair out a little bit, sort of go more
So
like
you're
this,
trying to top my mad scientist from
more like
last year,
that.
aren't
Yeah.
you?
So no. All right. That's
Oh,
all
and
I got.
speaking of it,
Oh, yeah.
but
Go ahead. Don't
no.
keep going.
No. This year, last year I came as a mad scientist. This year my wife thought I should go as a professor. So she went to Nordstrom Rack and found this jacket.
You can't see it.
Look at that. Where'd it go?
There you go.
Okay.
Yeah.
That
It's
jacket.
got the padded.
That jacket.
Yeah,
There you go.
fancy.
Look at that.
Here, look.
Corduroy
Yeah.
styling. $250 Ralph Lauren.
How much did
What
you
pay for it? $40.
Wow.
$40.
There's a bargain.
All right.
So you're supposed to go through all the stuff in there. So go right ahead.
I am?
Yeah.
I don't even know what's in
You have to
here.
do something.
Usually I
Just
make
for the
these
show.
things. Okay, there's like stuff in here.
So we have a full
Stuff
agenda
this is
today.
gonna read later.
There is some good reading in there, but the schedule's there. The schedule's going to be up here. As you may know, Don is next because he needs his nap here shortly.
I do.
I'll pick up whatever's left.
I have
after that.
discovered the power of nap.
We're going to take up Medicare later. We're going to take up housing. We're going to talk about consumer. I'm going to do a Q&A with Paul Merriman, who was just up here
You mean
briefly.
that Herb Weisbaum guy's here again?
Indeed, he is. And then Weston Wellington from Dimensional is going to be here a little later. He may sing because he has
Weston,
an amazing
sit.
voice.
We went out to dinner last
Wait,
night.
you're going to
with-
spoil my story.
Oh, you're
okay.
doing the story? You
That's
told me to tell
You
them.
go right ahead. Go
No,
ahead,
no.
please.
Last night we got to dinner with Weston and the folks from Apella to CSAR because it was not on us. It was on them.
It would have been Burger Master. It had been on us.
Exactly. Kind of fun to do a business drive-in. Anyway, Weston gets up from the table. He goes, "Excuse me for a minute. I'll be right back." And we're going, "Where are you going?" He goes, "There's a birthday group in there. Here, hold this. Hold this." He goes, "There's a birthday group in there. There's some women, and I know it's a birthday group, so I'm going to go sing them happy birthday."
No, he just decided. He did not know these people. He just decided to randomly start singing to
They're
them.
women. And we said, "How do you know?" He goes, "Because if they're a group of women at the bar, it's usually a birthday party."
I was thinking bachelorette party, but
Well, they were older, so he went birthday party. So I said, "What? You're really going to do this?" He goes, "I do it all the time. It's very popular." So I follow him because I'm dying to know what the heck he is doing. And this is really very spur of the moment. And Weston
Apparently.
Wellington goes up and
can you hear that? Pretty good, actually.
the bar is going nuts. They're just going nuts. So that's who you get to speak to you later today and maybe even sing. a
Yeah,
little
maybe he'll
song.
do that. So here's the schedule. You have that. And by the way, a couple of things, as I mentioned, around the corner, we're doing the show. We're also doing something we've never done before this year. Our two team leads, Derek and Joyce, are going to do a brief session on how we work with people. Many people go to Retiremeet. Many people call me and say, "I don't understand what you guys do." So we're going to walk through the Apella client experience. That's at 10:30 and at 2 today. So that's a breakout session around the corner. I think I got all the right. Oh, and then the retire meeting. Should you want our help after today, we will not contact you after today other than ask you what you thought of the event, rate the speakers, and please, in keeping with tradition, please rate me higher than Don. That's important. But so that'll be it. Otherwise, if you want our help, you need to fill out one of these forms. And if you're watching online, there's a click below there because we're not a sales driven organization. When you come to us, we're glad to help you. The retire meeting includes a review of your kind of overall retirement plan. We take a very deep analysis of your portfolio, looking at how much risk you're taking, how diversified you are. and how much you're paying, which many of you don't know. You'd be surprised. And then you also get time with a fee-only fiduciary advisor. So it's a pretty good deal. You just fill the form out, and someone with the orange lanyard will help
And
you with that.
guaranteed, no annoying sales pitch.
Not annoying.
No sales pitch.
Oh, okay. Not annoying. All right. We don't want to fall behind here. So
We're behind.
all my jokes and stuff. We're actually right on schedule. So I'm going to give you a couple extra minutes because I know you need them. So you heard you heard Paul Merriman mention that I've known Paul since 1980. I've also known Don since 1988. Don had a national radio show. Many of you are kind enough to remember in the 1980s, right? Not the 88. I would just think 1880s.
1990s. 2000.
And that's how we met. I owned radio station. We mistakenly put the show on there, and it got very popular. That's
everything happens by mistake. My entire life has been a series of mistakes.
Don has been the creative genius. That's why he's mad about the fonts. Don and I founded a company called Vestry many years ago. We merged into Apella a few years ago, which has been great, by the way. And the mergers worked out well because they kept Don in Florida. He had threatened to move out this way, and no, he stays there. So I really thank Jim and Pat for making that happen. But here's the other great part of being in this business, working with Don all the time, is between you and your lovely wife, Debbie. It's a great relationship. I have a lot of fun, and he's been a great friend. So please, everybody, Don McDonald.
Thanks. Yeah, he actually likes hanging out with me so much. Get this. Debbie and I are planning, if you listen to the podcast, you probably know. Debbie and I are planning a cross-country Talking Real Money road trip. Having it the Talking Real Money road trip was actually Debbie's idea because Debbie does not just want to be in a trailer with me for 3,000 miles. She wants to meet people. This is what she does. So we should make it, tied in with the podcast. So here's the deal. Tom said, if you stay a month in Seattle, I will pave you an RV parking spot at my house. He leveled and paved an RV spot at his house with electricity, sewer, everything. He now has an RV park in his backyard. So I'm going to be parking out here for the month in August.
Reserve it for this time. I rented it out for the summer.
Oh, good. Well, then we'll move on to California. I'm moving on to California. Hi, everybody. I'm Don McDonald. This is something new. Haven't done this for you guys ever. I think we did it once for AAII a while ago. I did a version of it. I want to talk a little bit about investing, but I want to talk about how investing has changed and how the way you invest should be changing along with it. Because if we were still doing it the way we used to do it, none of this good stuff would be happening. We actually live in the golden age of investing. Investing has never been easier. And despite all the crooks out there, it has probably never been more transparent and honorable than today, which is saying a lot because it's pretty crooked and pretty opaque. But we live in a really great world for people to invest for retirement, which is why I call this the history of retirement investing. Now, let's go way back. Let's go back to the 1920s. Back in the 1920s, none of you, if you were alive then, would be investors. The people who invested had vast wealth. We're talking the multi-billionaires of today. They were the investors. Just about 1% of the population. The reason being, we were a sustenance economy. Farmers have barely ever had extra income. Farming is a day-to-day, month-to-month, year-to-year proposition at best. And 100 years ago, most of the country was farming. A big chunk of the country was farming, and they were feeding this whole country with 30% of the people. There wasn't a lot of excess wealth. Now, just 2% of the country feeds all of us. More of us Yet 2% of the country feeds us all. So what that means is now we have most of the country's well-fed, can work at businesses that are more lucrative, that provide more investable income. And along the way, it's so important. This is one of the most important parts of investing. When you invest properly, you're not buying stocks or trading things. You're buying, hopefully, the global economy. Now, back in 1820, a little over 100 years ago, the United States economy was smaller than the economy of the Netherlands or Great Britain. It was not a big economy. Yet, just a few years later, 80, but that's Paul. That's Paul's life. Just Paul's life later, the United States economy had grown to surpass those other economies, but all of those economies grew dramatically. So had you been able to invest in those economies, we don't care what the market did, the value of the companies representing that economy became more valuable. They had to. And now, look at the size of these three countries' economies and look at how much grown past the rest of the world. Now, retirement. Today, it seems like retirement is ubiquitous. Everybody retires. Well, that wasn't the case just 140 years ago, 150 years ago. Most of you would, including me, most of us would have been dead. And of the few that remained, what, 3.5%? If you were the 3.5%, 78% of you would still be working. Why were you still working? You survived that long. Why were you working? You had no choice. There was no money for you. There was no Social Security. You couldn't invest. You had no excess cash. Today, check this out. 17% of the population is over 65. And of those, only 17% are still working. That's me. That's Tom. Most of the people over 65 are what based on that number? They're retired. Comfortably, apparently. Well, certainly more comfortably than we were in the 19th century. Nobody except the ultra rich enjoyed a comfortable retirement in the 19th century, folks. Nobody. It was a terrible time to live. No matter how rosy a picture we paint in historical dramas of the 19th century, if you were an older person, it was a miserable time to be alive. Unless you had kids who were willing to support you, and they were struggling, like many of our kids today. There were no pensions back then. Companies didn't take care of their employees. They expected you to be dead. Apparently, Presbyterians lived longer. It's that clean living. The first pension was the Corporation for the Relief of the Poor and Distressed Ministers. This is the name of it. And of the poor and distressed widows and children of Presbyterian ministers. What is the acronym for that? That was it. That was the first pension. By 1899, there were 13 private pensions in America. 13. Nobody had a pension. You ended up in the poorhouse. And there was really no place to invest either for most of our history. There were these tiny exchanges. You know, the exchanges like to talk about their history, and they show you, well, you know, we met around a tree in Manhattan in the early days. Yeah, that was like 8 people, all of whom were very wealthy, and they were there because the horse track was closed, and this is a place they could go gamble. It was not, they had these little tiny exchanges, but you notice the guys with their hats? I mean, these are rich people. Poor people had little caps. They didn't have these big, tall hats. And if you wanted to invest, what could you invest in? What investments existed? What companies could you buy stock in? Railroads, canals, mines. Railroads, canals, mines. Oh, banks. Banks. There really wasn't much to invest in. And the vast majority, because there was no Securities and Exchange Commission. You want to float a stock? Get a printer, print yourself a stock certificate, sell shares in the Troy Hill Passenger Railway, Troy, New York Passenger Railway. Do you think that stock's still around? Nobody was investing by the turn of the 20th century. 5% of America now. It's not much. And here's part of the problem. To buy a stock back then, is that a 100-share certificate? Yep, 100 shares. See, it says 100 shares on there? You had to buy 100 shares of stock. You could not buy a share like you can today. You had to buy a round lot through your broker, paid a huge commission to do it. Paper stock certificates were actually issued. And let's say this stock was $5 a share. $500 you had to put up. Not much. Then it was, average income was about $500 a year. So you couldn't afford to buy stocks, but we did have the beginnings of stock exchanges in the early 1900s. Lots of them. Now, when people, because we were, bear in mind, early 20th century, we were better informed. Now we had newspapers everywhere. We had the telegraph. We had telephones. So people were actually sharing information. I hear this guy made a lot of money investing in this stock. I want to do that, but I can't afford 100 shares. How can I get in on this action? Well, clever entrepreneurs would lease from AT&T one of those ticker tape machines. You couldn't buy them, you leased them. AT&T made a lot of money. You get one of those machines, you set up shop in your small town, you put a few benches in, you put a chalkboard up on the wall, and you put up the prices of the stock. And then people bet on the stock. It's called a bucket shop. People would place bets on stocks. Sound familiar? Kind of like options, futures contracts, which are just betting on the future movement of something. That's what they were doing. Those were the first options and futures exchanges, except for the agricultural ones, which had been around for a while. So they're literally, see the chalkboard? They're betting on the movement of stocks. They own nothing. They have no interest in the individual stocks. By the time of the Roaring 20s, interest in businesses, the economy was booming. The American economy was exploding in the 1920s. After World War I, we became a massive manufacturing economy because we basically supplied the materiel that won that war. We had so much industrial capacity that we could throw an overwhelming amount of equipment into Europe and men. Ours all hadn't died in the early part of the war. We had leftovers. So we went out there and won that war. And then when these guys came back, they needed jobs. The economy revved up like crazy. We had this boom in the economy. Money was everywhere, flowed like water. But not many people own stocks still because it was really hard to own stocks. It still was difficult to get into the stock market. Now, here's what happened. People figured out that they could borrow money to buy stocks. Well, now that $500 worth of stock I can put $45, $50 down, maybe 60, 70, and I own the potential increase of $500 worth of stock. Wow. It's kind of like putting 20% down on a house and figuring that you're making tons of money when the price goes up because you're cash on cash, you're doing quite well if the price goes up. As long as the price goes up, but the prices must go up, because if you have $45 or $50 on a stock and the stock goes down $50 or $50 or $60 on a stock and the stock goes down $50 a share, how much money do you have left? Zero. But the stock just went from 500 to 450. Zero. But you, and people did, borrow on margin at times up to the tune of 90% of the stock's values. That is gambling. Here's a cartoon from the 1930s. And on this cartoon, it's great. They show over here, this was the Florida land boom. Oh, only one of many. These happen all the time. Oh, look, get rich quick in oil. Anybody ever heard of that one lately even? Oil partnerships? Then the speculation on war prices. And then this little guy in the corner swears like all of us have sworn. I'm never going to do that again. I am not going to speculate anymore. I will not let my greed get the better of me and destroy me like it did in 1929. Wiping out incredible amounts of wealth. When all of that, all those margin loans came due and those stocks got called away. Huge amount of money. So what happened for the next, 35 years? Or not 35 years. Yeah, let's see, 39, about 15 years. Next 15 years. People were scared to death of investing. Does that sound familiar? How many of you remember what happened in 2008? I know you all do. I don't see anybody born before 2008. How did you feel after the decline of 2008 about investing? Be honest. How'd you feel? Did you feel really good? Did you go, oh my gosh, stocks are on sale. They're 50% off. I got to go buy some today. How many of you rushed out and bought stocks in late 2008? 1, 2, 3, 4, 5. What'd the rest of you do? Did any of you think, I'm just going to wait for it to start to go back up again, and then I'll get in? Honest? Come on. You did. You thought, I'll know. Well, I guarantee you, very few people knew when the stock market started recovering that they knew it would start recovering in the 1940s into the 50s, which it did. Now, academics had just begun to figure this stuff out. There was a guy by the name of John Maynard Keynes. They even named a branch of economics after him, Keynesian. I'm not going to talk about his economics. I'm going to talk about what John Maynard Keynes from Great Britain did in the 1930s. He came over to the United States with a big fund from England to invest. And he looked around the United States and went, this country has incredible potential. And these stocks, well, darn it, they're cheap. He looked at them historically. He started calculating the values, looking at what the assets were worth, how well they could do in a growing economy. He crunched the numbers and started buying U.S. stocks like crazy. Problem was, there weren't any other academics doing the same thing. Everybody was still seat of the pantsing it. Most of Wall Street was still, I'll do it when I feel better. You ever watch the CNBC guys? I feel like the market is poised. I feel good about this. Oh, I feel bad about the PE ratio. Oh, you hear feel a lot, right? Did any of you ever accurately and consistently feel your future in life? I feel like I'm going to meet the person I'm going to marry tomorrow. I'm feeling it. And then you didn't, and you're disappointed. You can't feel anything. But John Maynard Keynes was one of the first people who actually studied this stuff and said, based on data, I should be investing. Data. I don't care. I'm going to be in it for the long haul. He looked back at the numbers. He goes, economies grow. Economies must grow. There are no other alternatives. The economy of the world, I don't care how badly you feel about it, from watching whatever strange thing you watch that tells you it's the end of the world, they're wrong. No matter how bad it seems, it's better now than it's ever been. Will the global economy grow? I can pretty much say yes, because if it doesn't, I'll probably be dead. And I won't care. If the economy stops growing, what direction? You really need to think about this logically, because I keep hearing this. We're in trouble. The economy is going to stop growing. The stock market is going to reach a new high. Forever? Can the stock market reach a forever high? Forever high. Can it? What happens if it reaches a forever high to our economy after that? If it doesn't ever go to a new high, then it can only go in one direction. If the economy collapses completely and utterly, even if it's slowly, what are you going to do? Are you going to care about your stocks? Are you even going to be able to trade Bitcoin? Do I want to eat your gold? I want your food. I want your guns. Or I want to be dead. Now, back to investing for a minute, because buying stocks was hard, right? It was hard to buy individual stocks. Well, some brilliant guys in Boston said, why don't we just buy a bunch of stocks, put them in a big box, and sell people chunks of the box? And we'll call that, for everyone's mutual benefit, let's call that a fund for mutual benefit. No, wait. How about a mutual fund? Oh, we can mutually own all these stocks. First fund, 1924. First mutual fund. It was an open end. I'm sorry. Got to get my terminology. I'm not going to get into these weeds, but they were unit investment trusts. They were closed-end funds, but open-end fund, the one thing you could get out of every day at net asset value. The things that most of you invest in today. Mutual funds. Mutual funds started off slow, really slow. First one is 1924. 1929, 20, 1950, over 100. Wow. 1970, 250. Look at that. It took almost 50 years to go from 1 to 250. What happened since then? Oh, my chart had to get bigger. Whoa, there's 70, there's 1980, there's 1990, there's 2000, there's 2002, there's 2020. There are almost 10,000 mutual funds and ETFs now in America. Do you think the industry has grown a bit? Do you have choices? You had one choice in 1924. You paid through the nose to get into that fund. That's back when the Standard Commission, well, actually, it was by the 30s, the Standard Commission came in at about 8.5% of your transaction. That used to be the commission. What's your typical commission today for a mutual fund? 0, 0, 0, 0. Is it cheaper to invest today than it was in 1924, 30? A lot. If it's cheaper, is that good for you or bad for you? It's so good. That's all money you keep. The world is changing for the better. Mutual funds also, in addition to creating a place where it's easier for people to invest, also created something that number crunchers absolutely love. Data, 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 data. And they actually had to pay people to calculate that data. They couldn't put it in one machine, but they had data. And this whole new wing of academia took flight. Economic scientists who looked at that data and they said, wow, we may be able to see some broader trends and indicators in all of this data. A young man from MIT by the name of Paul Samuelson was one of the pioneers of this branch of science. Paul was a brilliant man. Funny is that they're all brilliant, but you'll understand as long as you don't look at the equations, do not look at their equations. As long as you don't look at their equations, you're going to go, well, that was easy. That was really, we had to study that? Paul Samuelson was the first person to postulate that if you're trying to predict the future, you're going to likely fail. And an active manager, this is in 1974, active managers aren't going to add much of anything to the value of your investment portfolio because they cannot consistently and accurately for a long period of time know the future. We all know that. We know that, and yet we don't want to believe that. Because in our own heads, we delude ourselves into thinking that, well, whatever's happening today will continue to happen into the future. Or I know more than everybody else. How many of you know more than everybody else? Yeah, okay, there's one. I knew there's always one. But Paul Samuelson came up with this really interesting theory. It led to what is called the efficient market hypothesis, which says that when you have publicly available information, in other words, it's available to all of us, whether we read it or not, it's available to all of us, there can be no advantages because we all know it. It's like when we got a call recently from somebody who said, 3M is going to split off their health division. Doesn't that mean their stock will go higher? I said, do you know that they're going to split off their health division? Yeah, I read about it. Do I know? Do they know? Are they waiting for it to happen to buy the stock? No, they know it's going to happen. So what do? What does the market do? Builds it into the price already. Anything that's known by all is already reflected in the prices. You can't know anything else. It's impossible. And he just had to speak the words. But did we listen? No. This group still exists, the Leutold Group out of New York. The Leutold Group represents active mutual fund managers, and they hate passive or index investing. Hate it, hate it, hate it, hate it. They put this ad out. Index funds are un-American. How dare they take away our God-given right to rob people? If you don't try to pick the right stocks, if you don't try to time the market, then basically what do you own? If you do it right, you own the world. If you do it right, you own all the stocks in the world on the stock side of I'm not even going to get into the bonds yet. We'll get into those. And if you're doing it in aggregate with low commissions and low fees, you can do it for very little money. Would you rather own the whole world or one part of it? Would you rather own one stock that somebody claims is going to be hot? Like, we had the guy on the show who always calls in the Tesla bull. Ever since the Tesla bull's been calling, the stock has been plunging. It's going to go up. I know it's going to. I got to tell you, I don't believe him. Last time I was here, I rented a Tesla. I didn't like it. This time I went for the Hertz Manager Special because I thought I'd be saving the company money. It was an electric manager special because I can't rent them. We're going to give you Surprise car. Great. They gave me a Polestar. These people don't know how to design cars. There's no car stuff in there. There's a wheel of sorts and a little knobby that good luck figuring out what gear you're in, because there are no gears, and a big giant screen so I can watch TV. But every time, I'm not tall, I'm 5'10", okay? Every time I get into, and I had spinal surgery. Every time I get into the darn car, I hit my head. It's not designed for people. So anyway, so don't pick the next hot stock. You will never find the smart manager. Well, you shouldn't say never. You might. Speculating is just gambling. Okay, you want to gamble? Muckleshoot Casino. Vegas, even more fun. I mean, Tom lost $100 on one pull. One pull of the slot machine. He goes, oh, I'll just put $100 in here and I can play for a while. Pulls. Oh, where'd my 100 go? Oh, darn it. This is sad. Retirement investing, it's the present and the future. Just globally diversify. It's too stupidly simple. Okay? If you were a Japanese investor and you invested in Japan 30 years ago, how did you do? You were Japanese. You bought the Nikkei. You bought the Japanese market. How did you do over those 30 years? Zero. But wait, Japan was the hottest economy in the world, right? Today, is the United States always going to be the hottest economy in the world? Actually, it really doesn't end up being that very often. We get the pants beat off us by all kinds of countries, but I'm not going to show you that slide either because I don't have time. Just accept what the market gives you. And I put in passive, non-active portfolios because these guys at DFA and Avantis make me crazy. Are they here? Reason they make me crazy is because they call their funds active. It's like, well, we don't want to say passive. That sounds like we don't do anything. What, it kind of said that. Didn't Repetto kind of say that? Yeah, that was funny. So anyway, passive versus active. This was a study done a few years by the Fama and French did one of these too, the Swiss Finance Institute, and they actually added in the effect of what the expected effect of luck would be and looked at active managers' performance from 75 to 2006, and they found that less, 0.6%, less than 1% of active managers add any perceived value after accounting for luck. So maybe you can find one, but 94% of the time you're going to be wrong. Even though they look good, it was just luck, more likely luck. Now, I love this quote. This is from one of those brilliant academics that we talked about, Paul Samuelson. Investing should be dull. It shouldn't be exciting. Investing should be more like watching paint dry or grass grow. If you want excitement, take $800, put it in one slot in Vegas. And then he goes on about it. You can't get rich at a Merrill Lynch office either. One more lesson from history in my final 2 minutes. I just added this in because I thought I was talking about this on the show with a caller. Now, in 1929, a 10-year treasury yielded about 3.5%. Okay? Pretty good. 10-year treasury. Safe, right? That same month, the Wellington Management Group opened a balanced fund, stocks and bonds, called the Wellington Fund. Same time, 1929. Now, of course, it has stocks in it, so it's more risky, right? Because stocks, over the past 94 years, lost money 25 years out of 94. So if you were in the stock market, you would have had to suffer through 25 losing years. Seems like you got more winning years, but you had some losing years. If you bought the Wellington Fund, though, you would have only lost money in 20 of those 94 years. So that's 74 years that you made money. You had a positive return. Now, of course, with the treasury notes, you would have never lost money. Never. However, your annual returns would be way different if you were in stocks, just stocks, the average annual return from over that period was almost 10%, which is a double every 7 years. Wonderful thing called the rule of 72s. You guys know the rule of 72s? You just take your return or you take 72 divided by your return, tells you the number of years it takes to double. That's how long it takes to double your money. If you were in stocks, you could double every 7 years. If you were in Wellington, you could double about every 9 years. That feels good. Every 9. With the bonds, it took you 18. Compounding, very, very powerful. Finally, then I'm done. You can be safe. A lot of people, I want to be in CDs. They're safe. You can be safe, but safety has a price, as I showed you with the bonds. Yeah, you can be safe, but you double every 18, twice as often, or less than half as often. Safety has a price. If you want to make more money, you have to take more risk. The good news is the risk we're talking about when you buy the whole market is absolutely, short of global conflagration, a 100% risk to your principal. You cannot lose all your money unless the world blows up. If the world blows up, do you care? If you care and you're a survivalist, I'm telling you, Costco just had the best deal on pallets of freeze-dried food. It was like 3 years worth for $2,500 or something. It's like, if you want to eat that crud, but I'm thinking, I got a new business opportunity. I want to talk to somebody about getting into this. I'm thinking, for survivalists, freeze-dried water. They don't weigh as much. And when you need it, you just fill them with water. And it rehydrates. Get it? Rehydrates. Great idea, huh? Pet rock. Risk can be mitigated by diversification. And by the way, please just have a plan. Just write some stuff down or meet with somebody. That's going to save you a whole lot of grief. And now, to help you learn how to create income in your retirement, the inimitable, the gambler, Kenny Rogers. Oh, no, Tom Cock.
Oh, the slings and arrows. You can see why I enjoy Saturday so much.
Was that facetious?
Take it any way you like. By the way, earlier this year, you stay right here for a minute.
Oh,
Earlier this
gosh,
year, we were, you may know 2024 is the year of the intentional word. Have you heard this? Everybody's supposed to have the word that is how you're going to be this year. And so I was at an all staff meeting and I asked the staff what they thought my word was.
Yeah.
And some young advisor, I think he's in the back, said, retirement.
That's your staff.
My intentional word is optimism, because that's how I feel. Do you know what Don's intentional word is for 2020? Anybody guess? What?
Oh, I just heard it.
No,
somebody say
that's his.
no.
No, that's his. So there you go. No. Any questions?
It's working great.
His life is so
Every
much
time my
better.
wife says, honey, would you? No, I can't. That's why he's saying no to you.
By the way,
I
in
got
your
it.
bag, thank you. That was a great presentation. It truly, and in the program is the written word that goes with his presentation. In the bag as well is a piece about a movie that I think you should all see. It's 88 minutes. It's free. You can watch it at home, and it's made by a guy named Earl Morris, who's an absolutely fantastic documentarian. And Dimensional Funds, thank you very much. Andrew's back here, and then you'll be hearing from Weston in a little bit. Put this together so you can all see it. And it's all the people that really that made a lot of the revolution that Don spoke about happen. I think it's a wonderful opportunity to see some of the people inside the industry. And as I said, it's 88 minutes. It's easy to watch. So take advantage of that. There's the link is there, and then you need to enter a code to do that. So I'm here to talk about the fun part, right? Spending the money in retirement. Maybe you've saved it. Hopefully you've set some aside. You've got somewhat of a plan figured out. But to me, and I hope to you, and I know to our clients, because the number one comment we get from them is they don't think about money anymore. It's not at the core of their life. Money to us should be like gasoline on a road trip, right? You don't want to run out of gas, but you're not doing a tour of gas stations. It's not central. It's there, it's important, but it isn't the thing that you need to be thinking about every single day. And so that's part of my chat today, is to put money in its place. Here's the agenda. I'm going to talk a little bit about the budget, the fun part. And where's my charming wife? She's here somewhere. She's afraid to raise her hand, probably. Okay. So please plug your ears when I talk about the budget a little bit. That one right there. Plug your ears when I talk about the spending plan here a little bit. You won't want to hear. Anyway, so I'm going to talk about that a little bit. I'm going to talk about sort of the fixed sources of income in retirement around Social Security, those kind of things. I'm going to talk about portfolio design. Many of you come to our office and say, I want to talk about mutual funds and ETFs. So we're going to say, no, you got to have a plan first before you even start thinking about how to invest. The number one call we get to our radio show is, I just came into this money. Where should I put it? How should I invest it? And we generally say, we don't know, because we don't know you. So we're going to talk a little bit about that. We'll talk about sort of how to draw that money down. Taxes, because they're a big part of all this. And by the way, our tax folks are here out in the hall today. So if you have any questions for them, they're happy to take those. And they told me, I hope this is right, by the way, Jim, that they guarantee a 20% reduction in what you have to pay the government. Is that? No, he's shaking his head. He's saying that's not true. I misunderstood. I apologize. I got confused, frankly, right after the casino thing, which my wife can verify. And then we'll talk about some of the mistakes I see as a practitioner. And by the way, one of the true joys of my life, I can't say this enough, is how many of you I get to know, how I get to be part of your lives. I've seen so many of you today. It's a joy. I love it. I love helping people. I love being part of all that. It's a great part of our business that we get to be involved that way. So let's first talk about how much of the money you're going to spend, because I find this an absolutely fascinating exercise when I meet with many of you, because you come in and you say, we make about $200,000. Here's my spreadsheet. We spend $70,000 a year. And I say, okay, so you're paying 20% in taxes. How much did you save last year? Oh, $25,000 or $30,000. So then there's this mystery $50,000 to $70,000 that you cannot account for. To me, the spending is the gross that you bring in minus taxes, minus whatever you're saving. Everything else you are spending. We need to get real about this. It's only 25% of us who actually have a budget. 6 out of 10 of us, even in retirement, live hand to mouth. We don't have a plan for all this. And we saw this recently, right, honey? We had everybody over for the Super Bowl. And of course, the oven didn't work and the freezer didn't work. Now, who needs ice in the middle of Northwest winter anyway? That was my take. But that didn't go over really well. But those two unexpected expenses added about $1,700 by the time they fixed the oven and the freezer. Those are actual expenses. And we're all in denial about this. Now, I know there's some of you, by the way, that are in denial the other direction, because we talked to you, you've been great savers. You have trouble sort of turning the spigot on. But you need to know the number. And you need to spend within your limits, because today credit card debt is somewhere around $1.3 trillion. So it's outrageous. And people are paying 20% on that. But in retirement, here are the kind of the general things we find. People at the beginning of retirement have all these things they really want to do, the trips they want to take, the spending they want to do. So you have kind of these go-go years. I'm out spending more money. So spending kind of goes up a little bit after retirement. In fact, many of you believe you're going to spend less in retirement. We run plans, and Jason will talk about this in a couple minutes. We actually run about 100% of your pre-retirement spending, because we want it to last for a long time anyway, right? So you have kind of these go-go years. Then you maybe slow down a little bit. Maybe it's like Paul. It takes, more than 30 seconds to walk all the way up here. He's not here. I can't get in trouble for that one. You don't move as quickly. You don't spend as much money, right? The spending kind of goes down a little bit. And then in your later years, you have perhaps what's called the no-go years, right? But you might be spending more on healthcare. So there's some variability to the spending here, right? But my biggest take and my biggest wish for all of you is, and this is true in our household as well, that you're honest really about how much you're actually spending, because we can't help you. We can't put together a plan until you are, because there's some of people we manage money for, and they tell us here's how much we want. And then they call us 3 or 4 times a year and say, we need another $30,000. We need another $40,000, et cetera. I'll tell you an interesting story. A couple of years ago, we went with a couple that were big, earners. Both had very big jobs, and I think they were making like $500,000 a year, which is great, good for them. And we put together a plan for them. And when they came in, they just wanted to talk about how we managed the money, the mutual funds we used, and the factors and the academics and how much they could make and this sort of thing. I kept trying to get them to go back to their plan because the plan showed them running out of money. It's hard to imagine, but here's why. Every year they took 3 to 4 vacations that were around $40,000 each. And they wanted to keep doing that. So we have this meeting, talking, and at the end of the meeting, the woman says, so what you're telling me is we'll be okay if we spend less money. I said, yes, and that was the last time we ever saw them. But it's the beginning point of any conversation, and some people, I get it, just don't want to hear that sort of thing. So, but once you've established that, then you need to look at sort of these fixed sources of income. In our world in the United States of America, about 65% of retirement income comes from Social Security. That's right. And most people are very cavalier about how they claim Social Security. Most people don't consider the others in their life. And most people don't use that 4-letter word that you should, that I can actually say here, which is wait. Because Social Security, on average, there's a little variance between 62 and your full retirement age, but over the period of time from 62 to age 70 gives you an 8% a year raise. And is there anything that Don promised that's going to pay you 8%? There is nothing that can promise that. And there's no annuity that will pay you 8%. They may claim it, but they won't. There isn't. That's the only thing available. But it's still about a quarter of Americans that wake up on their 62nd birthday and take Social Security. 1/4 of us, 25%, without thinking about the fact, and the numbers are in your handout, what the impact of that is. And we show you the actual numbers of somebody claiming Social Security. At age 62, they get a benefit that's worth about $16,000. At age 66, that goes up to $24,000. And then at age 70, it's $31,000. And that's what you get the rest of your life. Well, yeah, they add a little bit in for COLA, which may or may not keep up with inflation. I don't think it has lately. But people don't give Social Security the attention it deserves. By the way, I'm going to not give it the attention it deserves today because I don't have that much time. But there are tons of books written about this. When we work with people, this is at the core of what we do. We are a planning-centric firm, and Social Security is right there. I'll give you an example in my life why it makes sense for me to wait until age 70. My beautiful wife is a few years younger than me. I've been lucky enough to be a bigger earner over time. I'm going to wait till 70. Then when she can claim hers, she'll claim half of my benefit. So now it'll be my benefit plus half of my benefit. And then if the tables work correctly, as they should, I will die first. She will inherit my benefit. So it will make a ton of sense. And I won't use the boyfriend joke here. I promised you I wouldn't do it. For me to wait. We have a tendency to live longer than we believe we will. We have a tendency to spend more money than we think we will, right? And so you need to wait. For most plans, it looks better to do that. And by the way, there are cases. I just talked to someone in the hall this morning who had all the numbers figured out for Social Security, and then they realized, wait, I've got to pay myself in retirement from somewhere because I'm not going to take it from Social Security. Yeah, that means you're going to have to take it out of your qualified money, your taxable money somewhere. And the question always becomes, how do I know this strategy will work? And the answer is we don't, because you call me in 10 or 12 years when you have to live that long for the strategy to work out, right? Now, in my life, it'll probably work anyway, because if I pass away earlier, my wife will still claim that larger benefit. She can take her own benefit or my benefit after I am gone. But Social Security should get a lot of time, a lot of attention. And there's a couple things you should do, everyone should do. One is, if you have not gone online to ssa.gov and signed in, you absolutely 100% should do that for a couple reasons. Number one, to make sure that your employer is putting the money in your money, your contributions. By the way, Jim will talk about this after my talk today. I want to make sure that money gets in there, right? You got to make sure that that's there, right? And there's been cases where people have not logged in, where there's been people who have defrauded their account, who've gotten in with their Social Security number and are drawing the money somewhere else. So you've got to do that. And here's the other part. Please, and this is not a sales pitch, but it really is important. before you claim, you should at least run your overall plan and your claiming strategy by a professional. It should be a fee only, 100% fiduciary. It doesn't have to be us. We'd like it to be us, but it doesn't have to be. But you need to make sure, because it's so vitally important to your overall plan. Social Security deserves more attention. Pensions. It's about 10% of us now getting pensions. I think it's great, the ones who are. And there's usually a couple of questions around this. Number one, sort of when to claim it, although now private pensions after age 60, there's not a lot of benefit to waiting. But the bigger one, frankly, is, do I take a lump sum? Do I get the payout from the company? Or do I instead get an annuity payout? And much of this turns out to be psychological. Many of you would be better off, even though financially it's going to be better to take the lump sum, invest it, pay yourself out of that, and have control of the money. But many of you emotionally would be better just getting the payout every month. I've met with you. And there's a temptation in our industry, right, to say, no, get the lump sum, let us invest it for you, because it's selfish. We want to manage that money and make a living doing it. But the point is, if you can't take the market ups and downs, if you don't want to deal with the volatility that is involved in investing, then you take the annuity payout. And by the way, here's the downside of the annuity payout. The money is not yours, it's theirs, right? The money doesn't grow. So after about 20 years, it buys about half as much as it would, correct? So it's to most people's advantage to take the lump sum and instead of taking the annuity payout, but it should be looked at. Then there's this other aspect. This came up in our lives recently, part-time work. And you're saying, wait, I'm retired. Well, there's a couple of advantages to part-time work. Number one, for those who want to retire prior to 65, it can supply health care, right? Which can be very expensive if you have to go buy it. That's one. It can supply purpose, which Rebecca will talk about this afternoon. Getting up in the morning and having someone else relying on you is a very important thing I've found. And I saw it in my life with my father, where it did not work out well, but when he retired, he was bored, he didn't enjoy it. But the other part of all this is, frankly, the income. Having a part-time job can supply some of your income before you have to take Social Security, for example. I mentioned in my life, we've seen this recently with my brother, who was a college professor, and he got retired a little earlier than he wanted. And then he started looking at the money. It wasn't time to take Social Security. He'd saved some money. He didn't want to draw on that. So he found a couple of part-time jobs, one in his field, that he's doing now for the next couple of years to supplement his income before he starts drawing on the other places. I think it's worthy of looking into, especially for the healthcare. And then home equity. There's about $30 trillion in home equity in the United States of America today. $30 million. A lot of money, right? That you may need to access. This is another reason that we generally tell people it doesn't make sense to pay down your mortgage, especially if it's less than 3 or 4%, because now you have all this money tied up in your house that's hard to get to. And there's only a few ways to get at that. You could certainly do a HELOC, which you can do, a home equity line of credit, which you can do easier while you're working because you have that income, but there's still ways to do it after you quit working, because you can show you draw money from your portfolio, right? So that's one. And then there's the always dreaded, always bad-mouthed reverse mortgage, which have been really off the radar for a number of years and kind of come back because the costs are a little bit low. The bad news is they've skinnied down how much equity you can take out of your home. But for some people that are house rich and cash poor, it makes sense. And by the way, if I was in that situation, potentially, I would look into it sooner rather than later. So those are ways you can look into it. Okay, so we've talked about your budget a little bit. We talked about your fixed sources of income. How about the money that you save? Because you came here today wanting to talk about how I put my portfolio together, how I live off of that money, and that's what many of you want to know when you reach out to us. And the first part of all of this is, we already discussed this, how much income you need, but the other part for anyone who wants to invest at all. And I don't care how old you are, because you may feel differently at 30 than you do at 60, but you still may be conservative or be willing to take more risk. I ran into a woman this morning who had a 93 on her risk quiz, which is amazing. It's a very high score. Very few people score in the 90s. And by the way, the risk quiz is free up on our website. You can take that anywhere, anytime. You need to know your risk tolerance, because what happens, right? We either get into 2008 where the market goes off by 50%, or we get the spring of 2020 when people were calling me. I actually had a client call and cry because their portfolio had gone down by so much. You need to know that about yourself before it happens, because when it goes down and then you take the money out, that's a real loss, correct? So you need to know the risk tolerance. And then you need to know, and any plan should help you understand this, what rate of return do you need on your money? Because if you don't have to drive 90 miles an hour to fulfill your retirement, maybe it's more comfortable driving 60. You don't have to have pegged all the way over, right? So you need to know that rate of return. And then, as Don mentioned, we truly believe, and we think the numbers back up unequivocally, that you should invest in a globally diversified portfolio. What does that look like? Well, here's what it looks like. It's up on the screen. It's about 60% of your money in the United States, because the United States is about 60% of market cap value today. It's about 40% outside, between developing countries and those countries that you just feel nervous about, the emerging markets, right? Brazil, India, China, used to be Russia. So they got blacklisted a couple of years ago. So you're globally diversified. And by the way, Don mentioned Japan. Japan, if you know, the Nikkei just hit its new record high for the first time since 1989. That is a long time to make money. And for those of us old enough can remember, in the late 80s, it was all about Japan. It was about their manufacturing. The Japanese were buying up property. They bought Pebble Beach. They were here telling us how to run our companies. And if you just invested in Japan, as about 9 out of 10 people in Japan did, then you have this 35-year period where you made no money. And I'm not saying that's going to happen in the United States, but frankly, we don't know anything more about the way the market opens on Monday than you do, right? So I'm globally diversified. I'd rather spread my money around, and that's worked for a very long period of time. So that's the global diversification. But you each need to know, in every one of your households, how much you're going to have in the riskier things like stocks, how much in the less risky things like bonds. Asset allocation. So before you call me and say, hey, I was thinking about doing XYZ, because I'm going to say, how does this fit in your plan? Is this a stock fund? Is this a bond fund? How does this fit overall? Everybody needs to know that first. Then you're going to balance, as I said, 60% US, 40% international. And then inside of that, you're going to have some big companies. You're going to have some small companies. You're going to have growth companies, value companies. You're really going to spread that money out into almost 13,000 securities. And Weston will talk a little bit more about this here later this afternoon. So how do we create income off of that? Because that's another question we get a lot. You have this portfolio, right? 60%, let's just say for argument, in stocks, 40% in bonds. And the market does its thing during the year. At the end of the year, you say, I need money. So you're going to sell the things that went up, and you're going to take some of that, put it in your pocket, and buy the things that went down and rebalance your portfolio. A total return strategy, rather than those of you who want to turn dividends on, who want to turn interest on. This total return strategy has been more sustainable. It's been a better way to do this for a very long period of time. So that's what we recommend in terms of retirement income. And then this whole aspect of guarantee. I can't guarantee anything, but apparently the insurance industry can, because they guaranteed last year a lot, because they sold $360 billion worth of annuities. And why do we hate annuities? Let me give you a story just from last week, where the aunt of a client went in. She's 80 years old. She had $50,000. She went to her bank because she trusts the bank. And she told them, I need to put this in something. It's short term. How about a CD? Can I buy a 2-year CD? And the nice man sitting at the desk at the front of the bank said, we don't sell CDs anymore, ma'am. We only sell annuities, which is an outrageous thing to say, and sold her into annuity. Thankfully, she's getting out of it. But she didn't need an annuity. By the way, it had an 8-year surrender on it, so she wouldn't have gotten her money back anytime without paying a huge penalty. Why do I hate annuities? Because of surrenders. Why do I hate annuities? Because of fees. Why do I hate annuities? Because of the commissions. Do you think the person sitting in the front of the lobby was incentivized to sell a CD or sell the annuity? Pretty easy. You're going to sell the annuity, right? So we see this every day. There's only one type of annuity I think is a reasonable thing to do, and that would be an immediate annuity. If you had a budget or cash flow, you could give money to an insurance company. I just looked it up for a single life, $300,000 immediate annuity, where you give them the money, they start paying you back at 60 years old. A single life, you're going to get about $22,000 a year back from that. By the way, that's up substantially from a couple of years ago when it was only $19,000. So that might be one way to kind of have a budget. That might be one way to have a regular source of income that you don't have to think about, which is what many of you want. I get that. I just want to see the money paid to me all the time, but I'm not a fan of annuities. We had another gentleman who came to see us a few years ago who had purchased an annuity, was very happy with it, was doing fine, but then he had a health issue and he needed that money. And he had 7-year surrender he had to pay because the commission had gone to the salesperson. Not only paid that, then he paid a huge tax bill on top of it. So in a general sense, we don't think annuities are going to make sense for you. And Don would use stronger language than that than I would. I can tell you that much. For those of you who listen to the program, you know that. So, okay, but let's talk about some actual withdrawal strategies, right? Here are my last few minutes. There is no right withdrawal strategy, except to tell you that Mr. Ramsey, who says you can take out 8% a year out of your portfolio, is wrong. He is not a practitioner. He is a broadcaster, which I admire because I'm a broadcaster, but he can say anything he likes. He's protected by the First Amendment. Same with Susie Orman, who I've known because I interviewed her on TV. She doesn't manage your money, right? She can get up every morning and say, here's what we think you should do. But I can tell you here are real numbers. And thank you, Paul Merriman from the Merriman Education Financial Foundation. And by the way, it's completely supported by your donation. So Paul does all this work with the few people that help him. But these are his numbers. This is a 4% withdrawal strategy that you hear about that's been killed more times than Rasputin the last couple of years, right? It's dead. It's not going to stab it. No, it's still dead. You shoot it. No, it's still dead. But it still works. Or has worked for this whole 52-year period, right? A long time for the money to survive. But what you're doing here is you're taking out 4% fixed a year and you're raising that every year. That's the column that says distribution because things are more expensive. And you can see you get a regular payout for those 52 years, which would be a very long retirement. The first column, by the way, is a very conservative portfolio, 40% in stock, 60% in bonds. The next one is kind of a moderate 60-40. I know it says it upside down there. But the idea is to show you that while you're taking the money out, the portfolio still grows. One of the biggest mistakes I see you all making is you're not properly invested all the time. You feel like, well, here's what's going to change. I need to invest this way. And that is market timing. That is a fool's errand. But it works here. And by the way, you see at the end of your life, in 2022, you end up with $52 million. That sounds like a lot of money for your kids, grandkids, and charities. I did this presentation a few years ago, and a guy stood up and said, no, Tom, you've got this all wrong. I want the last check I write to bounce. By the way, honey, I've already written it, so just so you know. Or that's for fixed, or you can take a variable withdrawal, how much you make. You have a good year, you take everybody to Canlis for a holiday dinner. You have a bad year, you go right around the corner to Burger Master. You got to live with the variation, but look at the differences here. You end up taking out a lot more money, so because the market goes up for the most part. So your distributions, you can see the last distribution, $640,000. Last distribution on the other page was about $290,000. So you're taking out a lot more and you end up with giving away less. Again, these are personal decisions. I happen to like the 5 variable. My own personal plan, my plan with Danielle is to try to make Social Security, our Social Security's paid the day-to-day bills, and then have the other money be withdrawn this way in a variable method. So we have a great year, we do more things. We have a not so great year, we do less, but that's a very personal decision for each person. Couple of things around tax planning. I mentioned our tax folks are here today, and no, Jim just told me, no, they can't guarantee the 20%, which I do apologize for. But a couple of things I think you should pay attention to. I think you should have 3 buckets, if you will, of money. One is qualified money, right? Like IRAs, 401ks. One is Roth, which I think is underrated. And one is a taxable brokerage kind. Why? Well, we just had somebody call the show recently. They wanted to take $150,000 out of their portfolio. He was going to take it all out of his IRA. And I said, well, do you have any other holdings? Oh, yeah, I have this brokerage account. I have this Roth. We actually figured out that it made more sense from a tax standpoint to take out some of each one, to game it a bit, rather than just saying I'm pulling it all out of my individual retirement account. You need to know your current tax rate and what impact that could have on the withdrawals. You've got to have exposure, as I said, to the regular aspect of a portfolio, stocks and bonds. And here's another one to consider. I just met with a great couple, been terrific savers this week. and they're going to retire early, they're going to be absolutely fantastic candidates for a thing called Roth conversions, moving money from pre-tax accounts to post-tax accounts, moving it over, paying the tax, and then it grows tax-free for a very long period of time. They're great candidates for that. But tax planning is underrated and should get more attention. Secure Act 2.0, which was passed a couple of years ago, gave you some great advantages. If you're not already taking your money out of IRAs, et cetera, your required minimum distributions do not start until age 73. For those of you born after 1960, you get all the way till age 75. They also did something I think is a wonderful gift that you could do for your kids, grandkids. If you have been savers for them for college in a 529 plan, they are now allowing you to take money out of that 529 and moving it into their Roth IRA. There's terms and conditions, of course, up to $35,000. So think of the advantage for a young person once they're really getting going with their life to have $35,000 in tax-free money that will grow for decades. I think it's absolutely fantastic. Long-term care, we really don't have time to get into, but I can talk to you off camera about this. But let me mention one other thing, because this comes up a lot. Many of you have sort of questions that you don't feel like you get answered well. And I'll give you a couple of them. Number one, how do I invest today? Well, how you invest today is the three things I mentioned. How soon do you need the money? How much money you need to draw? How much volatility you can accept? That's how you invest today. Do not ask any of us what's going to happen tomorrow, because we don't know that. So you need to be invested properly every single day. You need to have a plan. You need to consider how much volatility you can accept. And you need to avoid a lot of those things. And then the other one is, frankly, most of us, I have an advisor, Paul has an advisor, need professional help. Why? Well, for one thing, just to look things over and say, did you think about this? This just happened when Danielle and I met with our advisor last week. They said, wait, you forgot about X. That's very important for one thing. Coming up with the withdrawal strategy is another one that's absolutely key. And the good news is today, this is in your bag as well. We offer the Retire Meeting. You can get that absolutely free. And as I mentioned before, you get a look at your overall retirement plan. We take a deep look into your portfolio to see how diversified you are, how much you're paying others, all those kind of things. And then you actually get time with an advisor that'll answer all your questions for you. So I got to get the heck out of here because I've already gone over my time. I want to mention a couple of things again. Around the corner, we're going to have another session here at 10:30, a breakout talking about how we work with clients. You're invited to come over to that if you'd like. But right now, it is my absolute pleasure to introduce the next speaker, he's the director of planning for our organization. We have about 15 offices across the country now. We're up and down the West Coast. We're in Portland. We're in Olympia. We're in Southern California, et cetera, in San Francisco. But our job is to put together the plan and make you stay on the plan. Because many times you wake up and say, this is never going to work. Look what's going on with the market. Or I'm running out of money. And we're going to try to keep you in the right place. And the next speaker is the director of that planning for Apella Wealth. He's also, so he gets the baseball suffering thing. He's a Red Sox fan. So you Mariners fan, you can kibitz a little bit with him. Jason Gentile, thank you very much.
Thank you, sir.
You bet.
Appreciate it. You can hear me okay? Yeah, it's I always say it's like following Tom and Don is like following the Beatles if John Lennon made fun of the Red Sox every time he saw me. So I'm a financial planner by trade. I've done 1,000+ financial plans over the course of my career. And I still find that a lot of people have questions about what a financial plan actually is, right? It's a roadmap from where you are today to where you want to be. It looks at a lot of different aspects of your financial life, right? It's a net worth statement. It's cash flow. It's accumulation planning. It's decumulation planning. It's taxes. It's insurance. It's estate planning. It's every aspect of your financial life, right? A financial plan with a planner is the idea that you never have to make a financial decision alone. And you know, inside your bags and on the Retiremeet website, if you're not here in person, is a checklist, which I would encourage you to take a look at and just start going through those things of different areas that you might need help with. Because, you know, honestly, there's quite a bit that happens inside of our lives every day. And it's one of those things that get pushed off and pushed off and pushed off. But I encourage you to sit down and do a financial plan, talk to somebody, get help, work through it. Over the course of doing, hundreds and thousands of plans over the last 20 plus years, I always ask at the end of the engagement, what'd you get out of this? Right? How do you feel now? Right? And the idea of confidence and clarity come up a lot. The opening up of different opportunities that they didn't know were possible, gaining confidence, but more importantly than anything else, understanding that they're going to be okay, right? That's the real purpose of a financial plan, knowing you're going to be okay. For a long time, and Tom and Don hinted at this too, investments were thought of as the plan, right? Investments are a tool. They're a piece of the plan. They're a vehicle utilized inside of a financial plan, but they're not the plan. We have no control over what happens in the stock market. We don't know what's going to happen tomorrow or the next day or the next day. So we need to focus more on the things that we can control and less on those things that we can't, like stock market returns. So we're going to have a few quick hitters here, and then we'll spend a little time digging deeper into some of these other retirement risks. But risk number 10 is the most easily avoided of all the financial planning risks out there. And I can't tell you over the past 20 plus years how many times a friend or a client has referred somebody to me that has just lost their spouse and has no idea where any of the money is, has no idea how they're invested, has no idea how they're going to pay the bills. It's pure panic at the time they just lost their best friend, their soulmate, their life partner. And I will say that in every relationship, there's one person who tends to grab the reins because they understand it better, they're passionate about it, they want to do it. And there's somebody else who generally defers to that person. But we won't do a financial plan if both spouses or partners aren't in the initial consultation, if they're not in that data gathering process together, if they're not in the actual plan presentation together. Right? We want everybody to have access to all the information and to have the confidence to go like, okay, I've got this. I know where everything is. I know I'm going to be okay. If you are the person who defers to your significant other, they'll take care of it. I can guarantee at some point in your life, you will be filled with the regret that you didn't participate in this process. And if you are the spouse or partner that keeps the other person at arm's length, because maybe you don't want to explain it to them, right? It's easy for you. You think it'll be too much time. You don't want to restart the process. You are doing them an incredible disservice. Tom mentioned in passing long-term care. This is a topic we talk about with 100% of people. Doesn't mean we tell everybody that they actually need long-term care. Long-term care policies are extraordinarily expensive. We can see that in the massive drop of policies sold over the past 20 years. Right, 750,000 policies sold in 2002, down to 75,000 policies last year. Really, really expensive. And when you start to look at the statistics about long-term care, it's true about 70% of people will have some need for a long-term care service. But that doesn't mean it's 2 years, 5 years in a long-term care facility. It might mean just a quick rehab for hip surgery or something like that. So some of these numbers are meant to scare you and frighten you, but I assure you they're not as terrifying as maybe a lot of you are led to believe. About 48% of people will actually need some type of paid long-term care service in their life, right? And about 24% of those people will have a duration of more than 2 years. You drill down a little bit further, though, into these statistics, about 13% of people, roughly, give or take, will have catastrophic costs, north of $150,000 over the course of their lifetime. So the idea that you will have catastrophic long-term care costs, it's pretty low, but it doesn't mean it's not possible. We tend to see this more in the areas of dementia, right? About 11% of men end up with some form of dementia. It's twice that in women. So when we do a financial plan for folks, we absolutely 100% of the time will stress test the longevity of your assets should one or both people suffer some type of long-term catastrophic event, need care for some period of time. So I would encourage you to not just say, no, I'm not even going to consider it because I know it's super expensive, right? Over the past 2 years, we've had lots of policyholders come to us and say, I just got this letter in the mail from Genworth. our premiums are going up 40%, 50%, 60%. That's terrifying, right? And it's terrifying to actually think about having to drop it right about the time that you're going to need it. Stress test your portfolio against one of these. Everybody doesn't need it, but everybody at least needs to consider it. Bad assumptions. I'm not calling out anybody in this room, but over the past 4 or 5 retire meets, I've met people who go, my situation's super simple. I don't need a plan, super simple. I just need $40,000 a year. I just need to earn 6%. Super simple. I don't need anything else. But when we're not tracking expenses, when we're not tracking where our money's going, what happens is all of a sudden that first year, I've got $1 million portfolio, I'm going to take $40,000 out of it. Then all of a sudden the stock market goes down 10%, inflation goes up, right? So now I need $45,000 out of an $850,000 portfolio. All of a sudden my distribution rate goes from 4% to 5%, right? The next year my kid's getting married or I need a new roof, I need $30,000 out of the portfolio. By year 2, that portfolio is down to $800,000. 4% is tough to live on, right? I'm not going to have my assets for the longevity of my financial plan. So the idea of this cocktail napkin math, my situation's super easy. Throw away the cocktail napkin math, sit down with somebody. If you don't need if you don't feel you need a financial plan, once again, I'll refer you back to the checklist. If you check off 1 or 2 or 3 of those things on that list, you absolutely 1000% need a financial plan. But you need somebody to absolutely monitor and watch your cash flow, your distribution strategies, and make sure that you're staying on track to not outlive your money. This one's less happening, frequent today, right? This old adage where you take 100 minus your age, and that's the equity percentage you should have in a portfolio. That actually 20 years ago was how it was done, right? We have this natural tendency to become more risk averse as we age. Makes perfect sense, right? We want to make sure that we don't outlive our money. We want to protect principal. We feel like we need income, so we're going to invest much more conservatively. But really, the idea of how you should be invested is time horizon, goals, risk capacity. How much risk can you take based on your financial assets? What are your goals? What are the timing of those goals? And how does risk tolerance, right? Tom mentioned the risk score and the risk quiz. Take that. How does that all gel together? Because I know plenty of people who have very, very high levels of risk capacity, the ability to take risk, but very low risk tolerance, right? And there has to be some type of balance there. I will say that age is, maybe plays a small factor in that, but I have clients who are in their mid-80s who are 100% equity investors. They have enough from their pensions and social securities where they don't really need the portfolio, right? So they think of it as next generation. They're investing for their kids, for their grandkids. So don't let age be the single determinant of how you're investing. We went through this long period of being lulled to thinking inflation doesn't actually happen, right? And then all of a sudden it did, right? But there was this 40-year gap between big swings in inflation. And we forget how impactful that can be. It impacts our savings rate, our ability to spend, or an ability to do things that we want to do, because now the cost of kind of our basic essentials have gone up so heavily. So when we're doing financial planning and cash flow, we want to stress test different levels of inflation on people's portfolios and on people's expenditures. Everybody in this room spends similarly, I would think, right? Your essentials, housing, travel, but not identically, right? Inflation impacts people very individually, right? It's not we're all not swept up into the same bucket because we all spend a little bit differently. So, we saw 7, 8, 9% inflation, much higher on certain things, right? Remember how much eggs went up? All of a sudden, now it's starting to come back down. And I have this feeling that we'll get lulled back into this sense of security of like, inflation's not that big of a deal. Because now it's finally back down. End of last year, 3.4%. The Fed targets about 2%. The long-term average is about 3%. But, I would caution you to just say, hey, I need $40,000 out of my portfolio. That's it. Because these spikes in inflation over a period of time lead you to take a bigger and bigger chunk out of your investments. And if we're naturally becoming more conservative in our portfolios, but taking out more money, That's a recipe for disaster over time. Long-term care, I just threw this one in there because I found it interesting. It was the first time in a really long time that we saw healthcare inflation go down. Historically, it's been about 5%, and last year it was actually sub 4%. I don't know if that's a meaningful trend. 1 year doesn't make a trend, but let's kind of hope it starts to stabilize and come down. So we're going to dig a little bit deeper into some of these other ones now, right? And longevity. Don talked a lot about some of the things I'm going to talk about right now. He stole my thunder. So let's kind of look at this world map, right? And the top part of this world map is life expectancy in the 1800s. If you were alive in the 1800s, you knew you were dead by age 39. There's no shot you were making it to 40, no matter where you lived on planet Earth, right? You were just dead. If you lived to 40 or 41, it was some type of voodoo or black magic. They were probably going to burn you at the stake anyway. By 1950, we saw life expectancy spike up pretty considerably, right? Into the late 60s. And now it's even much higher, right? Life expectancy is 79 years old and continuing to increase. The expectation is by 2090, that life expectancy will be 90. I'll draw your attention to the 95 part of this chart. And, you know, if you're a female, just general health, just the average female, there is a 14% chance that you live to age 95. If you are a healthy, non-smoking female, there's actually a 31% chance you live to 95. The news isn't as good for men, but 8% that you live to 95. But if you're a healthy, non-smoking man, 22% chance you live to age 95. If you are a married couple, healthy non-smokers, there's basically a coin flip that one of you is going to live to 95. We stress test all of our portfolios to age 95 or 100 because there is a growing possibility that you will live that long. Yet I have never met anybody who tells me they're going to live to 100 years old, right? But think, you know, most people come in and say, well, my grandfather died at 58, my dad died at 71. There's no chance I make it that far. I got bad news for you. There really is. So just and kind of the other side of that coin is just because you're living longer doesn't mean you're living better. This has actually forced changes in the labor rate, and Don was talking about this as well. You know, if you go back to the 1930s, 1940s, like people who were 65 years old, that was 60, 70% of the labor force. And now we're starting to see this big silver tsunami, right? All the baby boomers getting into the retirement phase of their lives. Look at this chart. In 2001, there were about 34 million people in America 65 years or older. Today, it's closer to 58 million. And by 2031, it's about 72 million. And the expectation is about 30% of the population is going to still be in the workforce at age 65. That's a lot of people. That's impactful to the economy, to the younger people who are trying to get jobs, to employers. So it becomes a very different work environment on a go-forward basis. Now, a lot of people just love it, right? They know they're going to live longer, right? Retirement doesn't have to be age 65. They like their job. It's fun for them. It's energizing. It's part of their routine. There's a social aspect to it. They're passionate about it. But on the other side of that coin, there's people who have to do it. Maybe they didn't save enough. I don't know if you know this, college is really expensive. So all these people who wanted to retire but put their kids through school, that was a choice between saving for retirement and saving for their kids' college education so they didn't come out of into the world riddled with debt. So there's a lot of reasons that the labor force is changing, but probably the biggest one is we collectively are terrible savers, right? The rule of thumb has always historically been save 15% of your gross income, sock that away for retirement. The long-term average that we as Americans have done is 7.8%. The only time we've actually hit the target collectively as a country is when we were not allowed to leave the house. 2 years after that, the world was opened back up. We could go wherever we wanted, and prices spiked everywhere, right? Runaway inflation, savings rate plummeted to an all-time low of 3%. So we have a lot of catching up to do generically, right? So there's a lot of reasons people are staying in the workforce a lot longer today. Tom talked a lot about this, right? We do a terrible job of knowing where we spend. The word budget makes people gag. They hate it. So we talk about it as cash flow management, right? We want to know where your money's going from a cash flow. It's a cooler word, cash flow. It's cool. At least I think it's cool. We know where the money's coming in from, Social Security, pensions. Easy to track where money comes in, much, much harder to track where money's going out. The big one that we know is Social Security, right? But the idea of Social Security replacing a lot of your pre-retirement income, it's crazy. If I draw your eye to the kind of middle of that chart, the bottom there, $100,000. If I made $100,000 in pre-retirement income, Social Security replaces just about 44% of that, meaning that I need about $42,000 out of my investments. I need to generate $42,000 of cash flow just to maintain my lifestyle. And maintaining lifestyle is the #1 financial planning goal that everybody tells me. I don't want to do less in retirement. I want to at least maintain my lifestyle. So the idea that Social Security is going to replace this massive chunk, it actually replaces less and less the more money you have, right? And that's really how Social Security was designed. So if I need $42,000 a year out of my portfolio just to kind of maintain, well, I probably need to have at least $1.2, $1.3 million as just kind of a base number to be able to retire on, right? If I think of the 4% rule as gospel. We also see these trends, and Tom talked about the go-go years and the slow-go years and the no-go years. This is pretty consistent across retirees. When they get into the initial phase of retirement, there's a lot of travel, a lot of things they weren't able to do. They want to ramp up the fun stuff, eating out, going, traveling, etc. It slows down, and then naturally, the healthcare costs kick back in, and spending starts to pick back up. So, it's pretty interesting, but when we do a cash flow analysis for somebody, we do it based on how you live, right? Tell us where every single dollar you spend today is, and we'll start to really do that analysis. When do your liabilities fall off? How does income change over time? How does inflation or cost of living adjustments impact that? Does certain insurance plans, do they go away? How does your healthcare costs, how are your healthcare costs impacted, right? If I retire early, do I have to go get private medical insurance? What's that look like? What is Medicare going to cost? If we're thinking it's about $5,000, $6,000 a person today, if somebody's claiming Medicare in 10 years, it might be $9,500, right? So we're mapping this out for everybody. And then we're saying, okay, at what point do we get into this danger zone of taking out more than 3.5%, 4% of our portfolio? Every time somebody asks for money, right? I need $10,000 to buy a car or to do this or that. That is not something we just kind of take it from that account. No, there's a big analysis that happens to find the most tax efficient way to do this distribution and to make sure that you have secure cash flow throughout your entire retirement. Risk number 3 is we are just not built for this. Like we are just, the fight or flight mentality is off the charts. Like whenever we see the stock market turn red or turn on CNBC, panic sets in, right? The deep breathing exercises need to kick in, right? So I'll give you a little bit of a pass, right? The first form of currency actually goes back to 600 BC, right? King of Ladies, Lydia. And so currency has been around for a long time, but the idea of retirement is really, really new. Right? Retirement didn't really become a thing until the 1970s, 1980s. The idea that we could have like a real, relaxing, comfortable, enjoyable retirement. I looked at how much money was in 401ks. The most recent data I found was 2018, about $27 trillion. The 401k had only been around for 2 generations at that point, right? So we built up this system with people who did not know how to use this system. We didn't educate people on this system, and now they don't know how to get the money out of the damn system, right? So this is not like something we have taught in schools. The Roth IRA, that's pretty darn new, right? Index funds have only been around for about 50 years. The CFP designation, right? Financial planning as a profession and a science has only been around a couple years longer than I have. It's insane, right? So This is relatively new to us. So you do get a little bit of a pass because there's not a lot of data to go on. So this roller coaster of emotion that we go on is natural because there's not a lot of history to say we are going to be okay. And when you were born, that matters a lot too. Like, it matters a lot, right? If you were born in the 1950s, your formidable years, 13 to kind of your mid-20s, are where your brain says, okay, this is how the stock market and the economy works. Right? So if you were born in the 1970s, and you were 13 in the 1970s, stock market was pretty good for those formidable years. Less so if you were born in the 1950s. So when you were born matters a lot. How your family thought about money, how your parents spent, their reactions to money. So as we make these decisions to get in, to get out, we panic at the worst possible moment. You guys have seen this before, right? It impacts the return that we get by making bad decisions at the worst possible time. Bad news, I don't know if you know this, there's an election happening this year. And it turns out that you guys are going to get pretty nervous about that, right? But here's the good news. The stock market goes up whether it's Republican or Democrat, right? That is not the sole influence of what the economy or the stock market is going to do. 51% of days are up in the stock market, like 68% of months and 75% of years, right? So play the odds, right? Stay invested, stay committed to your investment philosophy. And don't underestimate compounding. You know, I will say that the guy on the left there, Warren Buffett, his famous quote was, "It takes a long time to become an overnight success." 22% annualized returns, but 95% of his net worth is attributable to him after the age of 65. Right? If he retired at age 60, he would have retired with about $13 million. Still a pretty comfortable, great life. The guy to his right, Jim Simons, Renaissance Technology, his average over the past 15 or 20 years is closer to 66%. If he gets the longevity of Mr. Buffett, we're talking about quintillions of dollars, right? So compounding works over time. Sequence of returns risk. We run Monte Carlo simulations. We take your financial plan and we say, okay, we know exactly how you're gonna live. We know where your money's going. And we're gonna randomize 1,000 different trials of the stock market. We're gonna see how many times are you successful. This is a pretty simple example of $1 million portfolio with $40,000 distributions growing at 2%, invested in the year 2000, just in the S&P 500. This person started with $1 million, took out the $40,000 plus 2%, and by the end of that 20-year time period, his portfolio was worth about $550,000. No other circumstances changes. We just invert the returns from first year to last year, just flip the returns. Same exact sequence, same exact situation. All of a sudden, that person now has $2 million, right? So it matters. So when we randomize and we do 1,000 different trials of different stock market outcomes, we can narrow it down to the worst possible trial. If you're a real negative person, we can narrow it down to that worst one and show you how you're going to be. So we want to make sure that we understand risk capacity, that we have all, a fully stress-tested, holistic financial plan. But we want to make sure that we've done that and that you know that no matter what, when it hits the fan, you're going to be okay. Taxes. So, I've got only a few minutes to rush through this one, so keep up. The nature of how we invest is just tax efficient, right? ETFs, index style investing, just naturally tax efficient. If you look at the Vanguard study, Advisor Alpha, advisors and financial plans add about 3% to your total return over time. And a lot of that is attributable to good tax management inside of a portfolio, right? So how are we asset locating, right? Are we sheltering bonds inside of IRAs to help tamp down future required minimum distributions, sheltering income, putting growthier things in things like Roths and taxable accounts? Are we taking advantage of tax loss harvesting? When we do year-end planning, are we looking at Roth conversion opportunities, maybe even gain harvesting opportunities? There's a lot that goes on in a financial plan at the end of the year. Certainly gifting and QCDs and all that fun stuff, and clean, tax-efficient estate transfer to the next generation. Here's just a quick example of how something pretty simple can impact your life. Han really wants a new set of golf clubs, so he's going to sell some stock, and it's going to generate $1,000 capital gain. He's in they're in the $322,000 modified adjusted gross income. But what happens? It's a cliff, right? There's an IRMA cliff. So that they're not thinking of it from a tax perspective completely. And all of a sudden their Part B premiums jump up, their Part D premiums jump up. And realistically, now it becomes a $3,200 tax bill because they did not factor that in. And for $3,200, that driver better hit it right down the middle of the fairway every single time. I would actually spend that much money if I could guarantee me center cut. If we go a little bit further in this, and I'll make this quick, a little bit further into the case, they want to retire at age 65. They make $150,000. They got $500,000 in a taxable account, $500,000 in an IRA. We did a full cash flow analysis for them. The yellow highlights blocked out the numbers, but these were important years for them. So we can jump to any single year, the first year, find out where all of their cash flow is going to be. Identify if they're going to be cash flow negative. They're going to be this year, $66,000 cash flow negative. By the time they jump to their first required minimum distribution year, they're about $13,000 cash flow positive. So we look at things like Roth conversions. We map out every single calendar year and what their tax bill is and tax burden is going to be, right? So this is to the dollar good estimate of where they're going to be in paying Uncle Sam and their state. When we do the Roth conversion, we just did a very simple example of $75,000 for 2 years just to show you what a Roth conversion could do. The red is the increased taxes, and the gray over the rest of those years are decreased taxes, right? So they save about $141,000 in their plan. Their portfolio value increases by almost $200,000. So things like Roth conversions, asset location, putting money inside of or sheltering bonds inside of IRAs, extraordinarily important, right? If we were going to invest their IRA as a 50-50, 50% stock, 50% bond, versus just putting all the bonds inside of the IRA and all the stock inside of the taxable account, the delta between the blue and that orange is how much the account is worth, right? There's a lot more stock in there, so the blue is the 50-50 strategy. But the more important thing is the impact to the required minimum distribution. The blue is that 50-50 strategy in an IRA and the increased required minimum distribution over time. It's $977,000 more in required minimum distributions over the course of your lifetime versus using an asset located strategy, right? So there's massive tax impacts to just where you put your money. So I know that was a lot in a little bit of time. Go see Derek and Joyce in some of these side sessions. If you are here in person, reach out and get a demo of the financial plan. Talk to somebody, see how these strategies can help to impact your financial lives. And I certainly appreciate you guys having me back here. It was a lot of fun.
Thank you, Jason. Thanks so much. Now, hang on there for just 30 more minutes. You're going to get a leg stretch. Just 30 more minutes. And it's a very valuable 30 minutes. Because what is one of the biggest changes in your life as you get older? Health. Health. Health is hell. I mean, I'm falling apart now that I'm at past 65. Is there a switch? Like, oh, things hurt. And, you know, I do worry about it. I worry about how I'm going to pay for the medical care that I need, my wife needs in retirement, because it's not cheap and it's really complicated. But we have a guy here who makes it so much more understandable. From a group called ASR, which I think is some sort of a thing you do with audio, like, you know, like, I don't know. Oh, it's ASMR. Never mind. Guy with ASR, he's here all the time. We love him to pieces. Kevin Peterson, talk about Medicare.
Thanks, Don. Hard to believe it's already been a year since I was up here last year, and love seeing the turnout. And you guys have an awesome team with Apella here to support you guys. But the Medicare section I'm going to talk about is a perfect segue following the Social Security discussion. And he's right. When you guys either turn 65 or retire, a big, important component of that is figuring out how we're going to get health insurance. How many people have had employer coverage most of their lives? Yep. And the great news about employer coverage is You think it's pretty good. We don't pay an awful lot for it in most cases. The coverage is quality. And when you leave that, especially if you retire prior to 65, people are in for a shock at how expensive Medicare can be, or insurance in general can be. But as long as you understand your options, how to plan for it, strategize for it, you really want to make sure we make the right decision. So again, the Medicare workshop I normally do is 60 to 90 minutes, and I'm going to go all 90 minutes for you guys today. I'm just kidding. But we're going to just cover the really important components so you guys have a good base level understanding. A little bit of information about our firm, American Senior Resources. We've been here in the Northwest for over 35 years. We take an educational approach with our clients. One of the things that I love being in Medicare with is you guys have to make decisions. So you're not sitting here deciding if you want to buy a long-term care policy, you want to buy that evil word, the annuity. You guys have to make decisions with Medicare, and you want to make sure that those are informed. So what we're going to cover today, what to approach or what to expect as you approach age 65, or if we're past that age and considering retirement. We'll go under the basics of Medicare, what it's going to cost, how your income can affect your premiums, your deductibles and coinsurance. We'll talk about Medicare supplement insurance, also known as Medigap, and also the Joe Namath Special Medicare Advantage programs. And again, Medicare Advantage plans are often misunderstood, and many people that enroll in them need to understand how these are fundamentally different. And there are significant pros and cons to traditional Medicare and Medicare Advantage, and we'll go through that today. And then finally, what your additional steps and resources are when you get to making this decision. So we'll first start with when and how do we enroll in Medicare? First of all, you're entitled to Medicare in a number of different situations. For most of us, that's when we approach age 65. I'm still a few decades away from there, but we'll get there when we do. You can also delay Medicare at 65 if we're still working and covered through an employer plan or through our spouse's employer. And whenever we decide to retire, we're able to activate Medicare at that point as well. But there are also people that can be on Medicare early due to disability, Social Security disability. So there's a number of different situations there. Now, how do we enroll in Medicare when that time comes? That's all done through Social Security. And Social Security, they're lightning fast on doing everything. If you want to apply for Medicare, I highly recommend you do it online. No one likes going into their local Social Security office. You can call Social Security. They might as well disconnect their phone because they hardly ever answer the line. But do it online. It's going to save you a lot of time. One of the common questions we get from people that are turning 65 is they call and they say, you know, I'm still going to keep working, but I heard if I don't get Medicare activated at 65, Uncle Sam's going to get me in hot water with financial penalties. I'm going to be locked out of enrolling at a later time. That is true if you don't have what Medicare deems as a creditable alternative health care plan. So if you're on COBRA, you're uninsured, you're on a private Obamacare ACA policy, you do have to get moving and get all your Medicare stuff set up at 65. But if we're still working and covered through our job or through our spouse's job, we can actually delay Medicare as long as we want to, so long as we do activate it within 8 months of leaving our employer coverage. And keep in mind, COBRA is not considered employer-sponsored healthcare. So don't make that mistake of taking COBRA Medical when you retire if you're over 65. COBRA's so darn expensive anyway, normally doesn't make sense. One of the best things to understand how a program works, in my opinion, is to follow the money or follow the funding behind your healthcare coverage. When you enroll in original Medicare Part A and Part B, you are going to pay a monthly premium, which we'll be talking about here shortly. But the U.S. Department of Health and Human Services also chips in a large share on your behalf. Now, no, the federal government's not giving you all this money on your behalf because they like you and they like giving handouts. These are the taxes that you guys have paid your entire working lives that are finally going to start working for you once you go on Medicare coverage. But both your premium and the portion that the Department of Human Health and Services is submitting on your behalf, both of those sources are paid to CMS, which is Medicare. And they in turn are going to fund your benefits in one of two fundamental ways. They'll either fund original fee-for-service Medicare, and if we go that route, we're typically going to add a Medigap or Medicare supplement plan with it, or they will fund a privatized Medicare Advantage program if you choose to go that route. So again, when you guys get to Medicare, you're going to be making a decision of really one of two fundamental ways of how you're going to get your coverage. Now, I know there's a lot of information on this slide, but to start, I want you guys to reference the chart on the right. We get this question so much from clients that are new to Medicare that say, all right, I'm retiring, I'm turning 65, I need to enroll in Medicare Part A and Part B. I know that. Everybody tells me I need to go out and get additional Medicare coverage. Why is that? What's wrong with just having baseline Medicare A and B only? And can I just have basic Medicare A and B only if I want to? The answer is you can just have basic Medicare A and B, but you are very ill-advised or exposed financially to do that for a number of reasons. You're going to see up here that your Medicare Part A deductible, and Part A is your hospital benefit, is a per-cause deductible this year of $1,632. So that means if we go into the hospital in January, we go in again in June, and we go again in November, and we just have basic A and B only, we're going to pay that deductible 3 separate times. Now, your Medicare Part B deductible, which is your medical benefit, is an annual deductible of only $240. That one is virtually nothing. But again, if you just have original Medicare A and B only, once we pay these deductibles up front, Medicare then only starts covering 80% of our remaining medical expenses. You are liable for 20% of all remaining medical charges, and there is no cap or limit to that with straight Medicare A and B. So you can imagine what a cancer diagnosis would cost when you're taking a $15,000, $20,000 a month infusion and you're paying 20% of that infusion month over month. And that right there is why we need to get some form of additional Medicare insurance. Now, chart on the left, what are we going to be paying for Medicare? Jason from Apella briefly touched on this, that when we start selling properties or pulling investment income, it can really impact what we're going to be paying. The standard Medicare Part B premium this year in 2024 for all Americans at a minimum is $174.70. Do we think that went up or down from last year? Of course it went up. Nothing goes down in insurance. So it went up $9.80 a month. Now, many people think that this is what they're going to pay. Whether your neighbor across the street, your friend, your sister, well, they're on Medicare, I'll do the same setup, it's going to cost me the same. Couldn't be further from the truth. If we're a single individual or a single individual that made more than 103 2 years ago, or a married couple that made more than $206,000 2 years ago, you're going to pay what's called an IRMA adjustment. And IRMA stands for Income-Related Monthly Adjustment Amount. Now, if we're a married couple and we made $220,000, it's not a big increase. But if we're in that unfortunate position of making over $750,000, it's a good problem to have. But you're going to see that your Medicare Part B premium can really get elevated. And I've had clients that I've had for 9 years that have always been at that standard premium, and they get a letter every January. January is always the month we get the calls that say, I just got a letter from Medicare that says this coming year, I'm going to pay $400 more a month for Part B. What the heck's going on? I always ask them the same question. Did we sell a house or a property 2 years ago? How'd you know? Huge capital gains. So remember that it's a rolling 2-year look-back period on how the IRS reports your income to Medicare. So if you guys were to sell a house today, post some big capital gains, it's not going to affect you immediately. But in 2 years, that sale of that property is going to catch up with you. So as I mentioned before, all Americans are going to pick their Medicare coverage in one of two fundamental ways. We're either going to do original Medicare Part A and Part B, We're going to enroll in a Medicare supplement, or also called a Medigap policy, and a drug plan. Or we can do a Medicare Advantage program if we choose to go that route. Now, before we get into the differences between supplemental and Advantage programs, let's go back to what original Medicare covers. So Part A is our hospital benefit. So that covers hospital stays, skilled nursing care, home health care, and hospice care. And Medicare Part B is our medical coverage. So doctors, specialists, surgeries, labs, x-rays, MRIs, infused or injected medications that we get in a clinic setting. But again, original Medicare, basic Medicare, does consist of two parts. Don't think we can do A only and not do B. When we do go full Medicare, you got to get both those activated. So one of the ways that we can get our additional coverage, some more traditional or historical way, is to add a Medigap policy or a Medicare supplement plan. Now, what are these programs? These plans are sold through private insurance companies. So you're going to go out and buy a plan from an actual insurance company. And they're designed to fill in those financial leftovers, the Part A deductible, the 20% that Medicare doesn't pay. Now, supplemental plans are standardized. Now, what does that mean? Why is that a good thing? You don't have 100 different supplemental plans to choose from 100 different insurance companies. Medicare itself are the ones that go out and build the benefits of these supplemental plans. And how many are familiar with these terms? Plan G, Plan F, Plan N. Doesn't matter what company you buy your supplemental plan from. The benefits by law are identical. They're standardized. And the reason that's a really nice feature is that they're very easy to compare. You simply want to buy off of price. There's a few caveats to that. Some plans might give you a perk to join a gym where another one wouldn't. But again, when you're comparing supplemental programs, you really want to buy on lowest premium. How does a Medigap plan work? And this is a really good thing of Medigap. When you receive medical care from your providers, your doctors bill Medicare, not your supplemental plan right out the gate. Medicare is still fully in charge of approving and denying your health care claims. Your supplemental plan, regardless of what insurance company it's with, has no say in the matter if your benefit is covered or not. If Medicare approves it, your supplement plan pays off your balance. If Medicare doesn't approve it, your supplement plan can't cover it either. But again, as these Advantage plans continue to evolve, this is a really big strength of supplementals, that your claims really do get efficiently, quickly processed instead of having an insurance company in charge of doing that. Not going to spend a lot of time on this chart. This just shows those standardized supplementals. You will see Plan C and Plan F on the far right are grayed out. These plans can no longer be purchased since 2020. But I will tell you that if you have any friends, parents, loved ones, or yourselves that are on a Plan C or a Plan F, at least here in our local market, you're overpaying, and we need to get you down to a G or even an N. And if that's something that's relevant, feel free to reach out to my team, and we'll go through that with you. Medicare Part D, more bad news for high income earners. If we do a supplemental plan, we also have to carry a separate standalone Part D prescription drug program. Now, let's say we enroll in a drug plan that's $10 a month, and we're in that first income bracket. We pay our insurance company, our drug insurance company, $10. But let's say we're in that second highest bracket as a married couple, and we still pay our drug plan company the $10 premium like anybody else would. But Medicare itself is going to collect an additional $74.20 from us in that income bracket. So again, if I put a Medicare package together to somebody in a modest income, a Cadillac option, it might be $330 a month. Pretty reasonable to have great Medicare coverage. That same exact package for a married couple in these last two brackets can be pushing $800 or above for the exact same insurance programs. And remember that that extra money that you're paying is not going to your insurance companies. It's not going to your drug company. It's going back to the federal government. You're paying a larger percentage of what it costs for you to carry Medicare coverage when you're in these higher brackets. So let's cover Medicare Advantage. This is the other way we can round out our Medicare coverage. Now, for those of you that have turned 65 already, and I know there's a number of us in this room, 3-4 months before your 65th birth month, your mailbox was exploding at the seams. You had enough paper to have a neighborhood bonfire in the backyard. Your phone was ringing off the hook. You got all these TV commercials telling you to do Medicare Advantage. One thing that's been very upsetting to me in my line of work is there is a lot of misinformation and mismarketing out there. And when we take a very educational approach, I can't tell you how many times I run into someone who's referred to me that had already made a decision a year or two ago and had no idea that there were other options out there. Why? They called these TV commercial phone numbers. They get dumped into a plan, whether it's a good fit for them or not, because that's what the person at these sleazy call centers wants to push. You need to educate before you make decisions. But again, Medicare Advantage plans do have a lot of great factors. I'm not saying they're a bad fit, but you need to know how they are different. Medicare Advantage plans are very similar to private medical insurance policies that you're used to, with some big improvements. You generally have no deductible, which is great. Most of us have never been on a plan without a medical deductible. And they do provide some additional benefits that original Medicare and supplements don't. So you get some dental care, some coverage for glasses, alternative medicine, full preventative eye exam and hearing exam. Most or traditional Medicare and supplements don't offer those things. And they come with a lower premium. Does that sound too good to be true? Well, partially it is. What all these advertisements don't tell you is what you're giving up or some of the back-end hidden cost. And we'll go through that here on another slide. To be on an Advantage program, you still have to have Medicare A and B. So when you see these TV commercials that say, this Advantage plan is $0, well, remember, you still got to pay your Part B premium and any income adjustments that apply. And Medicare Advantage plans are also offered by service area. So if you live in King County, you got a lot of options. But if you have a brother that lives out on the Olympic Peninsula, for example, very few Advantage programs out there. So these are offered by the county in which you reside. How does an Advantage program work? Oh, sorry, I got a little punchy there. So when you enroll in a Medicare Advantage plan, the federal Medicare department basically says, bye, see you later. We're going to pay whatever insurance company you elected to go with to take over all of your Medicare coverage. So as I talked about earlier with a Medigap policy, your doctor submits all your claims directly to Medicare, and the Medigap plan had no say in the matter. They just paid off the balance. When you're on an Advantage program, your doctors have to submit all of your medical claims to your insurance company. Now, by law, these Advantage plans are supposed to cover anything that original Medicare would. And for the most part, they do. But that doesn't mean it can be a lot more aggravating. So with Medicare Advantage, you will have more along the lines of needing prior authorization. Maybe they want additional medical records before they're going to approve coverage for an MRI. But again, I have a lot of clients on both types of Medicare, and Medicare Advantage experience overall is pretty good, but you need to understand how they are different before you actually make that decision. Won't spend a lot of time on the Medicare Advantage plan structures, but again, even though these have a lower premium and a few extra benefits, you are going to get nickeled and dimed while you use it. So unlike a Medigap plan where if we spend a month in the hospital, there's really no charge if we have a higher end Medigap policy, with Medicare Advantage plans, you do have a lot of co-payments. So $0 to $15 to see your doctor, $40 or $50 co-pays to see your specialist. But we spend a few nights in the hospital, your plan might have a $400 a night copay. You're going to get a bill for $1,200. And if you end up having a terrible year, and this will vary by the state, I know we have a lot of out-of-state people online, but in our area, you at least get out-of-pocket protection, what we call an out-of-pocket max, of around $6,000 to $7,000. So even if we're on a $0 Medicare Advantage program, you still get a limit of what you're exposed to financially. And again, that is why we should never have just straight Medicare Part A and Part B. So this is the ugliest slide on the presentation. Why? I did this one, not my marketing team. But every time I meet face-to-face with clients in my office, I take them through this side-by-side comparison analysis. So let's assume we're going on full Medicare at age 65, or we retire past that age and we're now signed up for original Medicare A and B, which we know we have to do. You're now at a fork in the road, and you're going to decide one of two fundamental methods of how we're going to round out our coverage. If we go Medicare supplement, also called Medigap, strengths here, they have no network of doctors. You can see any physician in America that accepts Medicare patients. There's no primary care physician requirements. There's no referrals needed. It really allows you to go anywhere in the country for your medical care and opens up virtually any doctor's office for you. Biggest benefit of a supplemental program, you really don't have any financial burden. If you have a Cadillac Plan G today, you have an annual deductible of $240. Anyone on an employer plan that's got a deductible that low? Good for you, but that's rare. Those days are pretty much gone. But once you pay this tiny $240 deductible, any Medicare covered service is fully paid for, 100%. You're going through cancer, you need an open heart surgery, you're taking $20,000 a month infusions. When you get your statements, $0 owed. Supplementals are great for people that go through a lot of medical issues. They're standardized, they're very easy to compare. In some states, including this one we're in now, you can change your supplements at any time throughout the year. You get a rate increase, and if some of you are on supplements out there right now with two of our more local carriers, if you haven't got it yet, you're going to be getting a notice that there's a big rate increase hitting on the 1st of April. But if you get a rate increase and another company offers the exact same healthcare plan at a lower price point, switch to it. They can't say no. It's guaranteed issue year-round in our state. And the other beauty of supplementals is the only way your benefits can change is if Medicare itself changes them, not your insurance company. Remember, these are standardized healthcare plans. But you got to pay for this level of protection. If we want that financial security, knowing that we're not going to really owe anything when we get really sick, we got to front load the cost. And that means that supplements have a higher monthly premium. That will vary by state. Here in our area, a good supplemental plan is going to run you between $165 to $220 a month. And keep in mind, that's in addition to your Part B premium. Supplementals do not include our drug coverage, which means we also have to enroll in a separate drug policy. So we got 2 ID cards to deal with, and we might have a separate small monthly premium for our drug plan. And the third and final downside, when we're on a supplemental plan, we don't get any additional benefits beyond what original Medicare pays. It's secondary to Medicare. It's simply there to pay off the balance. So there's no dental, doesn't cover eye exams or hearing exams or alternative medicine. Now, on the flip side of that argument, Medicare Advantage is your other choice. And the strengths here, they're cheaper. They start at $0 a month. Our drugs are included. You do get a lot of additional benefits, some dental care, vision, hearing, alternative medicine. And many of these plans provide fitness perks where you can join a local gym. Downsides to it, though, we're going to be in a provider network. And if any of you guys, especially over here on the east side this last year, there's been a lot of negotiations going on with insurance companies and one of your big provider groups just north up 405 here over the last year. So even though the plan you pick today might have all your physicians in it, doesn't mean that's going to be the case next year, which means you might have to change your healthcare plan or find a new doctor again. Who thinks it's easy to find a brand new primary care physician out there right now? It is almost crisis mode in the healthcare industry with doctor access. With Medicare Advantage, we might need referrals from our primary care physician. And even though we're paying less for it, we have a lot of additional out-of-pocket costs. The final thing I want to mention here is the most common question I get when we work with clients on educating them about these programs. People say, I'm healthy now. Let's do low-cost Medicare Advantage. I don't go to the doctor very much. I like that low premium and the extra benefits. Whenever I get cancer, I'll just flip back to a supplement when it's worth paying the premium. Doesn't work that way. If you start with Advantage coverage, and in 2 or 3 years, you start realizing, wow, I paid $5,000 last year, $7,000 this year. Supplemental is now clearly a better fit for me. You can always apply to go from an advantage to a supplement, but in almost every scenario, you need to be medically approved. So keep that in mind. So I'm about done, and we're going to get you guys out for a quick stretch of the legs. If you guys want to scan this QR code, or at my desk outside, I've got one you can scan as well. Our office does a monthly Medicare newsletter. It keeps you guys up to speed on what's happening in Medicare, and really good information that we send out periodically. And then finally, if you guys do have any questions, there'll be some time at the very end of today where we'll be doing a roundtable question, or visit me out at the desk. I normally get a lot of people that stop by, but here's my contact information as well. So we are right on time. And
You are right on time. Well done, sir. Kevin Peterson.
Hello, everyone. Let me just think, am I on? Can you hear me? Awesome. Okay. Put my water down. Here we go. Okay. I have a lot of material that I'm going to go through very quickly. As with some of our other presenters, I normally do this presentation in about an hour to an hour and a half. So bear with me as we go speeding through this. Today, what we're going to go over is just the different types of communities that are available for people as they age. We're going to go over the services that they offer, what's included, who's an appropriate fit for each type, and then some of the pros and cons. And if we have time, we'll also go through quickly things to consider when selecting a community, and also how to decide when it might be the right time for a move. And this could be you, and this could also be a loved one or a parent we're talking about. So, ready? Let's go. All right. So, first of all, simplest is an age-restricted community. And this is simply a housing development or an apartment complex for someone who is 55 or older. You can rent or you can buy, depending on the type of development it is. And usually your community and your yard maintenance are included, your transportation services are included, and sometimes activities and outings are included. The quality is going to vary a lot. So if you think, I might want to do this, what's the advantage? You know, you don't have your neighbor's kid running through your yard at 2 o'clock in the morning or whatever, because it's age restricted, right? If you need assistance with your ADLs, by the way, ADLs is activities of daily living. It's the things you do every day. You get dressed, you use the bathroom, you take a shower, you eat, maybe take your medications. So when you see that term ADLs, it's those activities of daily living. Okay, in an age-restricted community, that is not going to be provided for you. So if you do need a little bit of assistance as you age, this is not going to be the appropriate community for you. And your options are either going to be moving somewhere that can provide you some level of care, or bringing in some home care. There are not meals included. And again, no personal assistance with those activities of daily living. They are not regulated by the Department of Social and Health Services. And I'll talk a little bit more about this in a couple slides. So if something happens to you, if you need some level of care, this community is not going to be liable. They're not going to really be able to assist you or be responsible for helping you. Not a bad thing necessarily if you're age appropriate and health appropriate, right? Okay. Next, we come to an independent living community, which sounds a lot like an age-restricted community, but it's a little bit different. It is for someone who is still independent, does not yet need any assistance with those activities of daily living, and they are 62 or older. This is going to provide social activities. It's going to provide educational opportunities, housekeeping, transportation services, home and yard maintenance, and really, probably what's most important, a support network. So as you age, you have a built-in support network. And the focus here is really on helping you maintain your highest level of independence and activity and mobility. This is not about helping you with your dressing and your grooming or anything like that. Let's see, what's included here? Included, your apartment's going to be included. Some of your meals, 1 to 3 meals, depending on the community. Your utilities are included. Your housekeeping is included. Transportation, all of your home and yard maintenance, lots and lots of life enrichment activities, and access to help if needed, just not medical help usually. Your rent and your service fees are paid for privately. There's not a care plan at an independent living community, and this is going to be similar to the age-restricted community. Again, focuses on helping you stay independent, not on providing care for you. And unless the community also does provide some assisted living services, they are not regulated by DSHS, which means the Department of Social and Health Services doesn't come in to make sure they're doing everything right. You just have to trust that they are. Now, if this community even has one assisted living license in the building, they are going to be subject to inspections by the Department of Social and Health Services, which is a good thing. So if you're looking at an independent living community, a good question is, do you also have an assisted living component should I need it as I age? Okay, speaking of assisted living community. So an assisted living community is going to be very similar to an independent living community. And by the way, independent living community, you can really think of it as supportive community, even though they're not providing assistance with your activities of daily living. They do provide a lot of support. So within the assisted living community, a lot of the same thing is included. In fact, more is included with an assisted living community because all of your meals are automatically included. Of course, your rent is, your transportation is, all of your activities are included, access to help is available, and that sort of thing. Now, the thing that the assisted living community does provide that the other two don't is help with your activities of daily living. So when you move to an assisted living community or to the assisted living wing in a building as you age and start needing some help, what'll happen before you move in is the nurse will sit down with you and do a full assessment to find out exactly what it is you need. And from there, they'll design a care plan addressing your specific individual needs. How much is it going to cost? Well, that's going to be entirely dependent on the complexity of your individual needs. You know, could be relatively low. It can get very, very expensive, which is why you're all here, so that you're really, really planning for when you need a little help, right? The nice thing about an assisted living community is not only does it provide you help and support with those activities of daily living, it is also very closely monitored by the Department of Social and Health Services. And they must adhere to a number of regulations that govern how they provide care and how they interact with you. This is important. DSHS will come in and do a full inspection of the assisted living community at least once a year. And they're going to go over everything. They're going to look at medical records. They're going to look at how high is your water temperature set. If you can think of it, they're going to check it. And it's a good thing, again, because it is to protect the residents and make sure that care is being delivered in a safe and effective manner, right? Now, your costs for assisted living, even if you have a very advanced care plan, your care plan is not going to be covered by Medicare or any type of health insurance. This is entirely private pay unless you have long-term care insurance. There are some other options. You might be a veteran and have access to some veterans benefits. You might be able to access a life insurance policy. It's really kind of just depending on what your personal finance situation looks like. Very few communities accept Medicaid. So if you run out of money, you could find yourself in a tough spot. And like I said, many communities do accept long-term care. With independent living communities, I'm going to do a little callback. You know, all of those things are included in one price. With assisted living communities, all of the things that are included in an independent living community are also included in your rent. However, the care plan, and again, this is determined when you move to an independent living community, the care plan, that's going to be a separate cost. So if you've ever called an assisted living community on behalf of a loved one and really tried to get an exact cost, you can't. They're not playing with you. They just really can't give you a cost because it's going to depend on the care needs. It's going to depend on the size of your apartment. There are a number of things that are going to factor into that, unfortunately, or fortunately. Next, we have secured memory care. And secured memory care is a retirement residence that is appropriate for someone who is 62 or older and has a mid to high stage level of cognitive decline. It could be an Alzheimer's disease. It could be any type of dementia, whether progressive or not. But the individual who needs to live in a secured memory care community does have some level of dementia and needs regular, ongoing monitoring and assistance. Maybe they cannot live safely at home, and maybe they can no longer be supported in their assisted living community because they could potentially be a danger to themselves or just have a lot of confusion and need a lot more interaction and redirection. They are also going to provide specialized exercise programs, nutrition programs. Your monthly rent is going to include everything that is included in the independent living community, excuse me, or assisted living community. However, it's going to offer a higher level of care and it's going to cost more. The caregiver ratio to residents is going to be much higher, with the assumption that there's a lot more interaction that's going to be required. And your care plan, as with the assisted living community, is going to vary based on your individual needs. You're going to go through that nurse's assessment before your final cost is determined. It can get quite pricey as you age and your needs continue to progress. The cost of secured memory care, as with assisted living communities, is not covered by Medicare or by health insurance. So you really need to be thinking about, okay, I mean, if anyone's had a relative in here who's had Alzheimer's disease or another progressive dementia, right, you know it requires a lot of care and it can get very, very expensive. We're not all going to get it, but some of us might. It's best to just really prepare yourself for whatever might come because we don't have a crystal ball. We just don't know, right? Okay. Next, well, I know I'm going through this quickly and hope you're getting it all, right? There'll be a test later. Adult family home. This is a very different type of care facility. This is simply a residential home that's been approved by DSHS to care for up to 6 individuals in the home environment there. Usually, an adult family home is appropriate for someone who has a very high level of need. They might be very frail, a fall risk. They might have a very high level of cognitive decline. They are not going to be an appropriate setting for someone who is sort of just coming into this continuum and is still relatively independent, any more than someone who needs an adult family home would be appropriate for an independent living community. You know, you're really kind of starting to get to the opposite ends of the spectrum here. Not a lot of activity with residents. It's a very kind of calm, sedate sort of environment where the focus really just is on providing care. And oftentimes it's very near end of life care. There are thousands of adult family homes in Washington. I think there's like 2,000 in King County alone. So if you think that an adult family home might be the appropriate environment for a loved one, then I highly advise you to work with an elder care advisor because they can help guide you through what to look for and help narrow your choices down from, say, 2,000 to 3 or 4. And then you pick the one that is most appropriate for yourself or your loved one. Next, we're going to come to nursing home. And before I flip to nursing home, which, by the way, tends to be the thing that everybody thinks, oh my gosh, if I have a need, I'm going to live in a nursing home. Guess what? You're probably not. So real quick question, and some of you may have heard this before, so if you already know, what percentage of the population in Washington State is going to need to live in a nursing home long-term? Throw a number out. Lot of variety, but you're actually closer than most people. It is 4%. Oh, I think I might be missing some of my information. Sorry about that. No worries. Okay, so a nursing home actually serves 2 functions. What does the nursing home have for everybody? Well, nursing coverage, 24 hours a day. The ability to provide care that cannot be provided in any of the other previously noted settings because they're licensed differently. They are medical facilities. So, you know, you're going to have a lot more intense care in a nursing home. Long-term care, again, only about 4% of the population is going to need this in Washington State. If you are living in a nursing home, Medicare will not pay for your stay, okay? Medicaid eventually will, if and when you were to run out of money. On the other side, what is a nursing home for? Rehabilitation or therapy. Now, a lot of us will very likely need a brief stay in a skilled nursing facility after some kind of a major health issue. You know, maybe I've had a heart attack, or maybe, hey, maybe I've even just had a knee surgery and I've got a million stairs in my house that I can't manage. So I need to go there for some physical therapy. Generally, you're not going to be there for very long. And when you are, your Medicare aid benefit's going to cover the first 20 days, so long as you are continuing to make progress. After that, if you are still continuing to make progress and you do still need to be there, your Medicare B benefit will kick in. And I think your Medicare B benefit comes with a copay of about $200 a day. So it can add up quickly. Used to be people would stay for a long time in skilled nursing facilities after a health event, but now the average is really only about 3 weeks. All right. And then last one I'm going to touch on is a life plan community, or what is also known as a continuing care retirement community. A lot of people think of these as, okay, these are the big buy-in communities. They are often a luxury model, and there are several different types of CCRCs. The one thing that they're all going to have in common is you are going to pay a significant entrance fee, similar to what you might spend on a condominium. Or maybe less. You know, you could spend anywhere from a couple $100,000 as your entrance fee, all the way up to a couple $1 million as your entrance fee. Granted, that $2 million entrance, you're going to have a gorgeous apartment with a beautiful lake view. Who doesn't want that? But you're still going to pay something to move into these communities. You have to be independent when you move in, and then you progress through levels of care. They have independent living community, independent assisted living, memory care, and skilled nursing on the same campus. Now, one of the disadvantages is as you do need care, you have to move from, say, the independent building to the assisted building to memory care. So it can involve several moves along the way. So that gorgeous apartment that you paid your $2 million fee to move into, well, you're not going to get to keep that when you actually have some needs. You're going to have to move to the assisted living building. Sometimes one of these communities is an absolute fantastic fit. Usually, if you're moving in younger, it's a better fit than if you're waiting and delaying a move. But if you think, okay, that might be something I want to know more about, I highly encourage you to get the packet from the community and share it with your financial planner and talk about, okay, let's look at what is my longevity plan and does this make sense for me? Okay. I know I have skipped over some information and I apologize. I'm just trying to keep you all on track. All right. So next, what are some of the kinds of questions you should ask, or how do you determine if a community is the right fit for you or for a loved one? And I have to say the most important thing when you go into this process of looking for an appropriate community is to have a realistic understanding of your own needs or your parents or your loved ones. When we think of how we function throughout the day, you know, sometimes we'll think about how we do on our best day. You really need to account for, okay, what do I need on my worst day? What kind of support am I likely to need? You know, and look at more than the age of the residents when you go tour. Look at the vibrancy of the community. We all have this theory that, you know, I look younger than all of my peers. You know, you look in the mirror, you know, I look in the mirror, I'm like, oh, sure, I still look 35. I know this is not true. But you know, we have this little bit of a distortion. So when we walk into a community where everyone is 65, 75, 85, even if they're our same age, they all look so much older than I do. So look beyond that, really get to know, ask questions, and look at the vibrancy and look at the activities. Do they have things that you or your loved one want to do? It's wonderful to have a gorgeous Olympic-sized swimming pool, but if you or your loved one doesn't swim, who cares? That's not a benefit for you. So look for the benefits that are important to you. Attend events and activities. If you're right now in process of looking for an appropriate community for your mom, say, take her to some of their events, have a meal, check out the food. That is such a huge component. Because remember, in most of these situations, your meals are provided. And if your meals are going to be provided, you want to make sure it's good, right? You don't want to be eating cafeteria food that's blah, right? Okay. Ask about care limitations. So if you're moving into a community and you have a progressive condition, for example, let's say you have been diagnosed with early Alzheimer's disease and you're doing fine now and you're appropriate for an assisted living community, you probably want to ask if they have a memory care component, knowing that there's a high likelihood you may need that in the future. And also just ask, are there specific conditions that would mean I would need to move out? Little tip, if you go to a community and they tell you, you will never ever have to move out no matter what, that's a red flag. Because again, nobody has a crystal ball and they don't know if you're one of those 4% that might need to live in a nursing home. Hopefully you're not, but there's no guarantees, right? Okay. Ask about flexible licensing. And this is not something I mentioned earlier, but flexible licensing simply means that when you move into a community and you're independent, when the time comes that you might need to add some assisted living services, do you have to move to another apartment? With flexible licensing, the community simply applies an assisted living license to the apartment you're already living in to deliver care that way. It's a bit more dignified approach because you don't have to move to the little building with the little dining room away from your friends. And it's also, you don't know who's on services and who's not. It does protect your dignity to some degree, I think. And ask to see a copy of their most recent DSHS survey. Remember, they come in every year and they inspect everything. So you want to take a look at that. And if you see they've got a lot of violations on their survey, run. It is not uncommon for communities to have 1 or 2 violations. Like I said, I mentioned that they checked your water temperature your water temperature. Okay, it's set a degree too high. What is my plan of correction if my water temperature is set a degree too high? I turn it down, right? Not a big deal. However, if you find that they have medication errors, they have undocumented falls, they have a number of complaint investigations, you really want to find out what's going on or just walk away. Because again, if you are putting yourself or a loved one in someone else's care, it is vitally important that you know you can trust them. Don't just look at how beautiful the community is. There are a lot of absolutely gorgeous communities, especially like around here. We're fortunate in that respect in Washington. But no matter how beautiful that community is, remember that absolutely stunning chandelier in the front lobby, though it's nice to have, it's not delivering care to your mother at 3 a.m. Ask about staffing, look at the longevity of the staff, look at some of their special supportive programs. Don't be afraid to ask questions because, again, like you've always heard, the dumb one is the one you don't ask. So be sure to do some digging. How do you know when it might be the right time for you or your loved one to consider a move to a more supportive community? Well, how does life compare to how it was 5 years ago? Are you able to do all of the same things? Or have you found that either there's been a decrease in your mobility or just your ability to interact with the world and to do the things you used to do? And then how do you envision that's going to change over the next 4 years, 5 years, whatever that case might be? I always encourage people, even if you're not at a point where this applies to you, educate yourself about it. Get yourself far enough upstream so that if your circumstances change, you already have a pretty good understanding of what you want so that, you're the one making that decision. How often are you socializing? If you live somewhere where you have become very isolated, either because friends have passed away or moved to communities, or maybe it's just because you live in a home that is on a hill and tough to get to, what happens if we get an ice storm and you need help, right? So really take a look at that, at your living circumstances already. If you are in a place where, a lot of people say, I'm going to stay in my home until I die. And for a lot of people, that'll work. That'll work perfectly, as long as you have the appropriate support network and your home is laid out in such a way that you can age there without needing to bring in help. Or if you do bring in help, can they get to you, right? Have you had a fall in the past year? If you had, statistically, it is likely you will have others unless you make some pretty significant lifestyle changes. And even if you do make lifestyle changes and you become healthy, we're all still aging. We're not aging in reverse. We're not Benjamin Button. Eventually, we are going to all get to a certain age. And congratulations if you do, because consider the alternative, right? Are you, this one, are you living on processed foods or microwave meals all the time? Now, I will admit that all of us do from time to time, because it's easy. I have occasionally had Ben and Jerry's ice cream and a bottle of wine for dinner, but not all the time, okay? If right, if you find that, or your loved one, you go to your loved one's house and you look in the fridge and there's really nothing there except for frozen meals, and they're not good, they're all full of sodium and fat and sugar and such, they are not getting adequate nutrition, and it might be time to consider some options. Are you the caregiver or spouse for a loved one, and you have found that it has become your central identity? It is exhausting. If as I know some of you know from having parents that have been caregivers, or maybe you've been caregivers yourself, it is a tough journey. Even if you are not in a place or in the frame of mind where you would like to move your loved one into care, I encourage you, get some support, get some help. No one should go through it alone. It is a tough road. Have you been diagnosed with mild cognitive impairment in the past year, or some form of progressive dementia? It doesn't mean you need to move now, but you do need to start doing your research now. Because who do you want to make that decision for you? I mean, ultimately, we all want to have self-determination, even when we get to the point where we are not healthy enough to make those choices, or we are not cognitively intact and able to express what we want. So figure it out before you need it, so that you are the one making those decisions, not your doctor, not your kids, you. Okay. How am I doing on time? Oh, we're almost done. Awesome. This is my last slide, the money shot. This is the one everybody needs to have an awareness of how much things cost. Okay. And these are just averages in the Seattle metro area. Your home care, this is what your average cost is going to be based on 45 hours a week. Adult daycare, that's your best option if you have a relative who can utilize that safely and comfortably. It's a good stopgap. Assisted living communities, again, your average is almost $8,000 a month. Nursing home, considerably higher. Adult family home, it's actually pretty similar to an assisted living community. And memory care really falls closer to an adult family home. I apologize for not putting it in there, but I know this is a tremendous amount of information. I did make sure to put a little cheat sheet in your bag today, so you at least have this. But you're not all experts now, but that's okay. You will be. Go out, educate yourselves, learn what you can, again, so that you are in control of your choices. And I think I'm at time. Whew, that's the fastest I've ever done that. Booking through. You bet. Sorry, Tom. There you go.
No, you did. It's right here. All right. I read recently that, and I think I have this right, but the next speaker will correct me if I'm wrong anyway. That last year was the more fraud last year. Oh, Al Roker's, what's he doing here? Oh, Herb 100 years ago. That's good. It's going to stay perfect. And again, the next speaker will correct me, but I believe last year was the all-time record for fraud. And then today on our virtual, we had somebody trying to defraud people through a Venmo. It's outrageous. All the various ways people are coming after you. The Puget Sound region is really lucky because we have a guy that lives here who's been a broadcaster here and now writes for checkbook.org and does other stuff like this to help you stay informed, because we're lucky to have Herb here. And he, as you may know, has been a member of the broadcast community for many years. Actually, in my mind, he kind of originated the broadcast consumer man genre, if you will. There really didn't exist before Herb started doing all that kind of thing. So I'm really lucky because not only was willing to come and do this, but we've become friends, which I enjoy. And Herb has a great love of animals as well. We've done great work in the community for animals. My absolute pleasure to introduce consumer man Herb Weisbaum. Herb.
Thank you, Tom. Now you know why he's on the radio and not on TV. TV is pictures and sound. It's a whole different thing. By the way, I saw Don out in the hallway and I said, you really do have to learn how to project, Don. I mean, you've really got to just learn how to Just learn how to build it up. Nice to see you all today. A quick question before I start, and I want honest answers. Show of hands. How many people here have ever been a victim of a scam? Any kind of scam whatsoever? Okay. Not surprised. I just want to start with two quick factoids, and then we'll get going. So first of all, I think you know who I am, but is this working? Yes. Okay. So I've been doing this for 40 years. Cairo Radio and TV, Como Radio and TV here in Seattle. I was a consumer correspondent for CBS News, and I was also a consumer contributor for the Today Show. So I've seen this from both the local angle and the national perspective. And so we're going to talk about fraud for the next half hour or so. This problem is the worst that it has ever been. Here's a survey. I just found this yesterday from AARP. Twice as many Americans are afraid of being the victim of a scam or having their identity stolen than fear of being murdered. Worried about a scam as opposed to being murdered. And as Tom said, this is a record year. The Federal Trade Commission just yesterday came out with a report that they had reports of $10 billion in fraud reported to them last year. That's $1 billion more than in 2022. And it's only the tip of the iceberg because in most cases, I bet it's 100 billion if you put how much has really been taken, because most people never bother to report the fraud because they're afraid. So let's delve into this just a little bit. There has never been a better time to be a criminal. I have never in my 40 years of doing this have seen so many attack vectors and so many people being scammed out of so much money so easily than it is now. When I started, you know that Nigerian scam letter, the thing that I have the letter. They had to mail it with a stamp. That's how far now that's how far we've come with that kind of thing, because they can now do this kind of thing. So they're online, they're on text messages, they're on email, and they're on social media and the telephone. So they have all these ways to attack you. And social media, and you may not be on it as much as some people, but social media is now the #1 way that they are going after people because it's really, really lucrative. Americans lost $2.7 billion from scams that started on social media. That's either an ad, a post, or a message between January 2021 and June 2023. That is a lot of money being lost that way because for some reason, people believe what's on social media. Social media is not a trusted source. The internet is not a trusted source. It's a utility. It's like the sewer. Something goes in and something comes out. It doesn't mean it's verified. It doesn't mean anybody's checked it. It just means it's gone down the pipeline. You are the filter. You're the one that's got to figure out if it's true or not. So the top social media scams, if we're just looking at what's happening on the world of social media, are shopping. There's a lot of stuff on there. Oh, get this great deal on these shoes, and they're 10% of what you pay at a store, or investment opportunities, which is what you're here about. There's a lot of investment opportunities taking place right now. Investment scams, 54% who reported losses to investment scams in 2021 said the scam started on social media. A lot of cases are also starting on text message, and I'm going to show you a couple of real examples. But again, you get your financial advice from two wonderful people who are on the radio, or you have an investment advisor or someone like that. You do not take investment advice from someone who is just giving it out on TikTok or any other social media, or that just randomly texts you and says they have information. So let's talk a little bit about the cryptocurrency scams. This is one of the ones this is an actual text that one of the victims I spoke to have. And this person claimed to be a professional Bitcoin trader, and they are going to help them make a whole lot of money. And they actually had this chart. So they guarantee, as Tom McDonald always tell you, they can't guarantee doing anything. $300, you'll get $6,700 back. And then it goes up to $500, $10,000 back. And this was within a week. I don't think that's going to happen. But people give them money because they believe them. They have fake charts, they have fake stickers, they have fake websites that show how the investments are going up. And then when you try to cash out the money because nothing really happened, then all of a sudden they disappear. There's all these big fees that you have to pay. The money's not there. It's all funny money, but they make you believe that you're making this money. Okay. Most frauds, believe it or not, though, still take place on the phone. And because we all have phones, we walk around with the phones and we have phones at our house, a robocall or robotext to scare you into responding immediately. And look at these numbers for just the first half of 2023, 33 billion to robocall scams, 13 billion to robotext scams. They're now moving from robocall to robotext because people don't answer the phone as much, but it's kind of hard to answer ignore a text message. The thing beeps, you take a look at it, you see what's going on. These robocalls and robotexts are everything from the financial ones are, it's your bank and there's been a problem with your account and you've got to get to us right away because we just locked up your account. Somebody's doing fraud on your credit card. Somebody just bought an iPhone on your Amazon account. Whatever it is, the IRS is coming to arrest you. Whatever it is to make you immediately do something and respond without thinking, that's what the con artists are trying to do. It's instantaneous emotional response. When you get one of those things, take a deep breath, take another deep breath, take another deep breath, pause and say, oh, the IRS doesn't send out text messages. There's no reason why they would ever do something like that. And then you won't fall victim to what they're trying to do. Phishing and smishing scams are still the biggest fraud threats. Phishing, as we all know, is when they send you an email that looks like it's from something that you trust. Smishing is the same thing as text messages. So we have clever names. By the way, I did the first phishing story on the Today Show. I was with Matt Lauer, and they made me put on the screen the word phishing, P-H-I-F, because no one had heard about it at that point in time. That's how long I've been covering these things. Now we all know what it is. So take a look at these two things. They look legitimate. The old rule, they don't look good, they got typos, they don't use modern English, that's gone. These are two common ones, and what they want you to do is they want you to click on something in order to do whatever the problem is. Your package hasn't been shipped, your bank account is corrupted, whatever it is. By the way, everybody worries about scams and AI. The way criminals are going to use AI is when they write these things, AI is going to write them in the perfect language that they want. It will be perfect English, it will be perfect Canadian English, it will be perfect British English, it will be perfect Mexican, whatever they want. The AI will make sure that the letter is perfectly written with perfect punctuation and grammar. So the old rules, look for the slop, that they're gone. These things look perfect now, and they steal the logos. So if you were to click on the verify identity link, that would take you to a fake website that is a carbon copy of the Chase Bank website, and it's going to ask you to put in your credentials. So then they are going to steal your credentials and then wipe out all of your money. If you went to the FedEx one, you can either click a link and they'll do the same thing, or you can download open up the PDF. If you open up the PDF, it's loaded with malware that will put a spyware on your computer, and it will watch everything you do, and they'll grab all your passwords to all your accounts, and they'll be able to run your life. So you never ever click on a link. You never, ever download a PDF or a file from somebody you don't know. And if you're not sure, check out. I got one from my tax accountant. She decided this year that my CPA, she's going to have you sign a form ahead of time to agree to her services before you and what services you want. She's there. Everybody's computerizing. I called and said, hi, this is Herb. Did you just send me this thing? Because I'm not going to download this thing and click this link. Yes, we did. Thank you very much. That's nice to know. You have to, and if you got a thing from the bank and you're a Chase customer, what the funny part is people get afraid and they're a Bank of America customer because they just send these out willy-nilly. They don't really know you're a Chase customer. They just send them out hoping if you are a Chase customer, it'll ring the bells and make you afraid. Call the bank. Hi, I got this thing. Is it from you? They'll laugh and say no, or, you go online and check your account, but don't ever click the link on these things. How about this one? I got this one from the IRS the other day. Of course, it's not from the IRS. It's from a con artist. And the one giveaway, which is the first thing I always check, is check the address. The IRS doesn't send from the basassassinswhatever.com. What the bad guys do is they steal people's, they hack people's email accounts. So I got these bank from Chase Bank. It doesn't, I mean, that's not always the case. It may say chase.com with a letter changed, but you get, Billy Bob's Alligator Shop is not where you're going to get an email from Chase Bank, but people don't usually look at that. Wells Fargo is that's an actual fraud alert from Wells Fargo. These are the text versions, the smishing version. It said, did you attempt a purchase at Walmart? And then they're hoping you're going to reply, and then they're going to start a conversation with you and eventually suck the personal information out of you. This is an actual one from Bank of America and asking about closing your account. Please confirm. And again, it scares you. It's like, I have to do something and text right away. So this is all in the whole genre of identity theft, which is, again, the thing that everybody's worried about because it can have devastating effects on your life. I mean, if you're just If somebody just steals your credit card number, you change your credit card number. If someone steals your medical information or your driver's license information or your social security number, that can make your life a living hell. And I actually interviewed a woman once who had somebody steal her identity and commit crimes in her name. And she was pulled over for a speeding ticket once, and they took her away in handcuffs because she wasn't the Jane Doe who was committing the crimes, but Jane Doe was using her name and her social security number. And she now, for the rest of her life, has to go around with a piece of paper in her pocket or purse from the DA and the local sheriff saying, this is not the Jane Doe who's committing the crimes. This is the Jane Doe who's the victim of identity theft. So that doesn't happen very often, but boy, if that does, I mean, identity theft can be a life-altering experience. So what they're after is your personal sensitive information. And here's the thing, everybody's worried about protecting themselves, which you still should do, and I'll tell you about that later. But you have to, there's a new reality now. Your information has already been stolen. It's out there. There have been more data breaches in the last couple of years. Your information is probably out there 2 and 3 times. And this figure I just gathered last night that came in from the Identity Theft Resource Center, which is a great nonprofit in San Diego that helps people who are victims of identity theft. A record year for data compromise is 3,025, up 78% from 2022. So they've got your SOCH, they've got your credit card, they've got your debit card number, they've got your mother's maiden name, they got your birthday, they've got all that. It's floating around on the dark web. And if you haven't been a victim yet, the only reason why is they got so much material that they haven't gotten around to you yet, quite frankly. That's what it is. So you've got to take steps to protect yourself. And what they're going to do with this information that they grab is they're going to take over your accounts, they're going to try to steal government benefits, they're going to commit crimes, and they're going to open new accounts. So take over accounts. They're going to try to log in and take over your credit card account. They're going to try to log in and take over your bank account so they can buy things or steal your money. Government benefits are going to try to take Medicare benefits, or they're going to try to take Social Security benefits, or they're going to try to put the tax return in before you put the tax return in, and they get the refund, and then you have to deal with the IRS for 6 months to try to get you a legitimate tax return. And open new accounts. If they get your information, they can open brand new accounts, new credit card accounts or whatever. They can open cell phone accounts, cable accounts. They can run up the bill, not pay it, and then you're the one who gets the bill, and you're the one who has your credit destroyed until you can prove that it wasn't you. One of the few things and only things you can actually do to protect yourself is to get a credit freeze. Let's see, and I'm going to give you a round of applause for those of you who have a credit freeze on your account. Yay! A credit freeze is the only proactive thing in the entire world of identity theft that you can do to proactively do something to stop being a victim of crime as opposed to dealing with it after the fact. And what you have to do is go to the credit bureaus and proactively do this. It blocks access to your file at that credit bureau. They've just changed it now. I just updated mine. You don't need a PIN. You just need your login information, and so that's okay. And you can. And in the old days, you had to call and do stuff. It's free. You can change it within like 10 seconds if you need to. If you're at the car dealership and you have to buy a car, and then you got to do a credit check, you just say which one are you using, and then unfreeze the one of the 3 credit bureaus are using, and then you can. When I did my car, I put it on a 48-hour unlock, and it locked itself automatically in 48 hours again. They checked my credit, and everything was fine. So you can temporarily thaw it anytime you need it. It does not hurt your credit score. Big myth going around, it's going to affect your credit score. Will not affect your credit score, and it does not affect any current creditors. So it doesn't change your life in any way, shape, or form, except it blocks criminals from using a credit check to get something in your name. So if you want, you need a credit check to open a bank account. You need a credit check to rent an apartment. You need a credit check to get a cell phone, to get cable TV service, anything to buy a car, anything that requires a credit check, they are now stopped from doing that. It won't stop any identity theft, but it will stop a lot of identity theft. We had an account at BECU, my wife had, and I said, could you put me on as a co-signer on the account? Because she said, sure. So she went to the bank branch, and she called me up and she said, they won't let me put you on. I said, really? I said, no, they said they cannot put you on. And ding, light bulb went off. I had a credit freeze. If I'd have been a criminal and trying to get into that account, it would have blocked me. It actually works. So that is absolutely something you have to do at all 3 accounts. They make it a pain in the butt. They make you jump through all these hoops. They try to sell you stuff while you're on the site. Get credit monitoring, the whole routine. I'll talk about credit monitoring in a minute. Just get it for free. Don't do the lock, do the freeze. They want to sell you their lock. The freeze is regulated by the federal government. Lock is regulated by them. so they could change the terms of deals anytime they want. Find where it says freeze. Use the word freeze and freeze the account. And then you're going to get all kinds of marketing. I just went over and redid all mine the other day, and I'm inundated with email now. So you just get the email and put unsubscribe, and you're going to have to do it all the time for the 3 places, and then you'll deal with that. But it is certainly worth the work. Equifax, Experian, and TransUnion. You got to do it at all 3. They're separate companies. So you got to go to each one and look up security freeze. How do I put a security freeze on my account, and then do it. The other way you can protect yourself, at least in real time, you'll know if something's going on, because the quicker you spot a problem, the faster you can solve it and the less harm there will be to you, is go to your credit card, go to your bank account, and set security alerts. It'll take you about a minute and a half to do that, and you'll know what's going on. So, for instance, for my bank account, I want to know anytime the ATM is accessed. I want to know anytime I set it, anytime there's a check written for $250 or more. For my credit card, I want to know anytime there's a foreign transaction. I don't do things out of country, so that's a real sign of fraud. I want to know anytime the card is not present. That means online transaction, they stole my credit card number, they're using it without a credit card at a merchant. That's a warning sign. I want to know anytime that happens. So there's all these alerts that you can set up, and you'll either get a text message or an email or however you want to do it. And in real time, you will know that somebody's monkeying around with your financial account, and you can work to stop it really quickly before they really do serious damage. I can't urge this strongly enough. The other thing is to get really long and strong passwords. Yes, passwords are a pain, and hopefully in about 5 years we're going to get past the passwords and go to the passkey world. But right now it's a world of passwords. At least for your most important accounts, make sure each one is unique and each one is strong. And if you can't keep track of them all, you have 2 choices. You get a password manager that it's on your desktop, and I have one called Keeper, and they're free to start. But if you want to get the real good, what you pay, I don't know, $10 a month. I have all of my passwords in my cell phone, on my laptop, in my desktop. So wherever I go, if I need to access an account, I'm able to access the account. And I have passwords that are 20 digits long, because for my financial accounts, they got algorithms now that can crack 5 and 6 digit codes, and especially password 123. That's probably 1 second. That's how he. So, and I talked to for one of my podcasts. I do a podcast for Checkbook called Consumerpedia, and I talked to one of the guys who was known as the godfather of the internet, and he was actually on the Secret Service's top most wanted list, spent 6 years in prison, is now a consultant. And he said to me, this is not some 500-pound kid eating trick cereal in New Jersey. These are sophisticated criminal gangs overseas who are running top of the line software that they set the software up, they go to sleep in the morning, and they wake up and it says, here's all the accounts you can break into. That's how, this idea of you can do a password like 123 admin or, zeros, that would take the algorithm at least a half a second to break in. So at least for your most important accounts, make sure they're long and strong. Use a password manager to fill that in for you. And the reason why it's unique is because if you use the same one, once they get one of your accounts, they'll try it on all the other accounts. So, and a lot of people use the same one, like if they break into the PTA, which probably doesn't have good security, or your, a retirement community or wherever, and you got that on your credit card account, well, that's the least vulnerable account is going to be hacked, and they're going to use it on all your more secure accounts. So at least for the 6 or 8 accounts that you have that are really valuable, use the password manager. And if you don't want to do that, the backup is write it on a tablet, put it in your top desk drawer, and the odds of somebody breaking into your house, finding the tablet and using it are this compared to password 123, your threat vector. So one of the way or the other, whatever makes you most comfortable. But I have no problem with, like, some seniors don't like technology. I tell them, write it down, make them real long and strong, and just put it in a tablet. I'd rather you do that than let me in or whatever one of the passwords is. The other thing you can do is actually, that's one of the top 10 passwords, let me in. Nobody would ever think of that. You would never think of that, would you? I mean, I thought it was AB3 123. Multi-factor authentication. That is where you have to have a password and prove that it's you equals access. So, for instance, That would be your cell phone text message that you get. That would be an email code that you get, something that proves that it's you. The logic being that the criminal doesn't have your computer, the criminal doesn't have your cell phone. They could have stolen something, even in most cases. So that's what it is. And according to the folks at Microsoft Security, this is what they said. The worst password with multi-factor authentication is better than the best password without it. That's how good multi-factor authentication is in preventing identity theft and fraud. Probably 99-something% if you have multi-factor authentication and use it wisely. Some people get talked into giving a code to the criminal on the phone. Oh, you just got the code, give it to me. The code doesn't go out to anybody. You just put the code in to authorize who you are. But if you do that, that is a really good way. And a lot of websites will force you to do it, financial websites. And a lot of sites will ask you if you want to do it. If it's anything that's financial important, phone, social media, which is what they like to hack, do that. And it'll learn your computer, your device. So after a while, you won't have to do it if you use your cell phone or use your computer. It says, I know you. But until you get to that point, it's really important to set that thing up. Everybody always asks me about credit monitoring, so I'll finish with a couple of things. Credit monitoring, fine. If you want to spend the monthly fee, it's nothing you couldn't do on your own. If it gives you peace of mind, it's fine. Credit monitoring does not prevent identity theft. It just monitors and tells you there's a problem after the fact. It cannot remove your personal information from the dark web. I don't care what they say, and it's false advertising. There is nothing these folks can do to take your information away from the dark web. It's there. It's going to be there. You have to do all the things that I told you to protect yourself. It doesn't monitor everything because a lot of these websites that the bad guys use are now behind paywalls. So you have to have a password to get in there to get all the stolen Social Security numbers. So these websites wouldn't catch any of that. And they have $1 million guarantee. And in most cases, if you're ripped off, the bank's going to give you the money back. The credit card company's going to give you the money back. I don't know how they ever pay this $1 million guarantee, but people, I just don't know. It's just marketing. So just a couple of really quick things to be proactive. Get your credit reports, annualcreditreport.com, at least once a year. Find out what's going on. Look for accounts that you didn't open. Look for rental apartments you aren't renting. Look for anything that indicates that somebody's playing around with your identity. That's one of the best ways to do that. It's free. Check your financial accounts. A lot of consumer people say every day. I think that's ridiculous, a little bit over a little anal. I do it once a week or every 2 weeks to see what's going on. And with credit alerts, I really don't have to worry as much as I did before because they're telling me what's going on a proactive time. Check your medical billing statements. The thing you get says this is not a bill, so you throw it away. Well, before you throw it away, read it because it's telling you what your insurance company paid. And if you see on your bill that you had a kidney transplant in Kentucky and you're living here in Bellevue, Washington, it means somebody stole your medical identity. And they're having they're committing a fraud either with the federal government, with Medicare, or they're committing fraud with the insurance company. And you really want to know about that. The reason why is because their information that's bogus could be mixed with your medical file. And I met a little girl once who had she was going to get blood at a school blood drive because there was a car accident. They were trying to help the kids in the accident, and they told her she couldn't get blood because she had HIV. I don't have HIV. Yeah, it's right here on your medical file. Long story short, it took a big investigation. Somebody had stolen her medical identity, had HIV treatments, got commingled with her medical file, and on her record, it was that she had HIV. Imagine if they changed your blood type and it changed in your file and you were in an emergency situation or whatever. So you really want to be careful. If it shows that you got wheelchairs and drugs that you never got, somebody's playing around with your medical identity and you got to check it out. And then monitor your credit scores. You can get free credit scores all places now. Your credit card, your bank, all. So, and a lot of us don't need credit anymore because we're not buying a lot of stuff. Well, here's how you use that. If you're cruising along at 800 and you're doing just fine, and all of a sudden the next month your credit drops to 670 and you haven't done anything, there's a good chance you're the victim of identity theft. Somebody's gotten credit cards, run them up to the hilt, maxed them out, and all of a sudden your credit score dropped. So I use that as a fraud alert to let me know if something is happening with my life. That's how I use the credit scores I get. I got 5 minutes left, so I'm going to just finish up with a couple of things. Living in the digital world, we have to realize we are all in the digital world, whether we like it or not. You got to be skeptical and question everything. And now with this artificial intelligence, everything is suspect, especially at election time. Be careful. I guarantee you there's going to be fake stuff coming out. There's a little bit already. It's going to be even worse before we get through. But it's especially with all the stuff that looks like it's from banks and investments. It's all fake testimonials. Anybody can be made to do a testimonial. It's already happened with some big actors. They never did testimonials for these products, but there they were giving testimonials. Looks can be completely deceiving. I showed you how those phishing emails that looked real, they weren't. I tell this to the kids, there is no undo button in cyberspace. If you get fooled and in a rush, give them your social security number and hit submit, it's gone. In the old days, I'd do a story on TV and somebody'd run out to the mailbox and grab the letter and say, thank God you saved me $10,000, or I'm going to stop payment on the check. You do it, you send money in Venmo, it's gone. You know, you do Zelle, it's gone. You do push the button, it's gone. So be really careful. Stop and think before you do anything. Checkbook.org is the nonprofit that I work for right now. They rate services in 7 cities. Seattle happens to be one of them. We rate everything from doctors to lawyers to veterinarians to orthodontists to plumbers to electricians. It's not like Angie's List where people pay money to get listed at the top of the list. We have secret shoppers and we have people who are subscribers who are able to do this and give us the ratings, plus enormous advice free to everybody. I also do a podcast once every other week for them called Consumerpedia. It's a half an hour. We talk all kinds of subjects everything. The one I did Thursday is whatever happened to customer service? Question mark, question mark, question mark, question mark, question mark. And I shared some of my personal horror stories with some really big name companies. I like, American Express, Safeway, a couple companies, Chase Bank. And then we talked to some customer service experts. So you might want to check that out. And my website, consumerman.com, is simply a vessel that I use to get all my information out because it's easier to use for some people than checkbook. So everything I do goes on consumerman.com. It's got my archives. It's got resources. There's no advertising. If you go, when you go there, it'll give you a drop-down menu. If you want to sign up for my weekly newsletter, it's free. Every week you'll know what I'm doing. I'm doing a story. I just did a story this week on a national study on credit card rates and the big banks versus the little banks and the annual fees and how you pick a credit card. So everything I do, you'd get an email from me once a week. Hi, here's what I did this week, and you know what's going on. I don't rent the list, share the list. It's just between you, me, and my dog Sam. So that's all it is. And then because for those of you on the interwebs, because we rate stuff in these 7 cities, if you want to go, and by the way, you folks don't have to worry because in your little goodie bag, you have this, which tells you how you can get a free subscription for 30 days and also about the podcast. So, but for those of you on the interwebs, all you got to do is go to checkbook.org/promo/30-day trial. And if you live in one of these cities, you can see what we do and get the ratings for various services in your area. Anybody can go to checkbook.org and get all the articles. All my articles are free. I write one a week. It's the same stories I wrote for NBCnews.com for 14 years. Really in-depth, really a lot of information. Hopefully save you time and money and keep you from being ripped off. So I hope you'll take advantage of this because that's what we're there for. We just really, really, really like to help people. I think I have time for 2 quick questions. Does anybody have a question real quickly? Yeah. How hackable are password managers? There has been a case where the password manager company has been hacked, but it's all encrypted. They don't even know your master password to let you in. So the logic was they got some stuff, but they didn't get anything that they could possibly use because all the stuff there was encrypted and they didn't get through the final firewall. They just got some of the stuff. The risk of a password, life is risk benefit analysis. The risk of a password manager being hacked if it's a good quality password manager versus what I see everybody do, which is so they can remember it, ABC 1, 2, 3. It's like night and day. I have no concern. And I actually asked, my friend is the head of the cyber lab at MIT. And I said, do you have any, she said, and she used to be the Federal Trade Commission. She said, like, not at all. I'm very, very happy to use that kind of thing. So yes, ma'am. Uh-huh. Right. Uh-huh. Right. That's the world with social media world we live in where they don't, they don't care. They just don't care. These companies don't have a way. Same thing with, I don't know. They must have some kind of thing, but they don't really care. Wow. That's why you got to be so careful. And I have two-factor authentication on my social media accounts. By the way, don't link your social media accounts as a way to sign in, because they're always sign in with a password. And one says, oh, I want to sign in with your Google account. No, wrong. Because A, they're getting all this information about you. And B, if that gets hacked, then everything's crazy. You want a password for all those accounts, not your social media. I got time for one more until Tom kicks me off. Or Don. Oh, Don's going to kick. Don's brutal. Yes. Over to those. Nope. If you have a good password, you cannot memorize it. A good password cannot be memorized. It's 20. I mean, unless you got a photographic memory, it's 20 digits long. It's numbers, it's symbols, it's letters. Just use a password manager or write it down, because if you can remember it, my logic is it's not a good password. Okay. Talking real money. 1, 2, 3, ABC.
Ladies and gentlemen,
Thank you. Thank you very much.
Mr. Weisbaum. Thanks, sir. Now, I have been asked to introduce our next guest. Hang on, I got to see what his name is again. Hold on. I've heard of this guy. Yeah. Apparently he's like been helping people manage money for a really long time. Really long time. Ladies and gentlemen, please welcome to our stage Mr. Paul Merriman.
Thank you, Don. Thank you.
Look at you walking better than me at 80.
I can't believe it. Oh, thank you. Thank you. By the way, in your package, there is a one-page piece here that says how much is enough. And I will be making references to some things that are on that. I was told when Tom and I talked about what I could discuss, the one topic he did not want me to discuss was small cap value. And I just want you to know it was a mistake that a page of small cap value returns are on the back of this piece of paper. But I may, if I have time, spend the last 20 minutes talking about that. No, I'm not. I'm here to talk about how much is enough. At 80, it turns out you don't need nearly as much as you do at 70 or at 60. And so it gets easier and easier as we get older if we've planned. The interesting thing is this whole topic about enough is such a personal, private, subjective thing. Because what might be enough for you might not be enough for your spouse. And what might not be enough for you might be something different than what your kids were planning on from you. So in talking about this, I wanted to find some way that I could put the actual discussion to work somehow so that we would know, first of all, how many would like to have more than enough. I'm just curious as to the emotion, okay? And that would not be uncommon here in this group, because you've all been listening to Tom and Don, and you know about enough and more than enough. It is interesting that when I was first in the industry in 1966, and I taught classes, and I asked young people how much they would like someday, it was $1 million. almost without exception, it was $1 million. And we could say, well, that doesn't make any sense. I mean, why? Well, the reason it made sense was because if you took 4%, by the way, nobody talked about 4% in 1966, but if they did talk about 4% coming out, then 4% of $1 million is $40,000, and the average household income was $7,000. So it was a lot of money. Now, of course, we've had inflation that has caused the cost of living to double more often than we would like since 1966. But when I talk to college kids today, it is amazing to me how many of them, in this next month, I'll be talking to, I guess, April, I'll be talking to about 150, 200 graduating seniors at Western Washington University. And I know how many kids will still say, I want $1 million. Because there's something still magic about that. In fact, I think I had here, I hope this works. Yes. Here's who I learned about money from. Because in my days growing up, it was only Scrooge McDuck who really made any sense. The idea was you had to be able to swim and you had to dive, and it was a big deal to somehow take advantage of a big pile of wealth. Well, what has happened is this $1 million has become something that we still want, and yet it costs about 4 times today or more what it would have cost you for the $40,000 way back in 1966. So what do we have to do in order to figure out what is the right amount? How do we figure out what is enough? I had the greatest 90 minutes of my life, my business life, with John Bogle in 2017. I talked about that a lot because it was a life changer for me. And in that 90 minutes, there was one point that he was very critical of my work, our work. And there was another point that he said something that I totally disagreed with, but never said a thing. And that's the way I would treat John Bogle, because he was this amazing guy who, by the way, had an impact on every last one of us, because whether we ever put a cent in Vanguard or not, the cost of other mutual funds came down because of the work of Vanguard. So he was definitely a life changer, and he had earned respect. So I didn't say anything, but I almost came out of my chair when he started talking about enough. Oh, by the way, what he didn't like that we were doing then is we were showing people how to manage money on their own, because my work, contrary to Tom and Don and their firm, my work is about helping do-it-yourself investors do it better themselves, not to prepare them to work with an investment advisor. And so what he was complaining about is that I was recommending 10 different mutual funds in a portfolio. And several of you have stopped me here today and said that was something they tried, but it didn't work. Why? Because it was too complex, too complicated, too many things to figure out. Well, interestingly enough, that's exactly what John Bogle told me. He said, if you really want to help people, you can't tell them. He was very complimentary of the work of DFA and Dr. Fama and Dr. French. He had no argument with what they had learned about the different kinds of factors that can be taken into consideration when investing. But he said it confuses people. And when it became really important, he would write a book. And one of his books was Stay the Course. And the idea, the thing behind Stay the Course, is that if you're going to be successful, more than likely for the rest of your life, you've got to find a good way to do it and quit looking for another way every week or every month or every year when things don't turn out exactly as you hoped they would. So He believed that I was hurting, not helping. And I believe he was right. But it's what I had learned when I was in the business of managing money for others. So I knew that that was what I believed there, but I had to, and fortunately I had the help of Daryl Balls and Chris Peterson. How many, I'm curious, have listened to the Chris and Daryl's and my work on our podcast? Okay, well, that's great. By the way, Daryl is here today. I know he doesn't want me to introduce him or ask him to stand, but he is the man who turns out over 200 tables for people who follow our work every year, not I. So anyway, Bogle wins on that one. But on the next one, which I did not confront him with my feelings, he said his focus was again a title of a book called Enough. That his goal for individual investors, and truly his focus on all the work that he did, was to help individual investors who did not have a lot, like the institutions who brought millions, maybe even billions for him to manage. He was concerned about people who didn't have a lot of money having at some point in their life enough they can retire and that they would live successfully for the rest of their life and not run out of money before they run out of life. And the reason I disagree is because the reality of a plan and the reality of our lives are that we plan. What's the saying? We plan, God laughs. But that the reality that so many times we do not have the outcome that we had hoped for. And so much of what happens in our particular industry that we have no way to know is going to happen. I mean, this is the part that's so interesting, is people look up to us because we have this ability to understand the market, but then the next thing is in the past. We can't say in the future because we can't know what the market's going to do in the future. Those investment returns are unknowable. We can know them in the past. And one of the things I believe thoroughly is there is no risk in the past. We always know what we should have done. And you will tell us about it after it happens. But the bottom line is that the luck of when you live, when you're born, it's not only what country you're born in or what color you are. I mean, there's a whole bunch of things that we're going to dictate what we might end up having an opportunity to do. I have two little adopted Chinese daughters who, had they stayed where they were, would not have had a great future. Well, they lived in another society where nothing could stop them, at least not so far. And so luck is such a big deal in our plan. But we don't know how to plan for that theoretically. I mean, I can tell you one plan is to just assume you're going to have bad luck and oversave. How many people did that out of curiosity? Yeah. And how many of you are engineers? Yeah. I mean, that's the way it tends to be from what I have seen. So many folks who do know how to plan have a tendency to plan for the unexpected. But let me tell you what happened from 1975. And remember that John Bockel's fund started, the Vanguard 500 started in 1976. So, but from 75 to 99, the S&P 500 compounds at 17.2%. Was he a genius or was he lucky? He was lucky, and he knew that. It doesn't mean it would not have eventually become what it did become, but to compound at over 17% for 25 years attracts a lot of attention. And so you could, if you put away $6,000 a year for 25 years, you would have ended that period of time with about $2 million. But then the person who, having seen that, and there's one of our 3 books that is free. In fact, you've got a QR code here. It's called Spending Your Way to Wealth. In the back of that book is a 16-page summary of Daniel Kahneman's Thinking Fast and Slow, the Nobel Prize winner who wrote a book that was 500 pages long, and I know nobody ever finished it. But 16 pages you can get through. And if you don't read the rest of the book, which is all about what Daniel Kahneman talked about, the biases that we come to the table with. And the biases, I mean, there's so many biases we have that makes it difficult for us to get the returns we should get. And one of those biases is recency bias. And when something's been doing really well, is anybody want to get into cryptocurrency now? Really? I mean, doesn't it feel like somebody was smarter than you? And yet we know it's not the right thing to do. But emotionally, listen to this. Young people believe that cryptocurrency is less risky than the S&P 500. That's what they believe. And it's a big percentage of them believe that, by the way. It's not just a couple. They're all being duped. Well, you know, there are a lot of us that agree with that. Oh, old people too. Yes, old people too. Two old people. So what happened from 2000 through 2023 is the S&P 500 doesn't compound at 17.2, it compounds at 7.1. And your pool of gold for retirement is not $2 million, which probably at the end of that period of time, $2 million with 4% annual distributions would have been just good enough. But now it would be 4% of something less than $400,000 since 2000. I mean, this is not about any of us being wrong about investing. It's just the luck of the draw. My grandkids, as they are born, each of them get a pool of money and I write about this, and I don't keep it secret exactly what I do for them, but the bottom line is I get some money put away that's to fund their Roth IRA from the day they're born. And I also have the parents keep track because they're in two different funds. One fund is the S&P 500. The other fund is small cap value. That's one, Tom. And I want that child when she is 18, for the latest first granddaughter, actually. I want her to be able to see the year-by-year results of those two individual asset classes, how different they are, and what happened over the 18 years. Hopefully, small cap value will have done better, so that she'll understand there's a reason to have that in there, and that the S&P 500 isn't necessarily the answer for everything. But the bottom line is to plan for more than enough isn't easy. But here's what we can do. We can understand. Oh, I think I'm supposed to change something here. By the way, those three books are the three books that we offer free on there's a QR code on the back of that page, or you can go to paulmerriman.com. Those are the three books that we hope help young people and older people do better than Scrooge McDuck. So, the battle for enough. It is not an easy battle. And what we know is that there are three returns that are going to face you, potential returns as an investor. One is that you're going to get, and boy, wouldn't this be wonderful? You would get market rates of return. How many people would be happy with market rates of return? Those are indexes, folks. How many people would be happy with index fund returns? Okay, I mean, that is what most of us here would believe, because I think that's what Don and Tom talk about. And that is called the investment return. And there are so many forces that are trying to keep us from getting that return. When I came into the industry in 1966, they took an 8.5% off of a load on a mutual fund purchase. That was huge. And when you were trading stocks, you could trade a relatively few shares of 100 shares of IBM, and the commission was $175. Almost everything that was being done for the people on Wall Street, not for you. Now, since then, that has changed. And between index funds and low expenses and target date funds and ETFs and all of these things that have been designed and created since 1966, you actually have it's not perfect, but it is so unbelievably close to market rates of return. To the extent that I should be able to tell you that you and your children and grandchildren should do better in the market in the future than you have in the past, because the expenses are so low. The taxes are so low. So, first thing we have had to do is to fight to get Wall Street to be fair. The next thing we have to understand is a part of Wall Street is still there, hand raised high, take me, take me. I'm an active fund manager. I want to show you the way. Now, it's really easy for them to make that pitch when they just had 10 good years. It's kind of difficult if they just had 20 bad. But the bottom line is, here's what we know from the SPIVA reports. And if you've never looked at the SPIVA reports, they come every 6 months from Standard & Poor's. And if you just do a search, SPIVA, SPIVA report, you are going to see how funds did for the last year and the last 20 years. And it's going to compare how the actively managed funds did compared to the indexes that they were supposedly trying to beat. And only about 1 out of 10 or 1 out of 20 is able to do it. Which means when you go with an active fund manager, you are betting that they are going to be one of those 10 or one of those 20 people. And by the way, if you're in a taxable account, it's almost impossible, because you can look at Morningstar, how tax inefficient those actively managed funds are. You look under the page of price on Morningstar of that particular fund, and it will tell you how much of its earnings is going to go to Uncle Sam instead of you. Index is very small. Actively managed, maybe 3-4 times as much. So it is really hard for the active managers to make a case for themselves. But you have to be able to get by them and do it the way it is, put the probabilities in your favor, not in theirs. Now we have one more hurdle, and it's absolutely huge. And it's you. As Jonathan Clements, one of our 10 truth tellers, says, that the biggest enemy you have is the face you see in the mirror in the morning. That's paraphrased. But it's true. Because we come to the table with so many feelings, we hate to lose money. How many people hate to lose money? Yes. And what surveys show or studies show is that loss aversion is so great that a lot of people will not go into the stock market at all, because you could lose lots of money. And they are absolutely right on the short term, but if you do it right, they're absolutely wrong on the long term. And in fact, the fixed income things that are so good on the short term are terrible for the long term. So the hurdles that each one of us face can cause us to go from an investment return. Oh, by the way, I did not make the case. A lot of those mutual funds that underperform on average the indexes by, let's say, 1% a year, maybe 2% a year. In order to come up with an average of a loss of 1 or 2% means you have to lose more. And the reality is that means you might be in that fund or those kind of funds. So it's not just a matter of underperforming maybe by a little bit. It may literally be 2, 3, or 4%, but for 20 years you could underperform the index itself. And there's nobody in this room that's a professional that wants you to do that. So there's the active managers who create a hurdle, and then you create a hurdle because you panicked when the market went down in 2008. It's human nature. And so the question then becomes, how are you going to stop that loss? Because there's a study that says that individual investors, after the funds don't do as well as the index, individual investors even do worse, like all the people who got into the ARK fund at the peak and lost a ton of money. And then concluded, well, that was too risky. And they get out. And the story starts all over again. Now, it seems like, and I'm not making fun of the engineers when I say this, it seems to me that people who understand evidence-based buy and hold does not mean market timing. I don't mean you can't adjust from fixed income and more fixed income. I'm 50% stocks, I'm 50% bonds. That is my glide path from here on out, 50-50. And it's not because I need it, it's because I've committed so much to others after I die. Unfortunate part is the sooner I die, the better off they are. It was a bad decision on my part, but I'm going with it. So the reality is that for many people, including me, because I have loss aversion too, and if left to my own devices, there will be times, even if I said, I promise I'm a buy and holder, that I'm not going to act like it because I'm going to succumb to what they call the ICSIA market timing system. I can't stand it anymore. And we all know that feeling. And sometimes it doesn't even come because we want to feel that way, but we have somebody in our life who doesn't have the same risk tolerance that you do. And is literally scared to death that they're going to be running out of money. And I don't blame them. Humans think linearly. That's just our nature. And so it is my belief that for many of us, okay, we're going to have a compromise here. This is what I believe. I don't know that Tom and Don will tell you the same thing. I don't know what their belief about this, but this is my belief. That if what I want is the market return, and if they find the most efficient market return, and then charge you a fee to manage it for you, you are not going to get the market return. I know that, and still I want somebody to do it for me. Because I know that it is not about, people shouldn't be comparing the investment return with what they're getting. If they're doing it themselves, very likely they're not going to get market returns or the investment return. They're going to get some return that is adjusted by how they act, how they feel, how they respond to the pressures from salespeople who have got a better product. Is my time up? Well, not in the big picture. Oh,
You're okay. It's good.
Oh, it is. It's not.
All right. So we're gonna take a couple of minutes. Let everybody get their lunch. Then when we come back, we're gonna do a couple more drawings, and then Paul and I are gonna have a little Q&A. So go. Lunch
Can I
is
say
down.
one last thing?
Yes, of course you can.
Please see the small cap value page carefully. Thank you.
Thank you. So we're going to have a little lunch Q&A with my friend and colleague, Paul Merriman. Some of you know that Paul was the one who got me into this business in 1987. No, 97, pardon me. I'm not making, but I met Paul after I heard him on the radio in 1988. That's when I called you originally. But so we've been colleagues in some ways, partners in some ways, and friends. It's a meaningful friendship. Truly is. First of all, Paul turned 80 in October. I mean, how many of us are going to have that kind of energy at 80? That is, I got to say, that's awesome. Really is. So well done.
All possible with drugs.
It's all possible with drugs. Better living through drugs.
That's right.
Okay, but so you set up Paul Merriman and Associates in 1983, which became Merriman Capital Management, which became Merriman Berkman, which became Merriman Berkman next, which became Merriman. So anyway, it's a long run. But 1983, how different is this industry than it was 40 years ago?
Well, it's huge because what was expected of us in 1983 was that we would make stock investment recommendations. You didn't have to be a financial planner. You didn't have to do the rest of the work. And in reality, if I had to be a certified financial planner, I may never have gotten in the business because I did not have an interest in all that other stuff. Now, the people who worked at our firm, they did have an interest in order to get paid. So we had somebody that, just like you have lots of people who now do stuff that was not even thought of in 1983 as a responsibility of an investment advisor. And so that is huge.
What about the investment product?
Well, the investment products, you see, you really didn't get DFA, for example, and even in 83, Bogle hadn't caught on. Vanguard really hadn't caught fire yet. And so you were still talking about actively managed funds. And so that, of course, was the playpen we had to play in. But now again, look how today, lower expenses, more diversification, which leads to and less turnover, which leads not only to lower risk, but to lower taxes and so many things. And by the way, I think also when I did a podcast entitled The Number One Reason to Invest in Index Funds. And we literally have had over 1 million opens of that podcast. And what it tells you is the number one reason to invest in index funds is so you don't ever have to talk to a stockbroker again. Now, the article was longer than that, but that was the bottom line. But there's real value in not ever talking to a broker again, or somebody who is going to easily try to sell you something that's been performing well lately, and they get you chasing recency bias, which is so human to want to do that. So as far as I'm concerned, today you perform a service that just didn't exist in 83.
Okay, so that's a good transition because I said I wanted to ask everyone here to help you if possible. So your foundation is a not-for-profit. I mean, and you're not paying yourself for all the work that you do.
Neither is Daryl.
Daryl's working. He's
not
hustling. You guys put out a ton, not just the podcast, all the writing, which work with Rich Buck, who we love to death. All the paper, all the numbers, which I know you love. Yep. By the way, Paul used to do, some of you maybe have attended, Paul used to do a 6-hour, I sat there, 6-hour class on all those that one sheet he showed you numbers. There were pages, and I still have one of the handouts, a page and page and page.
I loved it.
You missed that.
I do miss that.
Okay, I thought so.
I do. But what we do now is right now we just started a series of podcasts. Each one is about 45 minutes to an hour that talks about the 8 major biggest decisions you're going to make as an investor.
Which give us a couple of them.
Well, I mean, the stocks versus bonds. I mean, it's
Yeah.
huge, the implications of stocks versus bond. Certainly the amount of beyond just the stock versus bond is the question about how much, well, what equity asset classes you should
Yep.
be in.
Okay.
I am
You're good.
good. Are you sure? So that in the old days, or if you followed John Bogle's advice, you only need one fund for the
Yeah.
rest of your life, and maybe a bond fund to go along with it. But the folks at DFA, I went to a class back in the 90s that just set my heart free. I mean, it gave me a feeling that there was absolutely a better way to do this. And John Bogle, we had him on the radio show.
Yep, several.
He did not really want to change that story. He wanted to stay on course, stay the course.
And so, I mean, that has led to a crusade of yours, which is, and I can tell you without looking at most of everybody's portfolio here, that they don't generally own enough smaller, crummy stocks.
Yeah.
Right? You don't. I mean, because it's just a lot easier to own the S&P 500.
Yeah.
And the biggest index funds are really basically the S&P 500. And the money keeps piling into those. And now you pointed out, Paul gave me a list of questions I was going to ask him, which I'm following.
Wait a minute.
Of
Wait a minute.
course. But one of them was core performance of the Standard & Poor's 500 since 2000. Now, I looked it up. The Standard & Poor's 500 has made about 7% a year since the year 2000, which isn't horrible. But conversely, U.S. small companies that are value-oriented have made 10 in that period of time. And yet most of you don't own that.
Well, let me say more. On the back side of the piece of paper you got, I'm not kidding you, this page, I didn't know this was coming when Daryl sent it. Because I'll ask him, I wanted to see.
It was the afternoon, so good.
No, I'm almost done. On one hand, you have the S&P 500 1 year at a time since 1970.
This is the 6-hour class which I spoke.
Picture that. I'm almost done.
Take your
On
time.
the right-hand side is all small cap value, 1 year at a time since 1970. And then it shows you along in between 10% increments, 10% small cap value, 20% small cap value, 30, 40. You can look at the combination of the S&P 500 and small cap value going back to 1970, and I can guarantee you cannot buy that performance. But that's the same thing we have to say about anything that we talk about the future. We cannot guarantee that performance, but I can tell you this. On the far right-hand side is something I had never seen before. That is each year who won and by how much. So I can look at the first 10 years and see that small cap value outproduced the S&P 500 7 times out of 10. But the next 10 years, it was 6-4 in favor of the S&P 500. Then it was 7 out of 10 in favor of the S&P 500. Who wants to have small cap value when 7 out of 10 of the last years? People focus on the short term.
Yeah.
The idea is to get a picture of the long term. And we even have other studies that go back to 1928. Wouldn't that be better?
And only you and Don were there for that, so I don't know how that works out. So, is that recency bias or
are you sexist as well?
Ageist, sex, whatever it is? It's all. Okay. So, but the place I was trying to go is about the foundation.
Yes.
And all the work that you do. So, for those of you who don't know, in addition to the foundation, Paul, and I think I have this right, just agreed to give $3.5 million to Western Washington University. And they're going to keep the statue of you on the campus, from what I'm told. All kidding aside, what is that money going to?
This is the most exciting project of my life. This is to get the project going at Western, where every student, and it's in the process of happening right now, every student who comes through Western will be exposed to 40 hours of financial literacy. So, yeah, it goes beyond that. It also includes outreach within the communities that Western has an outpost, and there'll be classes for the adults, in essence, the parents of the students. More than half of the students who come to Western as freshmen are first generation college kids. It's remarkable.
Wow.
What the opportunity is there. And to make it even better, I mean, I only offered money and asked them for a proposal. It also includes software in a database that they will use while they're at Western. And when they not retire, graduate, I'm getting these words faster. When they do graduate, they get to take that database with them and use it. And it also includes my responsibility to educate the staff at Western too. So this for me is like heaven. I never thought we had a prayer, but my wife and I started to support, and then the foundation supported a class at Western. But we were only getting to about 200 students a year because they could only take so many people in the class at a time. Now all of a sudden it is 15,000 kids.
That's awesome.
And
Well
their
done.
and their kids, and by the way, there's a study done about how much could be saved, or how much would the return be on having financial literacy classes at the high school level. And there's a lot of work being done on that right now. 25 states now require it to graduate. And an organization called ngpf.org, Tim Ranzetta, is providing free curriculum and free teacher development. And that firm even hires lobbyists to go lobby the politicians to get this passed.
Okay,
he-
which is great, but
Yes.
just in a general sense, because I've raised children and now in my grandkids' lives, which is great. And by the way, I should thank you for making me a truth teller. I assume that refers to my other occupation as a soccer referee, correct?
No, I couldn't do it there.
Okay.
Uh,
I was hoping, but give us 3 of the things that we could all take away that we could work with the next generation, young people, to get them interested in all this. Now, I've got one, my son is an advisor, so he's had an interest for a long time, and he's always been a great saver. His sister, who's here, who's a lovely person, not as much. But it's just a mental, it's emotion, it's who they are. But how do we give us 3 of the things out of all that we could take away to help young people get on the right path?
Well, let me take it all the way to the right here for a second. We are getting older. We have a lot of money, and now they are more than just children. They are young adults we're talking about, and we're concerned. Oftentimes, maybe you have 3 kids, and 2 of them you think are competent to handle that money, and the third one maybe is not. And so I suggest this approach, that you go to the one that is not very good with money. They know they're not very good with money. They'll tell you they're not very good with money. And what you tell them is, look, your mother and I are working on our wills now. And one of the things that we want for our kids is that what we leave them is going to really secure their financial future, almost, if you will, like a person having a pension, where they know that there's going to be something coming in over their lifetime. And that we're concerned. We're concerned. And one of the things your mother and I are watching, we're trying to get a sense of how you're dealing with your decision-making around investing. Because if you really can't get it and prove it, in essence, to us somehow, what we're going to do is we're going to do something we think is honestly in your best interest. And that is, we're going to put the money that goes to you into what is, in essence, a pension. We're going to buy you a lifetime income because we know that people who have pensions feel secure because they have pensions, right?
Yeah, right.
I mean, it's a big deal. And wouldn't that be what you would want for the kid that you were afraid was going to screw up the money?
Okay, so they get a pension. What else? I mean, but how do you help them?
Well, okay.
And like you brought up the high school.
I'm
where
trying
do you
to
start?
I'm trying to just use some leverage. I'm
see.
I'm
Okay.
offering, in essence, paying or suggesting there is
Okay.
a financial reward.
Which I love, by the way. For those of you, we talked about this on the podcast not long ago. Delta Airlines has a financial literacy program for all Delta employees. I think there's one here. So I met with you earlier. They pay you $1,000 to do it. And guess what? 30,000 people have done it. They wouldn't have done it before. Well, here's $1,000 if you go through this plan. They're
Totally.
incentivized.
I totally agree with that. I do think a cheaper thing to do is to give one of your children who's probably at least 18 a copy of We're Talking Millions, 12 Simple Ways.
Oh, I knew this was going to be easy. Sure.
No, I did. This is instead of Small Cap Value. Give them that book and maybe incentivize them with something. I don't think $1,000.
Okay.
We have had high school. In fact, there are testimonials, book reviews that I did not pay for on Amazon for that book, written by high school kids who read it and then went on to say, here's what it led me to do.
It's great. Those are up on the website.
I'll have to check with my kids.
Okay.
No, I'm
By the way,
my kids.
the website of which I mentioned is paulmerriman.com. That's
Thank
where all the goodies are. And that's where you can help. I know you don't like me. He's uncomfortable with me doing this, but as I said before, he doesn't take a salary. Daryl, none of these people are getting paid to do this fine work, but it still costs money to operate everything. So if you could find your way to giving a small donation there, I think it'd be great. So I'm giving one based on your work today.
Thank you.
I haven't given it
Thank you.
yet. So you might want to wait.
Take that back.
All right. Okay. Couple more questions. Number one is, when you look at our industry today as registered investment advisors, you mentioned planning centric, better investment products. Where is this going? I mean, where do you see this in 10, 20 years? How's it going to look different?
Well, I don't think the people who are hurting people more than they are helping them are going to exist, or they're going to have a very, very small business. Right now, look at target date funds, the best investment product ever developed. I don't mean it's perfect, but there's nothing else that allows a 21-year-old without knowing one more thing than that they're going to retire in 2070.
Right.
And that you put money in there on a dollar cost average basis, hopefully in a target date fund that's built with index funds, and they just let it go. And then, as you probably know, the target date funds continue to work for you for the rest of your life.
Yeah.
Now, the fact that I'm 50-50, but Vanguard would make me 70-30 means I can't use their target date fund, but for a lot of people, that would be just fine. That plus indexing is now more than half the money that's going in the market today is indexing.
No, in the market.
In the market.
Not going in of the holdings. Just that's what I read. Half of the money that's invested in funds is now, more than half is in passive indexing strategies.
Well, I haven't gotten my lunch yet, so I'm going to.
All right, and we're just out of time.
Oh,
so you're going to agree because you think I'm gonna hold that back? That's good. Because we got to go. But you've done this, as I mentioned, 40 years. You're now doing this without any compensation. You're trying to help all these people. This doesn't mean we're not going to see you again, but what is the Paul Merriman legacy?
Well, the Paul Merriman legacy, one, is hopefully going to be an organization that stays after me. That is my hope. Second thing is the program at Western Washington University. I'm speaking to 19 institutions this summer about this financial literacy. My hope is that I can convince people who have the ability to write similar kinds of checks to sponsor this kind of a program at other universities. I think it's really cool that the first one to do it is Western, because that's where I graduated, and I love Bellingham. I love that school, and that did so much for my life. But but that will go on because we're leaving enough money that it's
Good.
supposed to endow. So I want to find other people to endow elsewhere if that's what they want to do. And I'm sure I'll be out begging for money for the endowment at Western because they're raising money for more. We can't pay for the whole
Right.
thing.
Yeah.
Um,
Good. We've got to conclude there.
I know. We got to go.
Please, Paul Merriman, thank you for joining us.
Thank you.
You need to go see Beth to give her your microphone.
Oh, yeah.
Yeah. Mm. How is lunch, by the way? Is it good? All right. You know, when Don writes the ads for this, he always spends more time on the lunch, which always, I mean, it's the greatest lunch of all. Then I think, God, what if it's disappointing? Then people are going to be mad, not the speeches or anything, but the lunch, they're going to be really mad at us. So I'm glad it's good. And we're glad you're all here. And as a couple of program notes, as you may be aware, in room 403 right now, Don is doing the show. For those of you who want to go in there and heckle him, this is a great time for that. Ask him very difficult questions about his past that he may not want to talk about or some other painful topic. There's a microphone there available for that. After he concludes at 2:00, we're going to have another session about the Apella client experience. It was well attended this morning, but if you'd like to join Joyce and Derek for that, that's available as well. We have some great speakers this afternoon, starting in just a moment here with a member of our legal community is going to talk about all those fun things like your estate, etc., which is something you should not ignore and should spend enough time on to get it right, no question. So those are things coming up. We still have our advisors out, and I should have mentioned this earlier. I apologize, but they're happy to take one-off questions on anything during the day. So they're all here. And somebody suggested I give them Monday off, and I said, no way. So take advantage of them today. Take advantage of them in the future by getting one of the Retire Meeting, which we offer you in your handout. The other thing in the handout that I mentioned briefly is the Tune Out the Noise. I see one of them right there. That's the film made about dimensional funds, which is a remarkable film. It's really great. Look, you saw Don's history of sort of investing of the industry, but it's a fantastic look at the people that really changed the industry. Now, Paul's not in there. I think he should be, but it's people like that looked at the academic work and said, what does this mean to me? What does this all mean to the rest of us in a meaningful fashion? So it's a film well worth watching. As I said, it's on the handout there. It'll help you with all that. All right, we are ready to get going again here. So our next speaker is going to talk to you about the things you've got to pay attention to in retirement, and that is around your estate, whether it's wills, trusts, etc. She is a super lawyer. She's a member of the National Organization of Estate Planners. I think I have that right. Estate legal. You'll have NAILA. I kind of get that right. And she's also a mom to 2 teenagers, although in her bio, she calls herself a dog mom. So we'll have to ask her about that. Beth McDaniel, thank you for joining us today.
Yeah. Thank you. Well, good afternoon, everybody. It's such a pleasure to be here. Hope you've been having a good day thus far. And I know that these wonderful folks, Tom and his crew, have done a wonderful job at preserving and growing your wealth. And so now we're going to talk about the most important thing, and that is how to pass on your wealth to the next generation. My daughter goes to a school here in Bellevue, and this fall, a Seattle police officer came and spoke to the parents for 2 hours about social media. Now, granted, I was only there for the first hour, but she was so engaging that it took 2 hours with all of the questions. So if you thought her this morning was eye-opening, that was certainly eye-opening. But one of the takeaways that I had for that presentation is that you do not ask a teenager or a room of teenagers, how many of you are addicted to social media? Instead, you ask, How many of you know someone who's addicted to social media? So I'm going to use that and ask, how many of you know someone who doesn't have an estate plan? Well, I should be seeing more hands. Caring.com, they do an annual survey, and according to their survey for 2024, only 32% of U.S. adults have a will. So it is an issue, and we could talk a little bit as time allows as to what happens if you don't have a will. But what we're going to talk about today mainly is, as far as an estate plan, a will, versus a trust, and what would make most sense for you. So first of all, what is a will? Now, I think safely everybody knows what a will is. If you've ever seen a movie or read a book, there's inevitably, someone rich who dies, and a lot of them, and they have the reading of the will, which, fun fact, there's no reading of the will in real life. That's only something that happens in books and in the movies. But traditionally, the definition is a written document that defines who shall receive the decedent's property following decedent's death. So that's all that a will has to say. I had a will that I probated, and all it was a piece of paper. It said, Bill gets everything, nothing to Paul. That's all it said. But the key is that it had 2 witnesses. And so I thought for sure that Paul was going to contest it, but he did not. And so that was admitted as a proper will. Something to be aware of too is that in Washington, it doesn't even have to be in writing. It could be an electronic will. So that could be, I guess, a recording. So that came into our state in 2022. And I don't know of anyone, frankly, who has ever done a will like that. So, because the legislature added a special condition on that, and that is that there must be a qualified custodian that can certify that they have retained the electronic will and that the will was always in their possession. So there's not a lot of folks who are, willing to do that, and that could not be a family member or an heir in the will. So really, that's limited in the scope of it. But I can see that happening. I have had a few situations where finally, someone's in their last, final moments, and is finally, accepting of the fact that, they're going to pass away, and so I could see that possibly doing that. Getting some type of recording, because I have had situations, unfortunately, where, you go scramble back, draft a will, hurry back to the hospital, and it's too late. Either they pass or they are no longer competent to sign a will. So this would enable to capture someone's final wishes along that. I like to say you should spend your final moments with your loved ones and not with your lawyer. So I'm going to be sure to plan that. So that is what a will is in Washington. So what is a revocable living trust? There's obviously a lot of different types of trusts, but for this presentation, I'm going to focus on revocable living trust. So a trust is kind of a triad of 3. The first is the trustor, sometimes known as the grantor or settlor, who establishes the trust. And then they transfer title in the assets to a trustee to manage the assets in the trust. Oftentimes, the trustor and trustee are the same individual. The intention is that they maintain control of the assets as long as they're able to do so. And then they manage it for the beneficiary. And oftentimes, with revocable living trusts, the beneficiary is the trustor as long as they are alive. Revocable means that they have the right to revoke or amend the trust during their lifetime. Also, of course, they can do, transfer assets out of the trust, amend the trust. They have the ability to do that. And then upon the trustor's death, the trust is irrevocable and directs the disposition of the property. A couple of other things to keep in mind with a trust, a revocable living trust, is that, as I like to say, it's invisible to the IRS. In that you use your social security number as far as the tax number, for the trust. Now that can change if you're married after the first death, and we'll talk about that. Also, unfortunately, it doesn't have any extra, creditor protection. So, just because you have assets in a revocable living trust doesn't protect them from, creditor in the event of a lawsuit. So, other parts contrast between a trust and a will. And by the way, if you do have a trust, you do need to have a will. It's called a portable will. If you want to visualize a picture, and essentially that will says, "I leave everything to my trust." I tell clients, I think of it as the safety net beneath the tightrope walkers. You never want to have to use it, but it's there. And the only time it would have to be used, well, I guess there's 2 times, is that if an asset over 100,000 that was in the decedent's sole name was not in the trust, then that would be used to probate that asset and bring it into the trust. And another possibility is sometimes an executor needs to be appointed in order to sign an estate tax return. And so we do have 2 different estate tax to worry about in Washington, by the way. We have a state estate tax for estates over 2.193 million. We're supposed to have a $2 million estate tax with an inflation rider. But in 2018, the Consumer Price Index that's used for that, the name changed from the Bellevue, Tacoma, Bremerton Consumer Price Index to the Seattle, Tacoma, Bellevue Price Index. And so instead of making an administrative change to that, our estate tax is frozen at the 2018 value. And so you see cost of living increases with Social Security, et cetera. The federal estate tax, ours is frozen at 2018. And from talking to folks, that's unlikely to change just because there's so many different political bents, on that. Some people want to overhaul, but yeah, that could just simply be an administrative change. And so that's important to realize. And then of course, we also have a federal estate tax. And in 2024, it's for states over 13 million. So less than 1% of the population. And that is set to sunset. And if it does, then it goes back in 2026 to half of that, so about 6.5 million. So we'll see what they do federally. So another consideration with regards to a trust versus a will is the public nature of them. A trust does not have to be filed or recorded with the court or with the county recorder, but financial institutions may require certain pages of the trust. In Washington, you can have a document called a certification of trust. It's kind of like a one-page summary of the key parts of the trust. So that's typically that document itself is the public document for the trust. Whereas a will does become a public document. Books have been written about the wills of celebrities, because once a will is filed with the court, that is a public document that anyone can grab a hold of. With a will, however, unlike a trust, financial institutions, et cetera, aren't going to require a copy of the will. They're just interested in a document that's provided by the clerk's office called a letters testamentary, which is kind of a one-page official document that the executor can act. So who can serve as a personal representative? You have to be over the age of 18. My son just turned 18. It's like, oh my gosh. I cannot, but nevertheless, 18 is an adult in our state. It's okay. You don't have to be a resident of Washington. You just have to appoint someone locally. Often I do that for my out-of-state clients who could serve as the agent for service of process. So if the estate is sued, there's someone in state that can be served. A trust company can serve, a national bank, a law firm, nonprofit corporation whose bylaws allow them to serve as a personal representative. And then there's individuals who can't serve as a personal representative. A corporation can't serve. Persons of unsound mind. Not sure of the definition of that, but I guess we need a doctor's letter to say no, they can't serve. A minor, so a child under the age of 18 can't serve. Or a person convicted of a felony or any crime involving moral turpitude, so theft, fraud, embezzlement. And this happens, doesn't happen a lot, but it happens more often than not, where I have a client in their 60s and I have to tell them, I'm sorry, but that, you know, that happened when you're 18 is preventing you from serving. So things do catch up. Every once in a while, I have someone, depending upon if it's a non-violent crime, they can get it expunged from the record, but those crimes will prevent you from serving. So who can serve as a trustee? The same individuals that can serve as a personal representative, but in addition, a college can serve, or any other entity authorized by Washington state law. And as far as who can't serve, a corporation not organized in Washington, a minor, persons of unsound mind again, and persons convicted of a felony or a crime involving moral turpitude. So just want to contrast some of the difference between serving as a personal representative versus serving as a trustee. So what notice requirements do you have to give, and how long is the period in which you can contest a will or a trust? So a personal representative must notify the heirs, legatees, and designees, sorry about the typo, within 20 days of his or her appointment. So heir is basically your next, for lack of a better description, next of kin. And so in Washington, that goes as far out as issue of first cousins. And if there's still no relatives that are, if there aren't anyone that after going to the, spouse, children, siblings, nieces and nephews, grandparents, aunts and uncles, first cousins and their issue, if there's still not anyone, then notice would be given to the state of Washington. And so the executor or personal representative has 20 days after their appointment to give notice to those individuals. A legatee is defined as someone who's entitled to personal property. And so if the will specifically bequeaths to them, and personal property is, of course, tools, cars, jewelry, household items. And a legatee, or rather a designee, is someone who is entitled to personal property. And so this can be a little tricky, because I have clients who don't like their family, or they don't really know who their relatives are. And, if they don't leave, if they're not the beneficiaries of the will, we still have to give notice to them, so that they can have opportunity to contest. And, when you call someone and get a hold of someone, they find on social media and say, hey, can I get your address? And, by chance, could I get your siblings' addresses? And once they know that they're entitled to nothing, then, click. So that can be a challenge. And in order to contest a will, a petition must be filed in 4 months. And so, as I like to say, 4 months goes by, pretty quickly. As far as a trust, the trustee must inform the qualified beneficiaries of the trust within 60 days of them accepting trusteeship. And a person may contest the validity of a revocable trust upon the earlier of 24 months or 4 months after receiving notice. Peer recently told me, when in doubt, get notice out. Because you want to close, that opportunity for someone to contest the will, and you want to be able to, or a trust, you want to be able to administer it without, that hanging over you. So as far as what the notice to a trust beneficiaries needs to contain, it must have the name and date of the trust, the identity of the trustor or trustors, the trustee's name, address, and telephone number, notice of the time allowed to commence a proceeding, and then the right to request such information as is reasonably necessary to enable the notified person to enforce his or her rights under the trust. And this is a relatively new requirement in Washington. And I think it's a good thing, that someone who is a beneficiary in the trust, that they do indeed receive notice of the trust existence. And so it would be kind of a strategic thing then to, if a child is excluded from the trust, to give them notice, again, to shorten that, 4 months, 2-year period to contest it to 4 months. So what are the duties of a personal representative versus a trustee? They initiate and oversee the probate or intestacy proceedings for the estate. And intestacy is, when someone dies without a will. And essentially, what happens there is that if you're married, everything that you acquired during your marriage from your earnings is considered community property. And so 100% of that would go to your spouse. But if you have separate property, so property you had before you were married or you received during your marriage by inheritance or gift, half of that goes to your spouse and half of that goes to your kids. A quirky thing in Washington is that if you have separate property and you're married and you don't have kids, then 20% of the separate property would go to your parents and or siblings. So it's a little quirky outcome of that. It's optional in Washington to send notice to the decedent's creditors. If you don't send out notice, then there's a 2-year period in which an unknown creditor can make a claim. If you do send out notice, then that period is limited to 4 months for an unknown creditor. I have a number of estates where we don't send out notice. It's like, no, my mom did not owe anybody a cent. Or I handled my mom's, finances for years. There's no creditors out there. But of course, if, mom or dad had a couple car accidents before they died, or if they do have some, credit card debt, then we want to send out notice. Likewise, if you are administering the estate for a friend, it would make sense to, publish notice. You're responsible to file and pay the decedent's taxes. And with both a trust and a will, you get a new tax ID number, as of date of death. And so there's kind of 2 different sets of taxes. One is the decedent's, final taxes. So if someone passed away today, there would be a final, 2024 return, through today's date. And then from, February, 25th onward, it would be filed under the estate or the trust. They need to maintain the estate assets or the estate assets and pay administrative expenses. So the legal fees, the final burial expenses, etc. If there's an estate asset, if there's a house that's not occupied, making sure that it's insured, making sure that there are signs, that someone is living in the house, that the yard is being maintained, until the house is sold. Gather, secure, and inventory the assets. Pay or otherwise, settle their debts. And manage the assets of the estate during the probate process. And then ultimately, once the taxes are paid, once everything is sold that needed to be sold and consolidated, then we make final distributions to the heirs. Now, my practice is that, if a major asset is sold, like a house, then we'll make a partial distribution, because obviously with FDIC limits to $250,000, typically there's not a big reason to leave a lot of money, into the account. And likewise, it's my practice that we provide or help our clients with preparation of a final accounting. So essentially what came into the estate account and what went out and what is remaining to be distributed. So what are the duties of a trustee? So trustees have the duty to act with the highest degree of good faith, loyalty, and integrity to the trust beneficiaries. So it's a lot more noble, I guess, in my opinion, than an executor. And by the way, I bet if I polled the room and asked, how many of you have been an executor, and then followed with how many of you would do it again, the only hands that would go up the second time would be engineers and CPAs. It's kind of a thankless job. It's a lot of work. Administer the trust property with reasonable care and skill. Maintain complete accounts and records. And uphold the trustor's intent and act in accordance with expressed terms of the trust instrument. receive, property into the trust or any fund according to under the provisions of the trust. Keep all trust beneficiaries reasonably informed. And in my experience, aside from the recession, which I'll talk about in a moment, oftentimes with both a trust administration and a estate, the last piece to resolving it is the taxes. So if someone, passed away on December 30th, then it's, easy to resolve the, final income taxes, first part of the year, and easier to wrap up the estate. But if someone passed away, in March, then you're having to wait until, January to get the tax documents in order to wrap up taxes. During the recession, what was holding up closing estates was, real estate wasn't selling. That was a real drag. So it was nice when that finally cleared up. So as far as what happens when a estate is settled with a will, the personal representative petitions for their appointment. As I mentioned, notice is given. Already talked about creditors. And as far as them being discharged, typically they're discharged 30 days after a document is filed with the court called a declaration of completion. There are ways to close an estate that require a hearing, but I only do that in the most acrimonious of estates. I have one right now where the 3 siblings do not care for my client at all. So we're definitely, noting it for hearing, so that way, they have an opportunity to show up if they'd like and object to anything. So as far as settling a estate, in Washington, that once everything is consolidated, and like I say, so everything has been sold that needs to be sold. In Washington, the trustee can send to the beneficiaries a proposed plan to distribute the trust assets, and then wait a 30-day window to determine whether or not anyone objects. That said, the other option, which I think is more common, which is I do, is to send the beneficiaries a final accounting and have them signing a receipt release and waiver. And so that way, they're basically saying, we accept this final accounting, and that you should be discharged without any, we waive any rights to seek liability or pursue liability claims against you. So as far as closing and administration with both a trust or a will, it may continue on if there are subtrusts, for example, for a minor child, or if there's or perhaps a spouse, a disabled person, an irresponsible child. And if that is the case, then they may continue on and continue to be the trustee of that subtrust. And so oftentimes the trustee continues on in that vein. I was talking to one of the financial advisors, Justin, who's on the board of a nonprofit trustee. And I have referred a couple clients to him recently, where the client learns pretty quickly that it's not going to work for them to be the trustee. So like the client's brother, demanded to go, first class to Thailand. And as soon as he landed, he, called demanding more money. It's like, this is just too stressful. I can't do it. And so there are, third parties that are willing to do that in that situation. But of course, it's preferable to have trust provisions in for minor childs or disabled individuals, because the alternative to not having a trust for a minor is that the court gets involved and appoints a conservatorship or conservator for that child. And then the money remains in conservatorship for that child, typically in blocked accounts. And then when that child turns 18, they get the money. And I don't know how many of you have seen a lot of money in the hands of an 18-year-old. It's generally not a good idea. But the court, they're tied as far as being able to do anything further. So if you have a trust for a minor child, You can say that the trust continues until the child's 25 or 30, 22, just at an age that you feel that they would be more mature to handle it. And of course, the trustee can pay for school or any other need that they had, during the duration of the trust. And with regards to a disabled individual, especially if they're on SSI, it can be very detrimental if they receive an inheritance because they can only have, $2,000 to their name. If they do receive funds, greater than that, if they're over, under 65, then we can establish a first party special needs trust. But what happens there is that when the beneficiary dies, then basically the state is reimbursed for expenses that the state has paid on behalf of that adult, after the age of 55. Versus if you have a trust set up a special needs trust in your trust or will for that disabled person, then you can state what happens to the money if they pass away and there's still money remaining in the trust. So what are the benefits to doing a trust versus a will? Well, with regard to a trust, it provides incapacity protection, which can mitigate or avoid a conservatorship. It can avoid probate if it's fully funded. And that can be particularly important if you have, property in other states. Some states, like in Washington, you can do something called a transfer on death deed, which may or may not, work for you. But in those states where that's not an option, like if there's a vacation property in one state or piece of the family farm in the Midwest, having that all in the trust will avoid probate in every state. It's a private document, and it can provide financial exploitation protection. This last one is, really important to me. I had a period of time where just in a short window, I had 5 women who were exploited by a neighbor, and or a caregiver. With our culture, being different and, the kids, don't live next door and you're not seeing them, every day. It's very easy for someone to move in and take advantage and persuade, hey, I take you to the bank, wouldn't it be convenient for me to have, power of attorney? So that way, you don't have to go with me, all the time. So if someone gets a power of attorney or that shouldn't have received a power of attorney, the trust can act, like a brick wall because someone who has power of attorney cannot access the trust assets. So I think this is really something to consider, particularly, like I say, if it's not a situation, where your children live nearby, or perhaps you don't have children, you're independent, live on your own, and just want that protection. So the benefits of doing a will, it's more simple. It's less expensive to establish than trust, and it doesn't have to be maintained. So you can sign your will, put it in a drawer, and you don't have to think about it anymore. Now, granted, you want to keep a hold of that original will because you can admit a copy of a will to probate, but it's a pain in the neck. The original witnesses have to be located, and all the heirs have to sign off that it's okay to admit the will. But generally speaking, once you sign a will, you don't have to think about it anymore. I do, however, recommend that it's revisited, every 4 to 5 years at least. And also, if you have a life change, if you have a death, a birth, friendships change, just to revisit the trust or will. So what are the downsides to doing a trust versus a will? So a trust is more expensive to establish. There's more documents involved. Also, it's more work to establish it. You have to maintain it. So you have to just remember that you have the trust. So as you acquire assets, if you have a house that's in the trust, but then you move, your new dwelling has to be in the trust. So you have to keep in mind that you do have the trust. Not all assets can go into the trust. You cannot have a 401k or IRA be owned by the trust. Now, in some cases, it makes sense to have the beneficiary be the trust, but I guess that's another presentation. Also, have had a few occasions where my client has gone to refinance their house, and the mortgage company has required the property to be out of the trust in order to get the refinancing. So then, of course, you got to remember, okay, I've got the refinancing, got to put it back into the trust. And it may not eliminate the need for a will, just because, we're human beings. And I sometimes feel that, once people leave my office, I've done it, I've signed, I don't have to think about it anymore. And if that is the case, then there will have to be a probate, even though you do have a trust. So cons to will, as I mentioned, you got to keep a hold of that original. It's more expensive to administer, after your death. It's easier to contest a trust, or rather contest a will, because essentially there's already a lawsuit in process. It becomes a public document. Notice, and I mentioned notice has to be provided to the heirs, legatees, and devisees, and they're very state law specific. And so if you move here from Massachusetts, you have to go through some additional hoops to demonstrate to the court that it is a valid will under Massachusetts law. And it does trigger probate. And as I mentioned, if you have real estate holdings in different states, there could be a probate proceeding in each of those states. So what is right for you? Take it with a block of salt, but I think you really need to speak to a qualified estate planning attorney about what makes most sense for you in your situation. A lot of it depends upon the nature of your assets. If you have, primarily IRAs, it may not make sense. I did have a clients recently, though, who had like a $400,000 house and then, $4 million in IRAs. And so what I recommended was that the spouse be the beneficiary on the IRAs, but then the trust be the contingent beneficiaries. So the spouse would have the option to disclaim part of the IRA to the trust. The required minimum distributions would still be the same, but then part of the IRA would not be in his or her taxable estate. State taxes are owed 9 months after the second death. And that is another consideration for doing a trust, is if you do have a taxable estate and you're married, if you have a will, that could require a probate on the first death and a probate on the second death in order to establish a credit trust, which will keep assets out of the taxable estate of the survivor spouse. But if you have a trust, that would avoid, 2 probates potentially. It depends upon your heirs, right? If you have an only child who is single and has no children, maybe you think, I can just have, that child be the beneficiary on everything and do a transfer on death deed. And maybe it doesn't make sense to have the trust. Likewise, if you have no children, maybe you think, I'm not here. So, whoever gets my assets, it's just gravy to them. And so, a will would just be sufficient. I don't want to have the hassle of keeping track of a trust. It depends upon objectives. Do you value simplicity for yourself? Do you value simplicity for your fiduciary? I truly think that a fully funded trust is a gift to whomever you name as your trustee, because it's a lot more simple for your estate to be administered. Is avoiding probate important to you? Arguably, probate is simple in Washington, mainly because we don't have mandatory attorney fees like 6.5% in California, and so it's you have an option in Washington. All right, well, thank you so much. I hope that was helpful, and I hope you enjoy the rest of the afternoon.
So we have mentioned, and they're on the back page of your program, a firm called Dimensional Funds. I have used dimensional funds, mutual funds, and exchange traded funds dating back to 1997. Why? Well, because they are based on research, not on whims. They use academic, peer-reviewed white papers to determine how to invest. They are an ethical organization that I think truly puts your interests ahead of their own. And they have not deviated from that in that period of time. One thing, if you've noticed recently, is basically everybody in the industry, save for a very few firms, have decided that they will launch and now believe in a Bitcoin product. Why? To make money. They don't care about you all. They just see Larry Fink from BlackRock, for example. I really think it's disgusting that they're out, pitching this. Oh yeah, I've always believed in cryptocurrency, Bitcoin, etc. Dimensional has chosen purposely not to do that. Among other things that they could have done that would have pandered to your interests and gotten more of your money, but they have stayed to their core beliefs all these years. We've worked with them. They're a great organization, and we're extremely lucky to have them as a partner. And I think we're all extremely lucky to hear today from a vice president at Dimensional, a guy who's been out talking to people like us for about 30 years about the lessons learned from investing and how to put those to work. And here's one thing you don't know, although Don mentioned it this morning. Weston is a wonderful singer. He was just singing again. So maybe if you're lucky, he'll sing again. Weston, Wellington, thank you for being part of our Retiremeet.
You all hear me okay? Terrific. So with that buildup, you may be wondering what you're going to hear about all the clever people at Dimensional and what we do. I did not come here to talk about Dimensional Fund Advisors, even though I've been delighted to work there for the last 28 years. I am going to talk about some of the issues that I think confront every investor, whether they use dimensional strategies or not. And you probably heard a lot today about the virtues of indexing or low-cost asset class type portfolios, and they're a wonderful invention. The people who founded Dimensional were among the very earliest pioneers of those strategies back in the early 1970s. And we've done that strategy or various types of strategies ever since. But for many individuals, there can be a problem, potentially, when you convert most of your portfolio, hopefully all of your portfolio, to simple asset class strategies. Now, maybe you have a significant portion of your wealth in just one single fund, an equity mutual fund that tracks the S&P 500, for example. Good thing. And there could be a very powerful incentive or temptation to say, well, yeah, this index fund thing is great, but imagine how much more money I could make if I just got out of the index fund and put it in cash and waited until the stock market had a more favorable buying opportunity and then get back in. Now, if you can do that time after time successfully, well, go ahead. You'll make a lot more money. But before you go down that rabbit hole, I've got a few examples I'd like to share with you from the last 50 years that I think suggest it's much harder than you think. How are we doing? I have sort of a curse on computers, apparently. They get near me and they say, this guy doesn't know anything about electronics. We're going to make life very difficult for him. So this is what I do at Dimensional. I'm a financial historian of sorts. We have 5 people at Dimensional who have received a Nobel Prize in economics. And I've learned over the years that when you try to read one of their papers, typically, you want to read just the abstract, then the conclusion, and skip all the math. So what I've tried to do is to take the conclusions of all this rigorous academic research, but repackage it in a format that's perhaps a bit more digestible for individuals. So this title here, Stay in Your Seat, is actually a nod to one of my colleagues at Dimensional, huge soccer fan. Traveled all the way to Brazil back in 2014 to watch the World Cup match, Germany versus the U.S. Long plane ride, very long bus ride. He gets to the stadium, it's pouring rain. He'd packed light, didn't have any rain gear. Well, he scrounges a trash bag to keep dry, makes his way to the stadium, and the rain stops, and the game starts. Hard-fought battle. Entire first half, there's no score. Well into the second half, still no score. My friend's a bit thirsty after his long journey, gets up, goes to the concession stand. You know what's coming. For the few moments he has his back to the field, waiting for his drink, a roar goes up. Germany has scored! Turns out to be the only goal of the entire game. Germany wins 1-0. My friend thinks to himself, This is a lot like the stock market. When some of the best returns come when you aren't expecting them. I traveled all this way to Brazil to watch the World Cup match, and I missed the key moment of the game because I wasn't in my seat. Well, with that in mind, let's review some of the alarming headlines we might have come across over the last 5 odd decades that might have caused some of us to get out of our seat. 1970, at the time, the sharpest downturn in U.S. stock prices since the Great Depression. But if it's even remembered at all today, it's sometimes referred to as the forgotten bear market because it was overshadowed by an even sharper downturn. 1973, 1974, long lines at gasoline stations, turmoil in the White House, unraveling economy, plunging stock market. And even when the stock market began to recover in 1975, it still seemed like we were rather shaky ground, at least in some of the nation's major cities. We had some somewhat less eventful years, and then 1979, the discouraging cover story, courtesy of Business Week, the death of equities, how inflation is destroying the stock market. That's some pretty strong language. Why was Business Week so negative? Where was the Dow Jones Industrial Average, 30 prominent companies, when this cover story appeared? 875. Just about exactly where it was 15 years earlier. Now, granted, you got some dividends along the way, but this is presumably no one's idea of a rewarding stock market environment. Let's take a little broader view. Suppose you started the decade with $100,000, put all of it into the S&P 500 index, just as a simple basis of comparison, reinvested all of your dividends in more shares. How'd you do for that decade? Well, you made money, turned $100,000 into a little over $176,000. But your neighbor made even more money than you did investing in risk-free treasury bills, never had one sleepless night. Well, no wonder people like Business Week are talking about the death of equities. Why invest in risky stocks if you make more money in T-bills? Next decade opens up. Anyone remember Silver Thursday, March 1980? The Hunt brothers were convinced the U.S. dollar was going to become worthless due to rampant government spending and future inflation. They wanted no part of it. They wanted something, in their view, safe and solid, like silver. They came close to cornering the global supply of silver using a rather hefty amount of money borrowed mostly from big brokerage firms. Then when the price of silver began to go down rather than up, they got margin calls, meaning send in more cash or we sell your silver. They didn't have any more cash. It was all in silver. This precipitated a brief but intense selling squall on the stock exchange. Looked like the Hunt brothers were going to bankrupt almost every major brokerage firm. Well, the selling squall ended fairly quickly. Prices recovered. 1980 turned out to be a very good year overall for the U.S. equity investors. Not so good for the Hunt brothers. They filed for bankruptcy, were permanently banned from the commodities markets. Now, remember our Business Week cover story? Imagine you come into your advisor's office. It's August of 1979. You're not too happy. When is this going to turn around? You keep preaching this stay fully invested strategy. I think Business Week is onto something. The world has changed. Trust me, your advisor says. You know, these magazine cover stories are almost always wrong. I mean, I can't pinpoint when, but I'm really confident. A year, 2, 3 years from now, we'll be having much better times. Well, here we are, 3 years later, and where's the Dow Jones? 100 points lower. You got any more data you're going to wheel out to me, Mr. Advisor, to keep me fully invested? I'm out of here. Turns out August 12th, 1982 was the last day of that bear market downturn. And the next day was the first day of a still unfolding, we anticipate, bull market in stocks, with the Dow Jones now closing at close to 40,000. 1987. I'm sure some of you remember that. Devastating one-day stock market crash. So unexpected, so tumultuous, that much of the commentary at that time suggested something has permanently changed in the financial landscape surrounding Wall Street. Well, all that had really changed, in my view, we'd set a peculiar new record of sorts. We had a conventional so-called bear market, a loss of more than 20%, compressed into one single trading day. And then we're back to the ordinary ups and downs of stock market activity. And in the background throughout the 80s, as I recall, there was this growing anxiety that big, successful U.S. companies, they'd lost their edge, lost their way. We were being outmaneuvered, out-engineered, out-innovated by more nimble competitors from other countries, particularly Japan. But on the whole, the 1980s were a rewarding decade for equity investors in the U.S., so now our $100,000 is just shy of $900,000, and we're well ahead of our neighbor in Treasury bills. Next decade opens up. Boy, do we have things to worry about now. Another recession is unfolding. Kuwait has been invaded. There's a massive military buildup on both sides. At any moment, it seems, a shooting could start. Some brave souls at that time announced, well, when the shooting does start, obviously, the stock market will collapse even further. And if you're really brave, you'll pick through the smoking rubble to find some bargains to buy. Do we recall what happened the day the missiles started to fly over Baghdad? January 17th, 1991. What happened to stock prices that day? They skyrocketed and never looked back. 1991 turned out to be one of those well above average years, the kind of year you cannot afford to miss if you want to get that long-run capital market rate of return being handed out just for showing up. Later that year, we began to hear an argument we're still hearing echoes of more recently. The argument goes something like this. Look at stock prices today and compare them to any sensible measure of company value. Stock prices relative to company profits, to company dividends, to their asset values. They're so far above their long-run average, the argument goes, this can't possibly be a good time to be buying or holding stocks. You should sell them and wait until they're more appropriately valued. The following year, Time magazine tells us it's the longest period of economic weakness since the Great Depression. Who's this guy? Barton Biggs, very colorful fellow. Allegedly the very first individual to have the title Chief Investment Strategist, which kind of has a military connotation to it. You're surveying the landscape, see where the next attack is coming from. So why is he dressed up in this bear costume, signifying a down stock market? He tells readers of Forbes he had a confession to make. I voted for Bill Clinton for president, he said, and I made a huge mistake. Bill and Hillary are a disaster for the U.S. stock market. Get your money out right now. Well, 1993 turned out to be about an average year for stocks in the U.S., about 10%. 94, to give Barton some credit, not so good, but not terrible. Prices were basically flat for the stock market. You got your dividends that year, not much else. 1995, another year of well above average stock market returns. But in October of that year, Joe Granville appears in the pages of Barron's Financial Weekly. Now, Mr. Granville had published a market timing newsletter for many years and had made some uncannily accurate predictions for stock prices, both up and down, late 70s, early 80s. He now tells readers everything he has learned about studying all the patterns and squiggles in stock prices. Leads him to an inescapable conclusion. We are destined for another devastating stock market crash, similar in scope to that of October 1929. And it's only a matter of weeks away. At the very most, months away. Weeks and months go by, there's no crash. Prices go higher the next year. The chief investment officer for a major insurance company tells us he's never been more negative on the outlook for stocks in his entire investment career. Prices go higher still in 1997. Money magazine chimes in. Now is the time to take your investment chips off the table. Maybe by some miracle, you had resisted all these suggestions to fiddle with your portfolio, and you had remained with whatever you thought was a sensible allocation to stocks. So what happens the next year, 1998? First half of 98, stock prices go even higher. S&P is up another 16% or so. Then along comes August of 1998. The Russian government defaults on its debt. It triggers a sell-off in other bond markets around the world. It spills over into stock markets. Now, it wasn't literally true. It just felt that way at a time, that every single day in the month of August, we had another version of the anguished trader photo appearing in the newspaper. So by the end of August, all of your year-to-date gains in the equity portion of your account have been wiped out. You're reading your month-end August statement. It's early September. Not very pleasant reading. Now you got a year-to-date loss of about 2 or 3%, except now what are you hearing? You're hearing this isn't some ordinary stock market correction. This is a full-fledged global meltdown. Stock markets are falling everywhere, all around the world. No one seems to have predicted it. No one seems to know what's going to happen next. And the phrase we heard over and over at that time, this is unprecedented. Well, who in their right mind wants to have a big dose of stocks in their portfolio in an unprecedented economic or market environment? So here we are, September 1998, wondering, worrying, how deep, how long, how painful is the crash of 98 going to be? Then somehow 8 months go by and this financial hurricane has disappeared. And now we have a new concern. It's our irritatingly attractive next-door neighbors getting filthy rich investing in technology stocks. And it's not just our next-door neighbors, the golf pro, the gal bagging groceries. Everybody's making more money than we are in the stock market. Perhaps because we sold all our stocks 2 years ago after reading Money Magazine. But it's not too late, at least according to Harry Dent. In this book, published in 1999, he lays out a very appealing vision of the future. A golden era for investors lies just over the horizon, powered by unavoidable demographic trends, aging baby boomers and so forth. He sees the Dow Jones roughly quadrupling to 40,000 by the year 2008. We'll hold that thought for a moment as we survey the end of this decade. So now our $100,000 is a little over 4.7 million, even farther ahead of our neighbor in Treasury bills. Maybe try to keep that 4.7 million figure in mind for a few more moments. So we briefly flirt with all-time record highs as the next decade opens up, but these authors, channeling Harry Dent, say, Dow 40,000, it's on the way for sure. But you know what? 2008's a long way off, and we don't think you have to wait that long. We think the Dow should be 36,000 right now, based on the author's contention that relative to yields on high-quality bonds, stocks were still massively undervalued. Well, we now know the Dow Jones went nowhere near 36,000 or 40,000 at that time. We had a rather dramatic downward trip first. So you may recall our eager young couple about to get wealthier and investing in just the right tech stocks. So I think without explicitly admitting guilt, I think money is suggesting with this cover story, okay, we all made some mistakes. We've learned from our mistakes. Market survival guide issue. I call it the atonement issue. So now notice how the happily married couple is now the grim-faced individual. I think she changed the locks, after he had too many day trading escapades. So 2000 was a down year for stocks in the U.S. 2001, another down year. 2002, third year in a row of negative stock market returns. In October of that year, here's the headline. The day after the market hit its low for the year in 2002, and also the end of that 2.5+ year bear market. What does the news tend to look like at the very lowest point in a down stock market? Tends to look pretty grim. That's one reason prices are so low. The reporter here asked a bank trust officer, what do you think? Stock prices have come down so much. Time to buy? What did the banker say? What are you, nuts? Look around you. The whole world is falling to pieces. This is no time to be buying stocks. And yet just 4 days later, we've seen one of the strongest stock market rallies in 7 decades for no obvious reason. Now, prices rarely go straight up or straight down. They pulled back somewhat early the following year, 2003, but never came back to their previous lows. Once again, this is the headline in the Wall Street Journal the day after the market hit its low for the year in 2003. Once again, what does it appear many investors are doing with their stock market holdings? Stampeding for the exits to lock up safe returns and bank CDs or T-bills and missing out on a gain of over 39% between the day this headline appeared and the end of the calendar year. Another one of those years you cannot afford to miss. And it took place despite a mysterious healthcare virus that at one point appeared it was going to bankrupt the entire global travel industry. Then we're back to the daily grind, worrying about the economy, worrying about oil prices that will inevitably go to the high triple digits, we were told, worrying about our friends making more money than we are in real estate, or maybe not making more money than we are in real estate, leading to a devastating financial crisis, a very stressful time for many investors, as the economic news throughout 2008, early 2009, got gloomier and gloomier, and stock prices kept drifting lower and lower and lower. This headline in the Financial Times seemed to capture the mood perfectly. There's just no end in sight for this downturn in stocks. Now, this is a teachable moment, courtesy of the Financial Times. This headline here is a 100% true statement. There's never an end in sight for any downturn in stocks or any upturn in stocks. We just don't know for sure what lies ahead. As it turned out, this gloomy assessment appeared 12 trading days before the beginning of one of the longest and strongest and most profitable bull markets in the entire history of the United States. Were you on the train when it pulled out of the station? Or were you still standing on the platform, reading the Financial Times? And in the background at that time, there was also concern in some quarters that we had a new occupant of the White House. It was perhaps a sharply different view of the proper relation between business and government, leading at least one observer to claim at that time in an op-ed piece appearing in the Wall Street Journal that all of the recent weakness in stock prices could be attributed to the behavior of just one individual who happens to occupy the White House. I am not suggesting that anyone abandon their political beliefs. I am suggesting be very skeptical of your ability or anyone else's ability to apply those beliefs in a manner that can enhance your investment results. Vote your convictions at the ballot box, not with your life savings. This particular op-ed piece gets my Yellow Stinker Award for the worst market timing prediction in all of my voluminous files from the last 48 years in this business. One trading day before the stock market began to skyrocket. Stock market actually bottomed early March 9th, Dow 65.47. A TV news reporter had interviewed Warren Buffett, famous investor, chairman of Berkshire Hathaway. Mr. Buffett told the reporter that the U.S. economy had fallen off a cliff. Well, who wants to argue with Warren Buffett? What the reporter failed to tease out from Mr. Buffett, he'd been actively buying stocks for Berkshire's portfolio while the economy was falling off a cliff. And as the stock market began to rise, often dramatically, late March, April, May, and June, many investors were puzzled. How can stock prices be going up when the news is so bad? Not just individual investors, many professional investors were equally bewildered. This is Alan Abelson pictured here, peach of a guy. Wrote a weekly column for Barron's for over 4 decades. Died with his boots on several years ago, writing yet another column. He'd seen every market cycle come and go. But even someone with all of his wisdom, all of his experience, he was caught completely flat-footed by the upsurge in stock prices in 2009, insisting in August of that year that this marvelous movie we've all been watching will run backwards, guaranteed. Now, this is a key advantage of being a financial journalist. You can use the word guaranteed as many times as you want, in front of as many people as you want, and no legal authority can touch you. So where do we stand at the end of this decade? Let's see, our $100,000 is 4.2 million. 4.2 million? 4.2 million? Didn't you tell me I had 4.7 million 10 years ago? Yes. Didn't I reinvest all of my dividends in more shares like you told me to? Yes. Well, what happened? I'm missing at least $500,000. What's the message here? Stock prices don't always go up. There can be uncomfortably long periods when they don't. If that happens, can you stick with the program? Next decade opens up. Lots of things to worry about, apparently. Much chatter at that time that the moment this so-called artificial government stimulus comes to a close, it will knock the props out from under the economy and the stock market. Just a brief shout out to The Economist magazine, consistently the most alarming cover story images of any publications in my files. So apparently we're about to get torn to bits by financial sharks in the water more than a decade ago. And there were certainly plenty of things to worry about. Despite a rather tepid economic recovery, banks are still failing left and right. U.S. government has lost its long-held AAA credit rating. We survived the sharks in the water. Now we're about to get electrocuted back on dry land. Martin Wolf, deemed to be the most astute observer of all things financial by a jury of his peers, other financial journalists, telling readers, again, more than a decade ago, that the U.S. economy was sinking into the so-called Great Stagnation. Now, most journalists, in my experience, if you get the chance to talk to them after hours in the bar, they'll agree, trying to time the stock market, when to be in, when to be out. It's an exercise in frustration. Don't do it. But sometimes they just can't help themselves. To Brett Aarons of the Wall Street Journal, it was now so obvious that stock prices were so overvalued. The only sensible approach was to implement some sort of quantitative timing strategy. The Economist telling us that whatever the short-term cycles of economic expansion and recession may be, the very long-run growth rate of the American economy is both sharply and permanently lower. There's a huge sell-off in stock prices in 2014, another one in 2015, another one in 2016. Later that year, we have a controversial new leader in the White House. We have controversial leaders in other countries. We have many voices telling us that this bull market has lasted far too long, and it's over. Fortune magazine chimes in with a religious sort of a connotation here. The end is near. The New York Times can't resist. In a year-end issue, they tell us, with a rather alarming airline analogy, buckle up, investors, and assume the crash position. Are you ready for the financial crisis brewing for the year ahead? It looks like they were right, at least for 1 week. Business Week piles on. Hope all you investors enjoyed the so-called Trump bump in stock prices. Now, you'd better get ready for the Trump slump in the stock market and the economy. Now, imagine it's the first week of 2019. You're reading all these rather alarming assessments from a variety of allegedly expert observers. You're looking over your equity portfolio, and it's done rather well in recent years. Gosh, maybe I shouldn't be too greedy. Maybe this is the dangerous time when you get overconfident and expect another fabulous year and you leverage up and get burned. Maybe it's only a question, should I sell a little or should I sell a lot? How many of us remember what the rate of return was on the S&P 500 that year? Was it about average, 10%, like almost no one was expecting? Or was it 15 or 20 or 25 or actually just a shade over 30%? Not only have I been unable to find anyone with any stature in the investment world who predicted that, I can't find anybody who can explain why it happened afterwards. Another one of those years you cannot afford to miss. When they're passing around the plate of cookies, you have to be there to take them. So where do we stand at the end of 2019? Now our $100,000 is a bit over $15 million. Not too shabby. Next decade opens up. Brief flirtation with new highs, and then as this virus news begins to filter in, prices go lower and lower and lower. James McIntosh of the Wall Street Journal helpfully telling us in mid-March, however bad it's been so far this year, it could get much worse. And he was absolutely right. Stock prices fell the following week at an even faster pace than they had during the great crash of 1929. But just as suddenly, out of nowhere, comes this astonishing rally, so unexpected, so powerful that the vast majority, not just individual investors, but professional or so-called professional investors, were equally puzzled. And the argument we heard over and over at that time, oh, this is just like 1930. A recovery from the crash, and it was a fooler. The classic bear market rally. Don't fall for it. Just one more chance to lose more money. And it's not hard to understand that viewpoint. The news was not just dreadful, it seemed to be getting worse and worse day by day. The New York Times needs creative graphics to capture the depth of the collapse in retail sales. Who could have imagined in 2019, with unemployment in this country at a 50-year low, that anyone could be talking sensibly about a 17% jobless rate? Less than a year later, all the experts at the Federal Reserve, hundreds of PhDs, paid to do nothing but crunch all the economic numbers, telling us the pain will last for years. Company executives chiming in with a similar story. Time magazine telling us a global depression is unfolding. And yet somehow, 2 weeks after the Time story, the stock market hits an all-time record high, prompting at least one veteran market observer to claim this stock market is nuts. Hold that thought for a moment. We'll revisit it. I'm going to briefly pivot to a refresher of one of the more contentious election cycles in recent memory, or maybe even distant memory. Did anyone predict that Joe Biden would be elected president? Sure, lots of people did. Did anyone predict that Joe Biden would be elected president and we would have the strongest week in the stock market in this country following an election since 1932? Still looking for that one individual who made that prediction. Help me out if you know of somebody. So now our $100,000 is over $18 million. 2021, a brief recap. Another year when the vast majority of so-called experts were neutral to negative on the outlook for stocks. And it was certainly a very challenging year for many of us, especially students, parents of students, those of us trying to fill gas tanks or heat homes at sensible prices. Another year of well above average stock market returns. Let's revisit this notion that in the summer of 2020, the U.S. stock market was, in the words of a New York Times financial journalist, was divorced from reality. Now, I can forgive individual investors for being occasionally puzzled by stock market behavior. I have a harder time forgiving financial journalists who ought to know better. What is a stock? Well, it's a claim ticket of sorts, a legal claim on any particular company's profits and dividends. And there's no expiration date on that claim ticket. It's often to perpetuity, which is a rather long time. Investors gather around stock exchanges and they trade these tickets amongst each other. Now, by definition, no trade takes place unless both the buyer and the seller believe it was a fair price. Well, how do investors decide what a fair price for any security might be? Well, they tend to study these companies and learn as much as they can about not just what's going on at any company today, but what seems likely to happen tomorrow, or next year, or 3 years from now, or 5 years from now, or 10 years from now. Remember, it's a perpetual claim ticket. And because they're competing with millions of other investors, all looking at these companies, trying to assess what the right price might be, and keenly aware of any news developments that might affect the outlook, there's a powerful incentive to act quickly when news arrives. Now, sometimes good news can come in the shape of news that may be bad, but just not as bad as most of us were previously expecting. So we should not be surprised when the stock market can occasionally move explosively upward when the news is still black, but just a little less black than it was the previous day. So a year or so later, now what are we hearing about the economic outlook? Gosh, we're having one of the most dramatic economic recoveries in recorded U.S. history. Should it be surprising the stock market might have sniffed out and anticipated this kind of headline? So where do we stand in 2021? We're over 23 million. We have a bad year in 2022. We're back under about 19 million or so. And 19.2, we'll call it even out. What were we hearing about the prospect for 2023 as the year-end 2022 drew to a close? We had a brutal stock market, worries about the Fed cranking up interest rates, and I would argue almost universal conviction that it's not a question of are we going to have a recession? The question is it going to be somewhat mild or is it going to be a real doozy? We're supposed to brace ourselves for market turmoil. And suppose our fairy godmother had come to us at year end and said, oh, and by the way, just so you know, you're going to have the second largest bank failure next year in the entire history of the U.S. Still feel confident investing in stocks? Well, it happened. It also happened there was another potential default crisis. Even well into that year, we have so-called experts telling us the recession that is unfolding right now won't be an ordinary one. It'll be longer and deeper. Late as August, we're still hearing about how puny corporate profit reports are. Got the highest mortgage rates in 23 years. Sounds like a fabulous opportunity for stocks this year, right? Oh, and by the way, oil's back at $100 a barrel, just to give you one more thing to worry about. And we have political turmoil that's seemingly without end in what some of us might refer to as the clown show of Congress going on. And yet, despite all this negative news, the Dow and the S&P are on track for all-time record highs, and now we close out the first 4 years of this decade underway at now we're at 24 million. What's my point? Am I suggesting that all of you in this room should have a big dose of stocks in your portfolio? Absolutely not. But I do find favor with an observation made many years ago by Princeton economist and author Burton Malkiel. He said, I think almost everyone should have some portion of their assets in stocks. Now, he didn't say how much. Could be only a little, could be a lot. That's a good conversation to have with a professional financial advisor who might function as kind of like a coach. You know, most professional golfers, probably all professional golfers or major tennis player, athletes, and so on, they have a coach. Doesn't mean they can't play the sport. Just means they're more likely to have the odds in their favor by someone with a neutral observer position can help them be at the very top of their game. So, could you have stayed in your seat? That's the question, and a question I urge you to give a lot of thought to. And thank you all for coming today. Oh, good thing I showed up.
Okay. Sorry I missed Weston. How was he? Was he good? He good? Yeah. He's just a great storyteller, and he has all that historical perspective that makes it, I think, very interesting. We have a minute, so we're going to do a couple more drawings. Ricky's been back in the back room coming up with more stuff to give away. We found some notes that Don wrote to himself about 20 years ago that we think might be entertaining. No?
Yeah.
Okay.
It's a personal journal.
Ooh, ouch. All right. What are we doing first? Talking Real Money shirt goes to 749. 749. All right, we got one back there. Good. We're going to be talking with Rebecca Chrichton here in just a couple minutes. Dig deep here. Okay. What are we doing here? This is the book. Another copy of Secure Retirement with Larry Swedra, which is, I can personally attest to, is a wonderful book. To number 468. 468. We're right here. Fantastic. Well done. And while we're doing that, I should mention, we mentioned this briefly for people either online or here in person. And we haven't had time to talk about it much, but we do this. We talk about this on the show regularly. We talk about it on the podcast. We are willing to give you an hour of one of our advisors' time. That's the retire meeting that's in your handout. There's no cost, there's no obligation, and we're going to do a couple of things for you that I think are very useful. One, even if you have a plan, somebody else is going to look at it and say, here's other things to consider. Number two, and we do this, it's a wonderful piece of software we have. We take all the things you're invested in and we look at how diversified you are, how much risk you're taking, and how much you're paying others for that. It's a terrific piece. And then on top of that, you actually get an advisor to quiz about various things. So if you want that help, either online or here, just fill out that little form online. I think you just click on the link there. Tutabella. All right. This is for pizza at Tutabella, and the number is 561. 561. All right, we got a winner right there. Well done. Oh, we got one more? Oh. Pizza at my house. We do have pizza. We do have 2 ovens there now. So, you know, here's the thing. Here's the good news for me, because I don't need it. And when they sit there for a long time, those stone ovens, it takes a while to warm them up. So you'd actually have to have a fire for about half a day and really hot to really get them going again. So thank goodness it'll take longer than that. So we got another one. Oh, the backpack. Yeah. This is for the backpack. 624. These are nice backpacks from Charles Schwab. I want to thank them again for helping us out today. 624. We got it? No? All right, we'll do another one. Must be present to win. And it's 672. 672. We're going to keep calling numbers, so it doesn't matter. There you go. Yeah. Wow, this is 446. Well, you know, we're just making it up at this point. 446, going once, going to, okay, well, try one more. Seven, 5, 2. All right, I see a hand over there. You know, while Ricky Tactall is right here, I want to say a couple words about Ricky. So some of you know her. She's worked for us for 8 years, 7 years. Yeah. And this event does not happen, frankly, without Ricky, without Keely in the back, because all the logistics. I'll give you an example. And some of you know I'm a bit of a worrier sometimes, but I woke up a couple of nights ago, maybe it was Thursday night at 2:30 in the morning, and thought, we don't have the clicker. We don't have the slide advance. I was like, we only use it once a year. We're not going to be able to advance the slides. So from 2:30 until 5 a.m. when I emailed her, I thought, God, what are we going to do? Am I going to go to Amazon? Am I going to go to Best Buy? I emailed Ricky, and at 10 after 5, she wrote me back and said, I already have the clicker set aside with extra batteries. So take a deep breath. So thank you, Ricky, and thank you for all your hard work. And this year, I'm taking the clicker home with me, so I know we'll have it next year because I'm gonna put it under my pillow. It's just one of those things. There's just a lot of little details that go into all this. And I mentioned Keely Sharp, who's with our marketing department. She's handling everything in the back. Thank you, Keely, for all that. And our director of marketing, who's going to be here, she lives on the East Coast and planned to come out and help with all this. She had a burst appendix a couple of days ago, which is horrible. And she's recovering, but she couldn't make it. So, and then all the folks you see out in the hallway, they all spend a lot of time and effort. I jokingly said earlier, they don't get Monday off because I got to work Monday, but they spend a lot of extra hours helping put all this together. And there's a lot of behind the scenes stuff that has to happen for that to go. So it is truly a group effort, but one that we've enjoyed doing for many, many years. So I'm waiting for Rebecca to get mic'd up here. In the interim, do you have any questions? Because we're going to do a Q&A anyway. I'm happy to do some of those now, and we can have you come right over. Can we have you come to this microphone over here and ask them? Right here, you see it? If you have a question, you can't get out? Or take the mic, because we're going to do a Q&A later anyway. But since we have a couple minutes, we'll be glad to answer any questions, hopefully on topics that I can answer. And Don and I will be doing this in half an hour towards the end of the afternoon as well. But questions now? Here's one.
Quick question about your mortgage maybe being at a risk. I know this might be more something for Herb Weisbaum, but is that a legitimate thing? Your mortgage is supposed to be safe somewhere. Your home is paid for. Does anyone have any background information on any of that?
Well, okay. Now I'm understanding. First you said the mortgage, then you said your home was paid for.
Yeah, I guess.
Oh, you mean your title?
Title, yes. Thank you. Thank you for the clarification.
Yeah, I mean, this is just not an area I know enough about. You read about it from time to time, and it does happen. But I mean, I don't know exactly how to prevent it from happening. I don't think I could give you a really good piece of advice there. And I will say, and I'll reiterate this though, so many of us now have these ridiculously cheap mortgages that are 2.5%, 3%, et cetera. And yet we still have this inclination as savers and trying to do the right thing to pay them down. I will caution you against doing that, where that might feel good financially, but it generally is not the best decision because you end up with a lot of equity in your home that you cannot access in retirement. So it does make sense. I know that, and Paul used to, by the way, when we did the class together, used to tell people, get rid of your mortgage before you retire. You have to pay it down. I don't believe that with these cheap interest rates that so many people have now. So, but I don't know enough about sort of title insurance to give you a good answer. Other questions? Oh, come on. Personal questions about Don. Happy to answer those. I got a lot of stories, but.
I can make a mention about the title thing. If you check with your county, they may give you information, or they may let you know if something's changed on your title. But my question is, there's a lot of love given to small cap value funds. I don't really hear much about mid cap value funds. I got a little love for them. What do you say?
Well, again, when you look at kind of asset classes, the more the action has been over the long haul, large and small, not as much in the middle. If we're managing money for you, you end up owning some mid cap because things are moving around. But in a general sense, we'd prefer you to be more in large and small and not make mid cap a point of emphasis. I'll put it that way. But you end up with it in a diversified portfolio because if you own 10 or 12,000 stocks, inevitably some of those are mid cap, sort of, and we're talking about market capitalization here, the size of companies. And, right now there are, even in this region, two of the biggest, between Amazon and Microsoft, they're just huge in terms of the number of shares outstanding times the share price, market cap. So it turns out there's more gains to be made on that side and the small side than in the middle. And so we don't focus on that so much, but you end up owning them anyway. And that's kind of the way it goes. So, all right, looks like our speaker is here. So you're probably tired enough of me after all day anyway. One of the things that we have learned as advisors in the last 20 years is that focusing on money, focusing on your estate is not enough, frankly. And I have a personal story around this where, and I've shared this before, my father retired from the military and really didn't have the next thing to do. He was a person who was very engaged. And I watched him. He did not love his retirement. He wasn't focused on anything. He didn't seem to be have the energy. You've seen a guy today in his retirement now at age 80, he is engaged. And I think he loves his life. Paul Merriman, he has many interests, but one of them certainly is helping all of you. So we've learned over the years that purpose in retirement is extremely important. And that's why I'm glad to introduce Rebecca Chrichton, Executive Director, Northwest Center for Creative Aging. Come on up here.
Thank you, Tom. Oh, thank you, everybody, for being patient. I used to work at the Boeing Company, and I was there during the time they developed what was called just-in-time work, and I'm now epitomizing that. I didn't know about the closures on 520 and on Northeast 6th and Northeast 8th, so it was one of those moments. So thank you for being patient, and I'm delighted to be back here again. This is the third year that I've spoken to the Retiremeet with sort of my message about what comes next. You've got hopefully your ducks are all lined up. You know where your money is. You know all that's going to happen financially, medically, where you might live. And what I'm going to talk about is sort of what comes next. But I started last year by asking two questions, and I'm going to ask the same ones with an additional one. How many of you were actually retired? Okay. So how many of you are finding retirement what you expected it to be? Oh, okay. I'm not going to ask for details here. So how many of you would you say it's really different than you expected? Yeah, different than you expected. So there's a gap here in information that I'm gleaning, which is that some of what you expected isn't what you expected. And some of you, how many of you don't know what to expect? Okay, couple. Okay. Well, here's this whole world of what comes next. And I'm going to take you a little bit on a journey here. A little bit about me. I retired from Boeing in 2010. I was there for 21 years. I had a great job. I was a writer. I was a trainer. I did leadership development. I did diversity work. It was a wonderful place for me. And I retired thinking, okay, I'm going to write. I'm going to travel. I'm going to do all the things that hopefully might be on your checklist of what comes next for you. And so I left in December of 2010. And by March of 2011, I looked at my calendar. It was empty. I'm an extrovert. And I went, oh, no, this is not good. This does not work for me. So because I'm trained as an organization development person, I thought, okay, well, what do I know? I am experiencing what William Bridges wrote in a book called Transitions. He was one of the first people to talk about grief in the workplace, loss in the workplace. He kind of did a really simple model. He said, there's endings, and we know what endings look like. Maybe you get a watch, maybe you get a party, maybe everybody tells you what they really loved or didn't love about you, whatever it is at the ending. Memories, great memories, which you may not remember. But anyway, then there's the neutral zone, which I will come back to. And then there's beginnings. We know what beginnings feel like. They're exciting, and we look forward to stuff. We don't always know what's going to be, but we know we're excited about the new stuff. In between endings and beginnings is what he calls the neutral zone. And it doesn't feel good. I will not use the word that describes what it feels like, but it doesn't feel good. It's been sometimes called the dark night of the soul. There you are, and you think, where am I? And where am I going? And what am I doing? And who am I going to be? And there's a very big unknown space that you are in and didn't think you would be in. The neutral zone is absolutely critical before we start something new, from something we've left to something new. And if any of you have dealt with grief and loss, it takes time between losses and what comes next. So that was the model that I thought of. Organization development people think in models. So what I did was, let's see, there. No, that's not what I want. Come on. There. So I said to myself, and this is a question I urge you to ask yourselves, what is it that I bring to the world? What is it that I do, separate from the work, the jobs per se? What is it that people would say about me that I bring into the world? What did it mean for the rest of my life? And if you answer, well, I was really good at spreadsheets, that's good. And hopefully you were good enough to be here and understand what you learned today. I wouldn't be, but it's not the job per se, it's the characteristics behind the job. You're good at organizing, you're good at planning, you're a person who brings others in. And so I thought, okay, Rebecca, who are you? And I thought, well, I contribute. I am a big contributor. I love being parts of things. I'm a great collaborator. I've never worked in a situation where I don't collaborate with other people and sometimes get accused of traveling, stuck to the hip of a friend, of a collaborator. And I'm creative. I have a batch of creative stuff. I'm a writer and I cook and I blah. Anyway, those three things were helpful for me because it meant that whatever I did, whatever I embarked on next should include some of those things. Not all the time. But if those weren't present over time for me, I wound up having this kind of like, hey, Rebecca, who are you? And what are you doing? And what's your purpose? And what's the sense of it? So that worked for me. I don't think that anybody else needs to do 3 C's, but that's so asking yourself, what are my attributes? If you don't know, think about asking friends and family what they see as your strengths. We're going to get to that in a moment. Here's one that I hadn't known I got there. All right. 3 things that keep our brains, that our brains need to keep changing. Something new, something challenging, and a sense of purpose, which Tom mentioned. I think there is another slide here. Yeah, I often talk about positive psychology and brain science. There's a lot of information out there on how our brains work and what they mean, what our brains make sense of. And so you've probably, I love this first point is our minds and our brains and our feelings are all linked, and science is proving it. Did you ever have any doubt that they were all linked? I mean, really, it's nice that science knows it, but we know that when we feel sick or when we feel scared, our bodies go into response. We know that we are unified beings in our bodies and in our minds, and hopefully in our hearts as well. So there's a saying in neuropsychology, neurons that fire together, wire together. The more you do one thing, the more you will do that one thing. And so we have deep links in our brains from all the things we've done our whole lives, but we are always creating new neurons. Back in the day, before we did MRIs and things like that, the only way they could tell what was going on in your brain was how? How did they find out what was going on in your brain? What? Well, they asked you, but there was another very specific way to find out how your brain was doing. You had to die. You had to die, and they had to do autopsies, and they reported about that. So that's great help for people who are gone, but not, but we know that they're all together. Mental states become neural traits. It's just what we think about becomes the way we act. Your brain takes its shape from what it rests upon. The concept of experience-dependent neuroplasticity is very interesting. All it says is that what we do creates the capacity to do more of what we do. Makes sense if you think about it. So just keep that in mind, that everything you do kind of feeds into how your brain is processing things, right? All right, now why is it there? Okay. Okay, we've done that, sense of purpose, okay. So there's the father of positive psychology is a man named Martin Seligman. He's written a bunch of books. I want to just mention 2 of them because he's a cognitive psychologist, and his work looks at how we think around things that go well and things that go wrong. He's all about optimism and pessimism from a cognitive standpoint. So his book is called Learned Optimism. It's a terrific book if you want to look at that. And if you have kids or grandkids, How to Raise Optimistic Children is a book I would suggest, because how we think makes a big difference in what we do and how we do it. He says that other people are the best antidote for life's downs and ups and the most reliable way to get up, and the single most reliable momentary increase in well-being. Do a kindness for others. So think about what that looks like. And in addition to thinking about what it looks like, think about who does kindnesses for you and what it feels like to be on the end of a smile, a kind gesture, an offer to help. So that's just help others, let them help you. Okay, I'm going to do a real quick check with the audience. What do you do daily that is specifically about your sense of well-being and wholeness? I am assuming you are in charge of your well-being and your wholeness, that you're not counting on somebody else to do this for you. How many of you are counting on other people to make you happy? Well, I'm glad nobody's raising their hand. Well, We've got somebody back there with a raised hand. You know, certainly other people can affect how we feel. We know that. But if we're expecting us to be happy because somebody is doing it for us, we may be disappointed. Let me just put it that way. So what are some of the things you do that make you feel good, that make you feel whole? Just popcorn up. Say what? Help others. What else? Exercise. Absolutely. What else? Gardening, exercise, gardening, what? Crafting, making stuff, creativity. Loving animals, is that what you see? Pets. How many of you have pets? Do they make you laugh? If your pets aren't making you laugh, get a new pet, because really pets are there to make us laugh in addition to what else they require of us. But all right. So good. So you get a sense of it. Here are so just think about it. Some of the things that go into what makes people happy and take care. How many people meditate? Some meditators. How many people journal? Some people journal. How many people are happy when they're with their families? This is a trick question. Good. The majority of you are happy with your family. I'm really, really glad about that. So anyway, just think about what it is that feels good to you. And when you do it and you do it regularly, we're going to get to something else in a moment that is a guarantee. But so here is something that I have tried to track down this cluster of things. I have yet to find who actually said it. But what we need to feel good, something to do, something to look forward to, something to believe in, someone to love, and one more, something to laugh about. So much of what I'm sharing is not, this is not rocket science, right? This is kind of sensible stuff, but you have to fill in the blanks. I don't know what the thing you do makes you feel good. I mean, I like to cook. A lot of people figure out how they can order Factor online, you know, which is another whole thing to do it. So looking forward to something makes a difference, something to believe in, whatever that is, people you love, people who love you. And we do one more thing. We like to say something to laugh about. I'm a great believer that laughter is healing. And as a matter of fact, there's physiology that shows us that that's true. Good for our breath, good for our overall health. Should I tell you my favorite joke? These people have heard this joke before, but okay, they may not remember because most people don't remember jokes. So I'm just going to go there. So this is about two men who are walking along. They've got dogs. One has a Doberman Pinscher and one has a Chihuahua. Anybody know this joke? No. If you know it, it's probably because somebody heard me tell it. But anyway, so they're walking along and the guy with the Doberman says, I want a drink. Let's stop in a bar and get a drink. And the guy with the Chihuahua says, well, what about the dogs? He says, don't worry. Do what I do. Watch what I do and do what I do. The guy with the Doberman puts on his sunglasses and he walks into a bar and the bartender says, excuse me, sir, you can't bring that dog in here. He says, this is my seeing eye dog. And the bartender says, a Doberman. He says, yeah, really well trained. He'll just stay here, you know, no problem. Bartender says, good, what are you ordering? The guy outside, it's like he watches, he hears it, puts on his glasses, and he goes. The bartender says, sir, I'm really sorry. You can't bring that dog in here. He says, this is my seeing eye dog. And the bartender says, a Chihuahua? And the man says, you mean they gave me a Chihuahua? See, it's a really good joke. Is that a good joke or what? Every once in a while, somebody doesn't know the difference between a Chihuahua and a Doberman. That's a bit of a problem. But if you run into somebody with that joke and they don't know the difference, show them pictures. So there you go. All right. Okay, this is a quote from Philo of Alexandria from the 5th century BC. I share it because we are in a particularly interesting time in our world where kindness is not so valued, but it is so necessary. Be kind, for everyone you meet is fighting a great battle. We cannot tell by looking at each other what people are going through. We don't know what struggles they're having, what losses they've had, what issues they're dealing with. You don't know. Maybe you do, looking at me right now, that I had a struggle on the freeway today, but it was a struggle. It was a battle. Yes, it was. But think about that, because the kinder we are, the more likely we are to, first of all, feel good and more likely to connect with others. And connecting with others is like right at the top of what we need to do to feel good in this world, is to be connected to others. So, okay, here are some themes for happiness. It comes from a lot of the work in the neuropsych thing. Be good to yourself. What does being good to yourself look like for somebody? Somebody say. No. Take your time to relax. What else feels good? projects? Massage. Oh my goodness. Absolutely. Schedule massages. What? Floodlights. Sunlight. Sunlight, floodlights. They sound like. Yeah, good. Enjoy your life. Whatever enjoyment looks like. What I like about these is that they're just containers, you know, they're just containers for ideas that we then fill in and think, yeah, I enjoy myself when if you can finish that sentence, even with a couple of choices, that would be great. Build strengths. I'm going to get to that in a moment. Engage with the world. There are so many ways to be involved with the world, to volunteer, to help others, to just yourself learn more, try something new, do one of those challenging things, and be at peace. It is very hard to find peace these days. We need to kind of develop it ourselves. There's ways to do it. And maybe the more peaceful we are internally, we can share that with others. You know, there's whatever peace looks like, it's worth trying for. Okay, owning your strengths. Most of us grew up with the, in evaluative settings, schools, families, teams, work that you do, where we're always being checked to see, what are we not doing right? What are our weaknesses? And then there's like, well, then fix your weaknesses. If you don't do math, then learn math. If you don't do such and such. We now know that the more people do things that they're good at and that they're strong at, the more successful they're going to be. So when we were working with managers at Boeing, getting them to think about what their employees were good at and using them for what they were good at, as opposed to just pointing out how they screwed up, to use a language, they had to really kind of redo their brain, because their job in their mind was to correct everything as opposed to appreciate. We know that employees stay engaged when they feel valued, when they feel appreciated, and when they know that they're doing well. It doesn't mean you don't learn things. It doesn't mean you don't correct things that are a problem. And certainly if one of the things you don't do is getting in the way of your keeping your job, you want to learn those things. But in general, when we do things well, so there's lots of approaches to strength-based work. And if you think about what you're really good at, I mentioned this a little earlier, which is if you don't know what your strengths are, and many women, it's a generalization, many women, it's like, oh, I don't really have any strengths. It's like, no, we all have strengths. Learn what they are. Ask people, what do you think my strengths are? What are my best attributes? What do you appreciate about working with me, knowing me, being with me? And don't ask for what do we call that? Feedback. Don't ask for what do you want me to change? That's not for your friends and family to do, although they may think they do, but that's not it. But really to see what they say. And I will tell you, I taught a class about positive psychology, and I asked the class to go home and ask their family and friends, write them, what do you like? What are my attributes? What are my strengths? And they came back the following week, and one of the women, a very smart woman in the class, said, well, I did it, and I got this email back from everybody, and they said, we love that you are friendly, blah, blah. They just get a whole list of things that were all the same, pretty much the same from all of these people. She said, I looked at them and I thought, well, they just don't know you. And I thought, okay, there it is. And she was smart enough to think, maybe I'm seeing this wrong. Maybe this wrong. How many of you have heard of the imposter complex? Many, many of us feel like if people really knew you, they would not value you. They would not see good things, that we're covering up a lot. And the fact is, it's okay to feel like maybe I'm not so good at it, but the fact is most of us are just fine, and people see us and value us for what's real. So that's good. So think about your strengths. If you have any doubts about them, ask people and act from them. Make decisions that use them. Be involved in ways that use your strengths, so you feel some kind of confidence when you do that. And let's see. Okay, one thing you feel grateful for right now, just pop up. Friends, grandkids. Thank you. She said me. Thank you. What else? Like life. Good. Yeah. Good. Gratitude. So how many of you have ever kept a gratitude journal? Do you know about a gratitude journal? It's a wonderful practice of right before you go to bed at night, if you can think of or write down 3 things 3 things that you feel grateful for, that's a good way to go to bed. And I met somebody who had a 9-year-old son, and she said that every night they did 3 gratefuls, what he was grateful for. And in the morning, they did 3 hopefuls. And I love that. It's like, what are you thankful for? What are you looking forward to? And let's see. My favorite bumper sticker. Don't believe everything you think. We make up stories all the time and we think they're true. The story that I was not going to get here ever today was not one, happily, I gave into, so because I'm here. And don't worry about stopping thinking. Anybody really good at stopping thinking? If you've been a meditator, you'll know how hard it is to stop thinking and to kind of come back into yourself and be open. So don't believe everything you think. You will continue to think, I promise you. 10 elements of positivity. This comes out of positivity work. Again, these are just ideas about if you can say, what is joy, gratitude, serenity, interest, hope, pride, amusement, inspiration, awe, and love? And you know what? I can do that without looking even. So I'm proud of that. If you know what the answer is for you, you're in a good place. Then you're in a place where you're open to new things and you know how to take care of yourself. These are all about who am I and how do I stay positive? So think about them. They're good. As I said, if you have pets, amusement might just be plugged in with the pet thing. So, all right. What ideas will you take away? What action item do you want to commit to? We don't have a lot of time to hear it, but think about, is there anything in particular that I've said in this rapid fire presentation? Anything that you'll take away? A great battle. Thank you. That is a good thing to take away. And you said, put it, do. Yes.
I love your message. There's so much anger and escalation in society now. What do you comment about that?
I think one of the hardest things this is a hard time. I think to the extent that we are willing to ask another person why they feel what they feel or why they think what they think, if we are really willing to hear another person. A friend of mine said, so Rebecca, we have all these divisions. And she said, I want to be able to have conversations with people who have very different divisions so that when we're done, they'll believe what I believe. I said, she's a therapist. I said, how does that work for you? I don't, if that's your agenda, that's not how it happens. But if we're willing, I think, to be open to hearing, and I just was hearing today on the radio that some of the divide is not even who's what, it's the fear that we're going to be caught in endless discussions around politics and around things that are hard. And it's okay to say, you know what, let's not go there, because we've been divided before, absolutely, but this is a hard time. So being curious about another person, finding out, I'll tell you the trick. Listen well, but find out what other people value. Find out their values, because when we speak from our values, when we know each other's values, when we know our values, we can come to some way that we share. So is that a help at all? Anything else? Any other last idea before I get scooted off? Yeah. We've got hot water. We are so thank you for that, because that's one of those reminders, not that we shouldn't be caring about the enormous amount of stress and violence and painful things in the world. And for most of us, our lives are pretty good. And so what do we do with that gratitude? How do we become people who live fully and contribute to our world to make it better? So thank you for that. And I think this might be it. Let's see. Yes, it is. Oh, and here's this. So my organization, Northwest Center for Creative Aging, it's coming back. It's back now. Wasn't gone for long. We are offering consulting and coaching around the whole topic of what's important to you. Good questions make a big difference, and a good question will help you learn about yourself. I'm very good at questions. So if you're interested, the information is there, and I think there may even be a flyer in your bag. I'm not sure. I think that's true. But feel free to call me and get in touch with me, and I have cards as well. So thank you so much, and thank you for your patience.
Thank you so much. All right, here comes the best part of the day,
He's back.
where you get to ask Don a lot of very tough questions.
Well, you took the question, Mike.
Oh, no.
Yes.
Didn't they give you one to put? You go. I just have this. I'm just holding this one. So,
all right.
let's see, can I
thought
do this?
Stools. I'm going to feel so short.
Yeah, well,
Everybody, I'm back.
get over it.
Did you miss me? Oh, thank you, both of you, for that. Thank you. Both of you.
I think it's the three people that were watching you do the show.
There were, at one point, there were 7 people,
There you go.
but Weston Wellington was there. So they didn't come for me. They came for Weston. He's a really good guest. As a matter of fact, I'm thinking about him for a new co-host.
Remember, I'm the guy responsible for dinner tomorrow night.
I'm not thinking about him for a new co-host till next week.
Weston, time to go to the airport, I think. Got to leave. So we're going to do a couple of drawings as we do this as well, because you don't have to hurry. We've got plenty of time, but we're going
Where's
to take
Hannah?
questions
Oh, there's
right there. So I see someone. Okay. This gentleman wearing the Talking Real Money shirt has been to every retire meet, has sat in the front row for every retire meet.
He
And
was actually here but the year before Retirement in anticipation of the next one.
he's been waiting in the hallway. I think if you start talking, they'll figure out the microphone. So go ahead. What's your question?
I don't know if it works, but
It does
oh,
work.
It does work.
You can pull it out of there if you want. If you don't have to bend over. And
All right,
he's
thanks.
getting ready to retire
Thank you. Yes,
after a great. Can I say your career?
Sure, yeah.
A great career educating our children for how many years?
46.
46 years. So thank you. Awesome.
Absolutely.
Yeah.
God bless.
I
you.
love me some educators.
Thank you. Thank you.
Apparently didn't take, but okay.
I got a daughter.
Oh, jeez.
Well, she's not teaching anymore. Go ahead.
I just have a question about taxes. Historically, we're in a low tax rate environment, and in the past, that always has not been the case. And I know, Don, Tom at Apella, you guys like to make investment policy based on the laws as they exist now, correct?
Mm-hmm.
Yes, but the current
Let me
is
just
that
say,
sunsetted out after
ahead.
2025,
we're
correct?
$35 trillion in debt in this country. That being said, wouldn't it make sense to get as much of our assets into tax advantaged accounts?
So now you got to be careful when you say tax advantaged. So do you mean pre-tax or post-tax?
Tax.
Okay, because tax advantage
not
to
going to
me,
be not going to be taxed
that's
in the
tax
future.
free. Roth
Yeah,
is tax free.
tax free.
Okay,
Yes.
yeah.
Just
So you're saying, would it make sense to move money now from pre-tax to post-tax, pay the tax now because tax rates are low?
do you think taxes are going to go up?
Do I personally think taxes will go up? I don't know. I really don't. I honestly don't. What do you think? I mean, I really don't know.
Well, here's the problem. The problem is like the interest rate situation we had for
And have now.
well, but it was different before. It was rates were low, and every time we turned around, there was some expert and we had people here saying, "Yeah, but rates are going to go up,
Have to go up.
have to go up." But the problem is, we said it for 10 years before they finally did. You're still playing the prognostication game. If given our current situation, again, taxes are a minor part of our financial situation. They are not the lion's share of it. And when you pay taxes, you're paying taxes on money you didn't have before. It's not a horrible
What do you mean by
thing.
that? Money you didn't
Well,
have
like
before.
you made money on your mutual funds and now you're paying taxes on them.
I see.
You got a huge tax deduction on your IRA that was making you money at 8 or 9 or 10 even percent per year every year, and now you just have to give it back. But you borrowed it for free for 10, 20, 30, 40 years. You borrowed it for free. The rate for us, most of us, I don't see a billionaire in the
Back in the back corner.
Yeah. The rates for us
Don't leave before we leave either, by the way.
aren't likely to go as high as the rates for the ultra wealthy, if I had to make a prediction. I think that because we have seen a dramatic income shift in this country like we really hadn't seen since the Gilded Age.
Yeah.
I mean, really, since the days of the Vanderbilts and the Rockefellers. It's dramatic, and I think eventually that will have to shift. But most of us, I mean, if you look at the brackets, even for us today, if you're under a $300,000 income, you're in a pretty decent tax rate. It's when you get up into the 4s and the 5s that you start getting hit. So I
And
would not
anybody
do
know
not just plan for taxes.
Anybody know how much Jeff Bezos saved by moving to Florida recently? $600 million. He did not pay in the state of Washington capital gains tax for his move. Let's do a quick drawing, and then we'll take another question.
DeSantis got a huge bonus from him. No, I'm kidding. I'm not allowed to say anything about Ron DeSantis.
No, you're not.
I got in trouble.
For reasons
I didn't
well
mean
known.
to call him putting fingers
Yeah,
where I did, but
please.
I got paid to do it.
Yes, not enough.
Not enough.
So we're giving away a Talking Real Money shirt to 737, and that has nothing to do with the airline business.
737 Mac.
No, please. 737. All right, here we go. We got a winner down there. Next question. Come on up and ask. We want you to ask it on the mic because all the people that are out in other places can hear it better. Thank you.
I have 3 comments. One, the previous speaker said we should adopt humor, so thank you for your dad jokes. 2, I want to put in a commendation for Derek, my advisor. And 3, I keep hearing on the radio that stockcharts.com will tell me the best things before the pros do. Does that service actually serve any value?
Every single show, I send a nasty note to the station saying, take that spot off.
Well, tell them what stock charts. Not everybody knows what that is. Tell them what that is.
Do you really want to know? Yeah, okay. It's a service where they will send you a chart for stocks and you follow the squiggly line. And when the squiggly line gets to a certain squiggle point, it activates the whole world to go out and buy it, apparently. When it's like the market just reacts to the squiggles.
And it makes you smarter than all the hedge funds.
No,
the actively managed. No,
that's fundamental analysis. This is technical.
That's true. Okay,
it just makes you better at squiggling.
Yeah. Okay. Don't use stock charts. It's not something we'd recommend.
You do pay attention, though.
Oh, we got another question here. We'll do that. Then we'll go do another drawing. Go ahead, ma'am.
Clarification. We were told, don't use managed funds because, we're paying them to do that. But don't do it ourselves because we get scared and run away. So what do we do?
It's a really good question.
I think what you do is you go to the after party with us and we'll figure it out.
Yeah. No, here's what you do. Okay. 2 different things. There is managing a portfolio and there is managing your life. Those are 2 distinctly different things. There is no evidence anywhere. None. Everybody showed the numbers. I mean, Weston shows that everybody shows that there is 0 evidence that and it all has to do with predicting. The difference is predicting. There is 0 evidence that anyone can predict the future accurately and consistently over a period of time. Period. Absolutely can't do it. Do any of you truly believe that you can go to a psychic and learn what your future is going to be? Honestly? I mean, it may be fun, but do you really buy it? If you do, then you deserve active management.
And please call me before I go to Vegas next time.
Yeah, well, I tried.
I appreciate it.
Anyway, the other thing is that when it comes to, not everyone needs personal financial advice, okay? When you are just getting started, it's not complicated. Buy yourself a well-diversified fund, global stocks, you're young. Put it there and leave it the heck alone if your brain can let you do that. But there reaches a point in almost every successful investor's life. Almost every successful investor reaches the point where their portfolio and their lives grow complex. As you saw today, there's estate planning, and there's the Medicare stuff, and the Social Security, and the income generation that Tom showed. These are complicated, and then you throw into that our psychology that is absolutely battling against us at every turn. And that's why you need individual help.
And that is planning, not portfolio, because what you're really asking is, can I just do the portfolio on my own, which we think many people can, but the planning part generally requires a professional. Again, that's why I've got one, Paul's got one. I mean, people have advisors that help them get through all those things. Let's do another drawing real quick, then we'll take a question. What's this one for? This is Larry Swedrow's book, which I highly recommend. You want the book? It's all right. We're locked out anyway.
I'll buy you a book if you don't win.
Yeah, that's probably true. All right, we got
probably true.
with the $100 I lost at Vegas. 522. 522.
They're probably not here.
Yeah, there's going to be.
Tom.
Oh, all right. Come on down. All right. Other questions, please come over to the microphone. I know it's a bit of a haul. If you come over here, I'll give you the mic this way. Oh, we have another mic.
Oh, we have another mic.
Oh, okay. So we got mics both sides. So question.
But that mic is named Bill.
I have a question for you.
What? You're not allowed to ask me questions.
Of course, I can ask them. You might not answer.
All right.
And I don't think everybody knows this. What states are you likely to stop in on your cross country?
What is your favorite color?
What animal would you be? Anyway, what states are you likely to stop in on your cross country tour this summer?
Debbie and I actually have the largest map we could find of the United States, made of paper. And we've spread it out over the kitchen table, covering the entire expanse. And we've gone along the way with little dots of our possible stops. Some of the stops are very important to my lovely wife because she wants to visit family and friends because she's very social, unlike me. And so our likely path is kind of like Georgia, South Carolina, North Carolina, Virginia, Maryland, Pennsylvania, maybe to Ohio and Indiana, Illinois, and then cut up to Minnesota and then kind of jog up and down around the upper Midwest. So that's the tentative path.
That's the way out.
That's the way to Seattle.
Yeah.
And then in September, we'll go south down into California and then come down through Utah and Colorado, just because I haven't been to Colorado in a while.
So if you want to, if you have friends, relatives that are not in the greater Seattle area, if you're viewing, send Don a note and he'll consider adding that to the itinerary.
Yes, yes. In fact, I should put a form online. That would be good.
Question.
I have a question about gifting stocks to the kids. So what are the tax consequences when we gift stocks to the kids and when they sell it?
Well, one, they don't deserve any stock. Don't give them.
I want the last check I write to bounce. Yeah, I got it.
No, give them 529s. This whole UGMA, UTMA giving, because you cannot, a minor can't own stock. They cannot own stock.
Adult kids.
Well, you can give them stock, but they can't own it until they're of the age of majority, so they have to have a custodian. It belongs to the children, though, so it's taxed at the children's rate if it's sold. So, but consider 529s because it gives you more control.
And you can put that $35,000 from the 529 into the Roth at some point.
Yeah.
Huge advantage.
But with a regular UTMA, UGMA from a family member at the age of majority, which in most states is 18, no matter what you want, they can take the money and do whatever they want with it. At 18, I'm sure you were very responsible, but were any of you irresponsible at 18?
28, 38, anyway.
So what about gifting it to the kids who are over 18?
Gift it to
kids over the age of 18.
Oh, well then that's just a gift. That's just a gift. Then but if you gift them, oh, I know what you're getting at. An appreciated stock? No. They know that trick. You owe the taxes on it. It's at your rate.
He thought he had the loophole there.
Found the loophole.
Yeah. Want to do another one? Oh, we have a question over here. Go ahead, ma'am.
Hello. Well, depending on what happens with the free consultation that we're getting from your wonderful company, we're thinking about retiring in a couple of years' time. But we started our family late, and it'll mean that we're looking at retiring when my daughter is just finishing high school and getting ready for college. So what we're trying to work out is how can we make the best provision that protects our retirement, but also makes sure that she's well taken care of and doesn't have to.
They still do adoptions in this country, don't they? Because I have a 16-year-old that I'd be.
You'd give up. Yeah. Because look at him. He's really old.
We both are. It's just I dye my hair.
Both are. I said we both were. Yes, that is true.
So what your question is how to pay for higher education while retiring.
We have a 529 and obviously we're saving, we've got CDs and things like that for her. But I'm just trying to think about, there's a lot that can go wrong with a teenager in early 20-year. And I want to try and protect our retirement, but making sure.
Here's my protection. If you've saved money in the 529, that's great to give it to them. But everything else, they either come up with or they borrow the money. I mean, this is one of the.
You don't have to give it to them in the 529. If they're responsible, you do not have to give it to them.
But one of the problems.
You hold it over their head. You say, you want this? Do well in school.
One of the problems that we have is we have a tendency to want to help others and not ourselves. And you really should be selfish about your retirement anytime, but especially as you get close to it. Because as the expression goes, you can borrow for college, you can't borrow for retirement. And so while your heart is in the right place, you have to make financial decisions that may be hard on the other party, but legitimately, if it's going to be close, you need to take care of yourself first. And by the way, you can use me as the bad guy. I'm good at that.
Tom said so.
He said I had to do it. So yeah. Okay. Let's do another drawing here. We'll take a couple more questions. By the way, if you have individual questions, all of our advisors will stay till late into the night to answer those. They're standing outside.
You heard him. You said you have no choice. No party for you guys.
Yeah, no kidding. This is, what are we doing here? Oh, what is it? Oh, Wild Ginger.
That's right in the building where I'm staying.
Oh, well,
I want one of those.
Yeah, exactly. 427. 42. I hear a lot of 427. Going once. No 427. Got another one.
She locks it every time.
I know. She knows me well. I swear she's going to put the clicker in there next time and take the key. Wild Ginger 551. 551. We're going to start getting people that aren't here. This would be the problem. All right. Trying another one. Okay. And it is 417. 417.
And if nobody has this one, it's mine.
That was easy. All right. One more.
It's mine.
And then we'll just start. Then actually what we'll do is if we can't get it on this one, she'll hold it right there. And the first person up here to grab it out of her hand gets it. That'd be kind of fun.
I'll hold it up here like this.
Number 609. 609.
Well, you're close.
Oh, yeah, we got a winner. Good. All right, next question. You have a question, sir?
Dinner tonight. Thanks.
Go ahead.
Hey, guys. Thank you for this afternoon. Best $35 I ever spent.
Thank you.
Question on term insurance. My wife and I both have a long-term care insurance. How long do you keep up just the term insurance, though? It's getting more and more expensive. And
we're going to get two different answers here. Don?
My answer is you keep term insurance for however long you need term insurance. For however long another person in your life would need your income. Without your income would struggle. If you have built up a portfolio that will support that person with you after your demise, you don't need it anymore. It's there as any other insurance to protect you in a worst case scenario. It should never be considered to be an investment asset or something that's, I'm going to let my wife or kid win the lottery, the death lottery. I die, they win. It's a terrible thing. It should exist only for as long as somebody needs that income from you.
Is it like a 10-year level, or do you know what the terms?
Yeah, 10-year.
Yeah, I think that's reasonable. I mean, again, I have insurance. Don doesn't have as much, but I still have it.
Anybody who needs it.
Yeah, so I mean,
all
I
my
still
kids
have,
are grown up.
I still have.
Yeah, when you retire,
you have the assets to live
income,
on. Yeah, so I think
is that
right
time
there.
to let it
Yeah.
go?
Yeah. Mm-hmm.
Okay.
Yep.
Unless, of course, your wife insists on winning the death lottery. Okay. And she's working toward making you go first.
And then you might.
That's what I'm sorry, but I have a theory. Who dies first in the world? Men or women? Who are we married to? Whose fault is it?
At Don's house, he has a food taster, so to be sure. So
It's a dog.
It's
We
a
call it a
dog.
dog.
Try this. Oh, not feeling well.
Long-term care? No,
No, he said long-term care, but
he
they
meant
changed it to
term insurance.
Yeah. You know, long-term care insurance, I didn't get to.
They
yeah.
have long-term care.
It's changed a lot, as you may know, in the last 15 years. Basically, everybody was in the long-term care insurance business and then found out they weren't making money at it. They bailed, most of them. And now the real only ways you can buy that is with the lump sum, paying them, give them a bunch. They take the premium out of that. If anything's left, they give it back to you. I'm not a fan of giving insurance companies my money that way. I do have term insurance, but there are some new, we just looked into this. I want to thank Justin, who's back here, one of our advisors. We did look into some smaller long-term care policies now that are being issued as HGL Select, I think it is, and others that are issuing smaller ones that might be a good supplemental. I mean, it wouldn't cover everything for as long as you might want, but they might cover a couple of years of home care or part of it, and they're relatively inexpensive. So there's been a few more additional things there that might help. But it's a weird, it's very
terrible industry.
It's a terrible industry. They haven't done well at all. Sorry to hear that. Yeah.
This is a silly question.
None.
Did the dog get here okay?
The dog? Here somewhere. Where is the dog?
Dog.
I think Debbie's out in the hallway.
Yeah, my wife has is hearing impaired. Pretty severely hearing impaired.
Dog that got from Seattle.
Oh, the dog. Oh, you got to tell the story.
That story.
Don, tell the rest of the, tell the whole story.
Terrible story. Yeah. It was terrible because the people involved were so.
Wait, you got to go back to the beginning and tell the story because not everybody knows it.
It's so hard. Anyway.
I thought it would be a good.
No.
Well, it was going to be. Yeah.
It turns out it was totally a scam.
Wait, but tell everyone else who doesn't know the whole story the story.
Well,
they don't know.
I'm sorry I asked.
Quite all right.
Okay.
Be good news.
I wished it was.
We got a phone call one day.
Yeah, that my wife is very socially active. She loves people. So she got a call from somebody in our town that's
in Florida.
In Florida, that we found a dog that belonged to somebody else. It was chipped, and then we found out it came from Washington.
Yep.
How the dog,
like Benji 3 or something.
It had been stolen from Washington and taken to Florida. Well, and so they needed the family in Washington wanted help to get the dog back. So Debbie calls me and I put it out on the show, and a lovely woman with Delta
Airlines, yeah,
said, I will fly out there and bring that dog back.
Yep. She did, right? Literally within about 5 minutes.
I will do it. I will I can do this. I could fly out for free. I will go get it. She was a gate agent. And I went, that's just the nicest thing. Well, then these people who found the dog did some more checking. It turns out the people in Washington weren't really in Washington. They were claiming to be, and they wanted the money to pay for the trip. Yeah. For them to drive down. They needed new tires for their truck and the gas paid for and all this stuff so that they could get down to Florida to get the dog.
It did turn out well. I mean, the good news on the ending, though,
the dog was adopted.
Yeah.
The dog was adopted.
It all ended well because
great family.
The gate agent has agreed instead to take Don back to Florida for me. So it all ended well. I mean, that's... No,
it's the kennel that's the problem. They gotta put me under the seat.
As long as you're underneath the plane. I mean, other questions? We'll do another drawing while we're waiting for a question. What do we? Oh, we have the backpack, and this is it, right? Last chance. What? Oh, Derek has some. Oh, we have a lot of. Oh, hi.
Well, where is Derek?
You got going there. Haven't seen that.
Oh, there's Derek.
And thank you, by the way. Derek. Thank you for your email because you saved a lot of people a lot of trouble. We didn't know about the traffic situation. This nice gentleman told us about it. I think it was yesterday, right? About the whole 405 boondoggle, and you helped.
405 a boondoggle?
Yeah, well, shocking there. 638 for the backpack.
I don't even live here, and I've heard that 405 can
638, and we're giving away Schwab backpack. 638 going once, going twice. Yeah, we have a lot of online questions. Dan, go ahead and give your question if you would.
Okay, thank you, Tom and Don. Like your opinion, your feedback on this, it's something that I just came across the other day. Tokenized shares make the investment world more inclusive. By turning shares into tokens, business owners allow investors to easily add assets to their blockchain accounts.
Well,
This is the second dumbest, third. No, NFTs.
he's
still
having
the dumbest
fun
thing
with
I
you.
ever heard of.
Yeah.
Non-fungible tokens, they're number one. Well, basically what they're saying is you just put your shares on the blockchain.
Yeah, right. Yeah.
So, okay, maybe somebody will do that someday. Seriously, but I kind of doubt it. Kind of like Bitcoin. They kept saying someday it's going to have something that you'll be able to do with it. We don't know what that is.
El Salvador.
Quit saying El Salvador. That is not they're a bunch of dumb bunnies in El Salvador looking for press. Anybody except El Salvador using it for anything? Anybody?
There's a pizza shop in Arlington, I think.
Anybody here bought anything with Bitcoin ever, or had anyone buy anything from you with Bitcoin ever? No. See, thank you. Did you buy it? Right.
It didn't work out. Love the hat, by the way. What do you think? How's the team doing today? Do you have been following the score? Okay. We'll see you there. That's gonna be a great game.
Yeah.
The
Now we're
backpack.
talking soccer.
6, 5, 8. We got one right there. Good. And I think we have time for. Oh, we got another question right there.
I just have a comment. One of the things that I love to do is mentor junior staff at the place that I work. I actually just retired last month, but I'm still on the books part-time. And during the pandemic, we didn't have a lot of people in the office, but we had a lot of new people start working, junior staff. And I managed to convince at least one, maybe two of my co-employees to invest, to put in their minimum amount in their 401k so they could get the match. And I just wanted to tell you that, going to all these presentations over the years has made me sort of evangelical about, trying to get junior staff or younger people to take these things seriously. And, so the word is getting around. Just want
Thank you so much. There's two things there. Number one, yes, we want to help more young people. Number two, you work at a place where people go to the office? What's that like? I mean,
There's just a couple of people.
I go in every week like somebody.
Yeah, the best argument, I mean, it should be so easy.
I know.
Look at somebody, you go, how about if I give you free money?
Right.
Free. It's free. You don't have just
show.
Free.
Yep. Don't even have to show up.
No. Just put money in your 401k. We'll give you free money. Yes, sir.
Oh, hi. Been here since 2014, and I have a question. How do I persuade someone who say I don't got enough money to invest in anything since I'm working hard and basically don't have yearly under $30,000 to invest?
So where do you put under $30,000 to invest? Is that what I'm hearing?
Oh, how do I persuade someone who say
who doesn't have enough money?
Yes.
For an advisor to invest?
Yes.
We give you one fund.
Yeah, you use something like
you could do
or
or
how old a person is this person?
Say 30, 40.
I would use one of the one fund products, DFAW, which is Dimensional's global ETF,
yes.
AVGE, which is Avantis's AVGE global equity is theirs. And then Don mentioned VT, which is Vanguard. Any one of those I think would be very fine. And there's no minimum. You pop that right in there and
then just tell them to leave it there and don't look ever
don't
again.
Look. Yeah, ever
until they're
again.
Close to death.
All right, we got time for one more question. We want to let everybody go home. And by the way, on your way out, I'll say this one final time. No, this really isn't. If you want to hear from us again, you need to fill out the form and let us know. We'll be glad to have the meeting with you. If you don't, thank you for coming. Thank you for listening. And we hope to see you all again. Ma'am.
Yeah, I have a question.
Can you talk into the mic? Because
my Vanguard advisor sent me something that he wants to put in my portfolio, corporate overweight strategy. Do you know what that is?
No, but I'm sure Don does because he invests in stuff like this.
Sounds like a bond fund.
Corporate overweight strategy.
Sounds like a bond fund.
Which is,
overweighting.
Yeah.
Bonds.
Well, I'm trying to reduce my overweight strategy. And it works.
It does not. I've been around you long enough. It's not working.
Don told me a couple of years. Can I say this?
Yeah. You can say anything you want. You will.
Yeah, I will. Because some of you, I mean, I work out a lot, you know, and I referee soccer. I do all these things. And at one point I told Don everything I was doing. He said, you really should be slimmer. You know, it's nice to have an honest business partner, you know, really. Thanks.
No. That's not a business. That's just a friend.
Okay. A friend.
It's just a friend.
Any of you need a friend, call him, you know, so. I don't know this.
Oh yeah,
this
it's overweighting.
Vanguard. Okay, yeah,
it's
okay.
Overweighting
Yep.
corporates and
Intermediate term, yeah.
It's just another game that they're playing. And
bond market.
Vanguard. I was once. Anybody got a minute? Long time ago.
That's probably it for the afternoon too.
I was a big fan of Vanguard, and then I felt like they started getting greedy. And they started doing dumb things. They're starting to come up with like fancy pants strategies, which you don't need. They have such amazing products at low prices, but I'm telling you, I don't think their advisory services are what they should be cracked up to be. I mean, they're charging you 30 basis points, but they're only putting in a really basic portfolio of Vanguard funds. You're not getting a lot of personal attention. You're not getting the best asset classes for your situation. You're not getting great planning. What's the point? Why pay when you're not getting anything more than you could do on your own? Basically, it's not that fan. And to say that we want to overweight something now because we think it might be better, but
it's not Bogle-like.
It's not Bogle-like.
Yeah.
Jack is tossing and turning in his grave. So anyway, I just think Vanguard's getting silly now.
Well, we've gotten a lot of complaints about Vanguard the last couple of years about customer service.
It's so weird to have us
They've
looking at us.
grown. It's kind of scary. That's a little too close. As they've gotten bigger, as you mentioned, the advisory, they've moved into a lot of other things. And I think that's gotten them away from the core, which we would prefer to be index funds. Now they have both. They have some
index. If they want to go up against DFA and Avantis in the factor markets, groovy. That's fine. I love competition, but they keep adding active strategies and
other stuff. We have exhausted all of our questions. We've exhausted each other.
Oh yeah.
We've almost exhausted the staff.
I think this is longer than we've ever talked to in one day all year. So since last year about this time.
And I want to say, truly, thank you. Thank you for listening to us. Thank you for the trust that many of you place in us. Thank you for being honestly part of our lives. We love it. And I can't speak for Don because he won't let me, but I will tell you that it has a great impact on us. All the people that have come up and said hi today, and so many of you that we've gotten to know over the years. So thank you.
Yeah, we really truly do appreciate this. I mean, 10 years. I feel like it's really quite an achievement, and that you guys are why it worked, because you're an incredible audience and wonderful. I love the Pacific Northwest. If you could just stop that rain thing. If you could stop that, I'd live here.
Thank you all. Have a great night. We'll see you again soon.